in at least a short-term bottom here. But I think that the crude oil story is really the big story. It can end up being very helpful relative to inflation. You've got weak economic growth in China, and China, they're just panicking. They're cutting rates. They're asking funds not to sell stocks. They're asking banks to buy stocks. They're asking banks to support their currency. They're cutting back on handling fees for stocks. It looks like they're panicking over there. And there's more oil hitting the market now because we're basically easing sanctions on Iran and on Venezuela. And, this is probably part of the Biden re-election strategy. He certainly doesn't want to see high gasoline prices next year. And we just saw in the University of Michigan sentiment survey that, which was a little bit disappointing. And part of the reason was people were talking about gas prices. So also China has been stockpiling crude oil, and they're probably going to stop doing that. So I don't think that oil is going to move as high as a lot of people have been calling for the end of the year. I think that's going to be very helpful for the total inflation picture.
One would argue, especially if we continue to see strength in the U.S. dollar, ultimately that would weigh on crude also. Wayne, appreciate you joining us here, sharing part of your Monday morning with us. Wayne Kaufman, Chief Market Analyst at Phoenix Financial Services. A quick break, more futures when we return. Chris Robinson's going to join us here to take a look at crude oil prices and some of the other commodities on his radar. Jenny Horn's got a couple stocks she's watching this morning, 3M and XPeng. We got lots more futures, lots more here on the Schwab Network after this short break.
next. And I don't think that that's going to change until they hit their 2% card target.
Kind of feel like, Chris, if we don't get that breakout you just mentioned up above 85, if we don't get those new longs kind of chasing that move, ultimately, I mean, you get kind of the combination of a few factors playing out here. China, right, not necessarily developing to the extent that we thought, rates on the move higher, and we were just talking in the last segment about the impact that a higher dollar could have on crude prices. I mean, still holding above the 50-day moving average, but again, in terms of that range, we talk about the significance of the upper and the lower extreme, but also the middle is important as well, right? Sort of that pivot area, and through it, ultimately, I always say, opens up a door for a retest of that lower extreme. Fed Chair Jerome Powell would probably love to see crude prices back down to 65, and so would they in terms of replenishing the SPRs in the Biden administration.
Yeah, I would hope so, right? And I just hope they don't do like the rookie trading mistake. Don't turn a $30 winner into a $10 loser. That's the question. And everybody out there, the whole world's watching it. And I don't care how many PhDs or what your GPA was when you got your thesis at wherever you went to school. Markets are markets, and everybody is watching the same stuff. And like I said, barring some big story, barring some black swan, barring some craziness in the world, everybody's a technician now, which, you and I have been doing this a long time. There's the old story, the chart, the seas, the bottoms of the ocean are littered with captains with charts, right? So this stuff, some people fall in love with charts. There's sometimes when they really are amazing, especially if you look at them 6 months later. But when you're in the heat of the moment, these levels give you one thing. They give you a reason to pull the trigger. I don't care if you're bullish or bearish. That's what you've got to treat them. You can't treat them like an algorithm where A plus B equals C.
I agree with you. And in terms of crude, again, I think it's important to the point you make. You don't necessarily have to hold out and try and buy that last low tick. And I used to have a boss that would tell me every time that we'd bring up the chart says this, the chart says that, he would say there's a chart on every ship at the bottom of the ocean. Along the lines of that saying here that you were talking about. Let's get into what we're seeing here. We're going to talk again a little bit about the impact that the stronger dollars had. Well, we just mentioned in terms of crude. We're going to talk about it in terms of the Dow as well, but also gold, right? It seems to be one of the factors that we watch, but as of recent, when you look at gold at these price levels right now, the dollar up around 104, I mean, this is a win for the bulls, as I've been calling it, a kind of a best case scenario.
If you're talking about the gold bulls, yeah, absolutely. 1900, here's the deal. Big picture. I always talk about big picture. If you want to chase the next tick, you don't need my help. But big picture, we've been in a $450 trading range, 1620 to 2065, 450 roughly. And that 1900 level, we've tested it. I think it's something like 19 of the 36 months I counted last night. So 1900 is a big battleground. So again, I'm not too concerned about whether or not you're bullish or bearish. It's how you manage the trade. 1900 is a pivot, and I think you're right. I think that if this holds, that's going to be one more time, and it was 2065 or whatever that is. Is that the triple top? I've been told that double tops don't hold. Well, we'll see if triple tops hold. That's a beautiful trade setup again, and it's an opportunity for everybody out there. The people that are going to get hammered by gold are the people that treat it like like a religion. It's an opportunity, and this is a very key level. And again, you don't take my word for it. Any $3 charting service, you can pull it up and take a look.
Trade it, don't date it. It sounds like you're saying, talking to me about a similar pattern here, right? If gold were to take out 2100, ultimately, you'd be looking for some energy, the bulls to kind of jump on that trade, continuation, follow through, higher highs and higher lows, exactly what the longs would be cheering on.
Yeah, you can't get to 5,000 till you get through 2,100. Just remember. So, for years and years, I can remember when gold was at $300, and I was, that was what, 27, 30 years ago. Gold set at $300 for a long, long time, and so and if you look at what's happened since the pandemic, that is interesting because we've been in a $450 trading range. We've been up and down, and it's given traders a lot of opportunity. The people that buy and hold or sell and hold, they've had a difficult 3 years.
Well, we've been talking a lot about that in terms of some of the intraday opportunity versus what we've been watching in terms of some of those longer-term trends. And Chris, I think you sum it up very well in terms of if you're trying to capture the next tick, you don't need my help. But in terms of bigger picture, this is where you want to be in terms of focal points and where we think your attention should be. So we're always kind of steering towards that bigger picture perspective, and appreciate yours in terms of your contribution. As always, Chris Robinson joining us this morning from TGM Institutional Services for a look at a week ahead in terms of commodities and where they stand in terms of the discussion here. Now to check on a couple developing stories, time to bring in Jenny Horn, markets correspondent here on the Schwab Network, with a look at, well, Jenny, first and foremost, I see 3M topping the list amidst a settlement regarding these earplugs, right, in the military.
Yeah, Ben, we have some pretty major headlines this morning that are affecting various names. 3M today reportedly nearing this agreement for about $5.5 billion to resolve now hundreds of thousands of claims brought against the company, alleging that its earplugs were sold to U.S. military, that those were defective. So this is really interesting. Now, according to multiple media reports we've gotten this morning, sources close to the matter say the negotiations are ongoing and the final amount is yet to be confirmed. So this $5.5 billion is right now, I think, being sort of estimated by various reports, but the potential settlement was first reported by Bloomberg. Shares of 3M did rise this morning, as you can see there. We also did see more than 300,000 current and former service members that have filed claims blaming 3M and one of its subsidiaries for knowingly making earplugs that failed to protect them against hearing loss. 3M has contested those allegations, saying the earplugs work correctly and that users were given proper training then how to use them. But the settlement could be far less. It could be far more. Something could be between 10 to $15 billion. However, some that do say that in terms of its litigation costs, this could end up actually being a far less material impact if they settle prior to some of these different court proceedings. So very interesting story nonetheless. And I would say whenever I hear noise canceling headphones, I'm always like, you know, is anything really truly noise canceling? But I guess when you're in the military, you would expect things to be a little bit more effective.
Absolutely, absolutely. Apparently the deal with this is they were a little bit shorter than they needed to be in terms of ability to travel further down into the ear canal. But I think you bring up a good point here. This settlement was expected to be a lot higher than this, so we're seeing a positive reaction in terms of the stock up this morning. Talk to us about what's the news with XPeng.
XPeng. This is also really interesting. We are seeing shares are soaring also this morning on the fact that we did see there's news of the $744 million deal with ride-hailing giant, also located in China, Didi. Now, Didi IPO'd, and it was one of these names that was on a tear, and it's fallen out of favor for, gosh, now the better part of the last 3 years. So really interesting. XPeng will be acquiring Didi's smart electric car assets through share exchange, giving Didi the role of strategic shareholder, which this is per the both companies announcing this earlier today. With the new assets, XPeng plans to launch its first electric car model under a new mass market brand, which currently has a project code name of Mona. So XPeng has gotten absolutely crushed over the past couple of weeks, but this name also has been really expanding. It has, you know, this ongoing partnership with Volkswagen, which was read as a huge positive. Shares took off on that news, and now taking over a company that has been lackluster for several months. So it seems like Didi's failure is going to be XPeng's gain. But all I know is that the market right now in China is so competitive. We have so many companies that are expanding and trying to expand rapidly. I'd say any edge and any M&A seems to be welcomed by the street.
Yeah, I'd have to agree. And these are two names to keep an eye on in terms of developing stories here as we start the week. Not the only two names we'll be watching, but Jenny Horn, appreciate you bringing them to our attention. And, well, we're going to take a quick break. Stay right where you are. When we come back, we've got Michael Zaremski. He's going to help us deeper dive into that Powell discussion, the comments Friday, and the expectations of the target, which remains set at that 2% level. We got the chart master who's going to join us to take a look at the Dow and how large caps are starting to feel some of the pressures from a stronger U.S. dollar. We've got more futures. Stay where you are. You're positioned properly. You're watching the Schwab Network. Back in 2 minutes.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future.
By Colin Kelleher. Shares of Hawaiian Electric surged in pre-market trading on Monday after the utility company said its power lines were de-energized hours before the start of the Maui wildfire that killed more than 100 people. The Honolulu-based company said record show power had been out for more than 6 hours, and that there was no electricity flowing through its wires anywhere on Maui's west coast, when the fire that swept through the oceanside town of Lahaina broke out. Maui County has sued Hawaiian Electric, alleging its power lines caused the deadly wildfires on the island. Hawaiian Electric said that while a much earlier fire appears to have been caused by fallen power lines, fire officials declared that fire, 100% contained, and extinguished, and left the scene. The company said it has informed investigators from the Federal Bureau of Alcohol, Tobacco, Firearms and Explosives that it has records that back up its accounts. Hawaiian Electric shares, which fell nearly 19% on Friday following the filing of the Maui County lawsuit, the suspension of its dividend and a credit rating downgrade, were recently up nearly 37% to $13.22 in pre-market trading. Right to
maybe realize that as well too. And as the markets, I mean the interest rate markets, because Ben, if you looked at that 2-10 yield curve from last Monday to today, it moved 22 basis points, increasing the inversion there up to what, negative 85 basis points here this morning as well too. And what that's saying is that the 2-year note is actually rising higher. It's like 23-year highs here currently as well too, saying that the rates are going to remain higher for longer there. But the back end of the curve, even though it's been rising lately, it's starting to level off as well too, as I think they really starting to believe here that the Fed will need to see some economic weakness there before they will budge from their higher rate environment that they've been in.
You know, Mike, a couple good points there. Credibility, obviously something the Fed's got to continue to achieve, right? And they don't want to see falter ultimately, because that would create quite the ripple effect. I don't even want to head down that rabbit hole, but obviously strongly expected economic conditions. So they've got this firm ground to stand on here right now. So that helps them in terms of sticking with these targeted goals. But I think you really bring up a good point here. The move that seemed to really catch a lot of attention over the last few weeks was on the longer end of the curve, right? As we had that debt ceiling debacle resolved, the issuance and some of the concerns associated with the magnitude of. But headed into the Fed announcement, or I should say the Fed comments from Powell at Jackson Hole, it was really the short end of the curve that started to accelerate to the upside, and again widening that inversion ultimately. What does that tell us here a little bit further out in terms of expectations? Because now you've got a situation where we've seen the long end and the short end on the rise here. Ultimately, we're going to talk about it more in a second here in terms of the U.S. dollar, but watching this all yields the dollar on the rise here ultimately poses another headwind or potential headwind for stocks.
Yeah, absolutely right there as well too. We've seen the dollar there gain at what, 2.5-month highs here versus the euro, again the dollar index as well too. And it's, I think, really the function of the U.S. economy being stronger than expected there. Whereas even though Christine Lagarde, their ECB president, also noted though that they need to maintain higher rates for longer there and to get to their 2% target as well too. They are also running into a much slower economy in the EU than we're seeing here in the U.S. And I think that's being reflected here in the currency markets here, thinking that the ECB may have to kind of back off sooner if we really start to see economic conditions start to deteriorate there. And a lot of that will be tied, I think, to energy prices as well, too, as their energy environment situation in Europe is a much more difficult situation than we have here in the U.S. So we start to see energy prices creep up and they start to look at shortages there that could really dampen the EU economy there, forcing the ECB maybe to actually pause or actually cut rates there to kind of get the economy back rolling there. And all that is really bullish for the dollar. And like you said, bullish dollar is not good for those large cap stocks that have a lot of multinational exposure there as well too. And it can actually, like we're seeing here in the markets currently as well too, a little bit of a consolidation, a pause after a sharp runoff. We had a correction here, and now we're just kind of treading water here as we wait for a lot of economic data coming out the rest of this week.
You know, a fun fact here, Mike, I was looking at a newsletter from one of our regular guests here, Mark Chandler from Bannockburn. He wrote this morning, he said, note so far this month, the S&P 500 has not posted back-to-back gains. He said, if sustained this week, now if higher today, this negates that, but if sustained this week, the benchmark was unable to gain 2 consecutive days for a month. The streak could be at risk again today, he says, but ultimately he says we haven't seen that basically since, what was it, April of 2002. So I think it's a reflection of what we've seen in terms of rates and the U.S. dollar higher. Michael, is the takeaway here basically, if you haven't kind of gotten on board in terms of the higher for longer narrative, or if you've been pushing back against that expectation, ultimately it's time that you sort of just get on the train maybe and start to accept it for what it is.
I think so, and I think the markets have started to accept it. And also, Powell also noted there that monetary policy is like navigating with the stars on a cloudy sky there. So it really is subjective there. It is going to be data dependent, and of course, any shocks there can alter their perspective there going forward as well too. But right now, we just look at the data coming up here. We got employment data, we got inflation data with PCE, we got personal income and spending here. All those will kind of foresaw a tail here for the Fed here for that guidance there to how long can we keep rates higher as well too. Do we need to make one more rate hike the rest of this year here to really kind of put the foot down on inflation there and really keep these rates at restrictive levels here to bring that inflation pressures down? And it's all going to be guided by the data here. And I think the markets will start looking at this data there, and I see if the data looks positive for the markets, we expect a good reaction. If it looks negative there, inflation being hotter than expected there, expect a little bit of a pull down here. But I think these moves here, these large swings, either up or down, may be kind of done here for the rest of the year. We may see more of a choppy quarters. There's a market really kind of digest a longer environment and those lags that the Fed keeps noting there on monetary policy, on the economy as well too, that I think will start getting more forward there as you get into 2024.
Well, that wouldn't necessarily be a bad thing, right, Michael, considering that we are navigating under stars and a cloudy sky. Any shocks ultimately could be more like icebergs, right, in those circumstances. Absolutely. So let's avoid that at all costs here. Michael Zaremski, appreciate you joining us to kick things off here this Monday morning on the Schwab Network. It's now time to bring in Rick Decat. He's our chart master. He's going to help us take a look at the Dow here. Rick, I saw some weakness in large caps relative to the broader market, the S&Ps and the NASDAQ, for example, as the dollar strengthened, maybe starting to become a bit of a headwind.
Yeah, the Dow, looking at it during the past 2 weeks, we've been trending downward. That has shifted more toward a sideways trend, I would say here. However, as one thing that stood out to us is that we did break through those lows from last week here. We bottomed out near about 34,062. So, we're up about 1% from that point now. We are recovering somewhat here. It looked like we formed a bit of a triple bottom as well, too, near the 34,300 level or so. So that was something noteworthy as well. Now the points to watch are 34,062 to the downside, which was the lows that we formed on Friday, and 34,700 to the upside. We had kind of a double top there near that red dash line, Ben.
Yeah, it looks like there was some energy as we took out that triple bottom, to your point, but follow through was somewhat limited, and we're kind of now right back in that range with a new lower extreme parameter established to the downside and that well-defined upper extreme still intact. So kind of, I like what you're saying, a little bit more sideways than not. I mentioned at the top of the show, it wasn't just the Dow that took out the lows from the prior week last week into new lows for the month of August as well. Russell did additionally small caps and large caps participating, and the S&Ps and the NASDAQ again did not. But let's take a step back away from that more intermediate chart. Let's take a look at the daily and tell us where it puts us here right now in the bigger picture as we've come off the highs for the year.
Yeah, it's a bit of a different story when we look at it in the bigger picture, because really we've been trending upward for much of the time since March here. We've got an upward channel to contend with here. However, things were looking pretty interesting starting Thursday and Friday last week because we broke to the downside through the lower level of that channel. We didn't really move beyond the familiar range that we've been within, though. The green line at 34,200, the red line at 34,600. That's about where price had topped out for much of the past year here, we did have that breakout to the upside that capped out near 35,843. We've been trending down since that point. Now our moving averages, our 63 and 252 are flat, and our yellow 21-day exponential moving average is trending downward here. So kind of a mixed picture in terms of that. But we did recover back within the channel. That's important here. Now we've got some points to watch here. We've got to break through that 34,600 level. That's roughly in confluence with our 63-day EMA there in orange. That would be an obvious resistance point that the bulls would probably want to crack through, Ben.
Yeah, you know, as I look at this chart here, Rick, I'm reminded of the importance of being time frame specific when discussing price activity, right? You could be having a conversation out front of your house with your neighbor and talking about how, hey, the Dow's trending lower if you're talking about that more intermediate, that more granular time frame, but he's looking at you like you have three eyes, right? Because on the daily time frame, if he trades the bigger picture, he's like, this thing's been trending higher, and we've got higher lows here that are playing out right now. This could be a buy opportunity, they're thinking. So I think it's significant. It also speaks to how time frames are kind of what makes a market, right, in terms of providing that other side and the different approach, long or short type of approach. Let's get into what we're seeing in terms of the dollar and the Dow, right, and looking at the greenback as a potential headwind here.
Yeah, that was well put, Ben. It all depends on your perspective, you know. And if we look at our next chart here, I put the dollar and the Dow together on the same chart. The dollar's on the left axis, the Dow's on the right axis here. And you can kind of tell just at a glance that they tend to move in inverse directions from each other. Now, to prove that, I put a 20-day correlation study there. -1 means they move perfectly opposite to each other. +1 means they move perfectly in tandem with each other. You can see that we had some kind of swings in this correlation recently because just near the end of July, beginning of August, it was at the highest level it's been all year. So they were moving together, and now it's reverted back to the lowest level we've seen since I believe about February, January here, almost toward that -1 correlation here. So moving in opposite directions once again, Ben. So it's important to keep track of these relationships. They can tell you important things when they start to break down or when they start to kind of re-engage with their expected behavior, Ben.
Absolutely. Potentially a canary in the coal mine here as far as an indicator, something to watch at the very least throughout the week. Rick DeCat joining us this morning, the chart master, taking a look here at the Dow, some of the weakness we've seen in large caps and tying it back to some of the strength we've seen in the U.S. dollar, back to 104 to begin the week. That's our show for this Monday. Thanks for joining us to talk futures here on the Schwab Network. Stick around. There's lots to come here throughout the day. Headed your way next. Morning Trade Live with Oliver Rennick.
Good morning. Happy Money Monday to you. And adjust your audio. It is August 28th. We're going to be streaming stocks, options, futures, trading today, watching SPY, GNS gapping up, GME, barbecue, got a little gap up on liquor, watch AMC. Yeah, sub up, like up, comment down. Happy Money sticks around. Hope you had a good weekend. Be ready for some Happy Money Monday. Follow us on Twitter at Happy Money YT. And we have a Discord server. For both of those are in the description. I'll add a link in chat. Will be pinned for the remainder of the stream. Went over some pre-market news and what's going on. Got PCE this week on Thursday. Not much today. Tomorrow we have job openings. Wednesday, GDP revised. Pending home sales, wholesale inventories, retail inventories, U.S. trade balance and goods, GDP employment. That's all tomorrow or Wednesday. Thursday, initial jobless claims and PCE. That could be a mover there. SPY gapping up here, up 0.48%. It's right on that shoulder over there, so we might be opening at the high of the day. We'll see. This was also an extended hours level, so we're higher than the trading hours shoulder. We're at the high of the day right now, or I could keep coming back up, and we're gonna be in find resistance back at the top of this channel. So it has a little ways to go for that. If we don't kind of reject right here. The top of the channel I think would be 443.35, somewhere around here. Yeah. You were here earlier, you heard I had the news read you about Hawaiian Electric. And shares are up 36% in pre-market. There was a lawsuit from Maui County, I don't know what it is. A lawsuit basically against Hawaiian Electric. Claim that they started it, and they have evidence that there was no power on those lines when it started. Because the fire officials said that 100%, there was a fire earlier that was caused by the power line down or whatever. But that fire had been 100% contained and extinguished, and power's off since then. And then hours later is when the other fire broke out. So, anyways, yeah, it's capping up on that news. So that lawsuit might be futile or dropped. I don't know. I like the Hawaiian Electric play potentially. They did suspend their dividend, which is definitely sketchy, but that could just be until this is all resolved. And if so, this will be a nice dip opportunity. This Hawaiian Electric company. Shares of GNS are gapping up 30%. One we've been following, done pretty well on. Now we're above the highs from back here, 175 to 1910, up 30%. $2 resistance, I'd say 210 or 201, I guess. It looks like they got moved. No, yeah, about there, about $2. We'll see, find some resistance there. There is the ex-dividend date on the 31st, so we'll That's this Thursday. Not sure if we're going to sell off after that. I think that is a possibility. AMC gapping down just a little bit, down 4. Much better than the 30% we've seen. GME's up 1%. Liquor's up 35%. I don't think there's news on this. Assuming there's not. Oh, there is. $2 million share buyback. Wow. They're already buying back shares. They just IPO'd. Just jumping right in. Seems like the insiders all sold as many shares as they can. Now they're doing a share buyback. Interesting. BRAD is down 0.5%. Down a lot. Oh. One is up 1.7. Base is up 2%. Teledyne had that big candle down for it. Oh, maybe it'll hold this level. Oh, I got about 20 minutes to open. Thanks, Taryn. Appreciate your thumbs up. You were here early. Morning, Bella Scott. Doing well. Good weekend. Ready for Happy Money Monday. Hope you are as well. Any rug pull today. Puts are going to be juicy. Second thumbs up. Thanks, CJ Lee. Appreciate it, man. Yeah, we'll see. We will see. Thanks for your likes, guys. We've got 3 so far today. Morning, Julian. We're 3rd. Appreciate it. Morning, Bubba. I think I might paper it, but I think I'm gonna start trying strangles right at open. I'll paper it again. Helps with the morning FOMO. At least if I have a paper trade on. Then I want to start trying it. I think I could get it to work. I'm just rather experiment with someone else's for no money, I guess. So I would just open it up. Basically daily, do at the money, all side, put side. Be a little more realistic about it. I'm doing one on both. Market order it. 155 on debit. This is a paper account. It's a call to put at the money today. So this should execute when bell rings. About 20 minutes. Strangle is on. Buys up almost 0.5%. Market.
We will get some interesting names this week. Renita's going to preview us some of the tech notes that are already out ahead of cloud companies.
Yeah,
but
the group is smaller, but still some good high-profile names.
Exactly, kind of the last
Morning,
batch
Guts.
of these names. And then the timeline, to your point, with inflation, GDP, I mean, we should be getting some action at least by the middle of the week, it seems, because this is a market that's going to take its cues from bonds.
Yeah, of course it is, right? And bonds are going to have an interesting week, as they always do the week of payrolls, right? You've got JOLTS on Tuesday, you've got ADP Wednesday, you've got jobless claims on Thursday, and you got payrolls on Friday. So the employment situation as we know it, you're going to get pounded with data there. Throw in GDP, throw in income and outlays, and PCE, and you got a big week of economic data. We've had a couple light weeks in terms of data, heavy this week.
Okay. Should be fun because now that Powell kind of was able to find a middle ground, the market's really going to decide, I think, on the specific data, and we're going to see consensus forming one way or another, I hope, this week as the bond market has kind of left us teetering basically on fresh new highs.
Just like a good parent.
Yeah.
He's given us room to run with boundaries.
Okay.
Yeah.
All right. Thanks, Kev.
Yeah.
Good setup here. Good description of what's to come. Let's talk some of those tech notes out as we do have a pretty busy week for earnings. CrowdStrike, Salesforce included, Renita Young, and this morning there's already a pretty cautious note out on CrowdStrike that I feel like is very interesting given the reports coming up.
Absolutely. So shares are tumbling this morning. It just got a downgrade at
New high there
Morgan
on
Stanley
live
to
pre-market.
a equal weight from an overweight rating, and the stock now has a price target of $167. That's down from $178. That's about a 12% move to the upside still from where the stock closed on Friday. And this analyst says that he's cautious on the shares heading into this report, pretty much because of the consensus estimates for the second half of the year. He feels like the consensus estimates for the company to rebound may have a little bit more caution in that they actually appear high in light of what's happening with this company and what's happening in the environment for the second half. He says that it's going to be a much more difficult demand environment as we go forward. And we know that companies, they've been reconsidering their budgets as they look to the end of the year and into next year, and maybe even into the year after that, to find out how much they can afford to spend on software. And so, and cloud computing and all the other connected activities that they have to do to make their business work. So this company, however, this analyst says that what they truly need to upgrade may or may not be there. But the analyst says that another cut to consensus annual reoccurring revenue estimates seems likely for the company. So we'll be looking to find out if they actually consider cutting their estimates going forward or if they stay the same to where they've been.
Wow, so the analysts basically predicting that they're going to have to reduce their expectations for the rest of the year. It's a big stock that a lot of people follow very closely, given the cybersecurity connections. And the fact that they still have a price target above where it trades makes this, not the worst cut. But certainly when you see this ahead of the actual earnings week, it definitely introduces a good bit of anxiety for the whole kind of group, a little uncertainty to not just wait for the number. Analyst feels compelled to come out and make the note. We did see last week couple decent reports from the cloud space. Workday was one of the main highlights. This week we've got Salesforce. These are companies that definitely should benefit from the robustness of the economy. But to this analyst's point also, they're still dealing with kind of some of this post-COVID drag where they're just not selling as much as they were.
Exactly. And also there's another analyst note out today about CrowdStrike raising the price target to $200 over at Wells Fargo.
Oh, wow.
So we'll find out what, traders are trading on today as they come into the market.
So two competing notes, basically.
Completely different. Yes,
wow.
Competing.
All right, how about Salesforce?
Well, Salesforce is a little bit different. So shares were in the green about 5 minutes ago when I checked. They're likely still there, but they're higher despite a cut at Citigroup. The price target went to $220 from $230. It's still around a 5% move to the upside from where it closed on Friday. Kept a neutral rating on the shares. And this analyst says that he does not see any risk to the company's guidance, but he does expect the guidance and the upside that may happen to actually be constrained. Right? And that's because the firm says Salesforce growth trends, they remain pressured because of the macro environment. But they also see a renewal risk as we head into 2024. So there's more risk that companies may or may not actually renew their subscriptions, less risk on the near term. But there's also expectations for the margin expansion that everyone has had for this company over the year. He feels like those have largely played out, especially as the company is up, about 55% year to date.
Kind of similar to the other note for CrowdStrike, right?
Except it's just moving in a different direction.
Yeah, exactly. So a little bit more of a statement with the full downgrade for CrowdStrike. This is kind of hedging the expectations, but both fairly negative sentiment to start off the week ahead of both these reports. So not exactly the best setup here. Thanks, Renita. Appreciate it. Good, important, though, as we can't forget some of the late tech companies that are reporting this week. Salesforce going to be big. CrowdStrike, too. No, it's not very positive despite a firm start this morning for futures. When we come back, we'll talk about what we learned last week from the Fed chair, how that fits into the economic outlook, for which we'll get a big update this week. Everything you're looking for in the economy, inflation, wages, growth, it's all coming the next fact that there is a 2% target, and that's not. Market's been looking for cuts and keeps pushing that out. Does that give him some credit still as being a bit aggressive?
I think I'm just reading his mind here, and I don't know the man, but I'm pretty sure that Powell believes there's some kind of expectations channel where somehow if the stock market gets too optimistic, that will inflame everybody's inflation expectations. All of a sudden, you'll be willing to pay more for eggs just because your Nvidia went up. I mean, it's a crackpot theory, but I think he actually believes it. So he's going to do everything he can within the consensus that he can develop to keep expectations under control. But you know, you can look at the yield curve like you were doing in your prior segment. You can look at the money market curve. You can look at the Fed funds futures. And yeah, they're pushing the cuts out, but the first cut by consensus is now going to come between the May and the June FOMC meeting. There is no market consensus for even one more hike, right? So it's not like, so the market's kind of already seeing through the Fed. The market thinks this cycle is done. I think the market's right. I think the only place the market's wrong is in thinking that the cuts won't come until mid-year. I think they'll come in the first quarter because inflation isn't just moderating. We don't just have progress. It is collapsing. By the first quarter, it'll have minus signs in front of it. We're going to have outright deflation, Oliver.
Right now, the last couple readings seem to be plateauing. And I hear a lot of folks talk about the calendar effects that will be coming, where the numbers won't be as easy to show big disinflation like they were off the highs. You don't think that's going to keep numbers at least around 3 to 3.5%?
No, it's just not true. You know, I understand that the year-ago comparables were absolutely horrible, you know, especially the June comparable. But you know what the July comparable was? You know, it was 0. So, you know, we've already hit the tough comparables, and inflation is collapsing. Goods inflation, which is 48% of the CPI basket, for the past 2 months has been in outright deflation. And not just on a year-over-year basis, on an instantaneous basis. The money supply is in its first year-over-year contraction in the modern history of the data since 1959. We are heading into deflation, and we still have a chance in this market to celebrate our great victory over inflation without having caused a hard landing. Oh my God, we're geniuses. But trust me, by the end of the year, by January, by February, these deflation numbers are going to start to come in, and people are going to absolutely panic. And you're going to hear all these inflation gurus like Larry Summers say, oh my God, the last time there was a serious deflation was 1931. Okay, well, yeah, the Depression caused deflation. Deflation didn't cause the Depression. So it just could be another bogus panic in the many that we've had since the pandemic about all these things that are supposed to cause a recession that never do. We need to welcome this deflation because we had so much inflation. We need to have a little deflation to fix it. This is going to be great. It's going to be scary, but it's going to be great.
What do you think type of growth we'll be able to maintain in the environment you're describing, Don? Because right now, over the last month, we've seen GDP expectations getting ratcheted higher and some inflation expectations moving with that. The bond market has been repricing. So over the last 30 days, literally the opposite of what you're describing has been happening. When does that tilt in the other way? What do you see as being the catalyst to go your way?
It's one thing and one thing only. It's the contraction in the money supply. It was the expansion in the money supply that caused disinflation. Inflation and growth are not the same thing at all. When the money supply grows suddenly, like it did after the pandemic, when Congress spent $6 trillion within a single year, just deposit it directly in your checking account, your savings account, your money market fund, that increases the money supply. It was the largest increase since the years when Paul Volcker was Fed chair. And so we got that kind of inflation. But then the stimulus bill stopped, and the money supply stopped growing. Then the Fed started tightening, so the money supply is now contracting, especially after Silicon Valley Bank, where the banking system is hardly able to generate any new loans and leases, which is where the money supply comes from, right? So the money supply is a crystal ball that tells you where inflation is going. It told us 3 years ago that we were going to have a short, sharp burst of inflation. We had it. It is telling us now that we will have deflation, and we're going to get it. That has absolutely nothing to do with growth. The growth, now, investors will think it has something to do with growth, So as all these, wonderful growth statistics flow in for this quarter that you're talking about, we'll probably have the blow off top in this wonderful bull market that began last October. But that'll just be temporary. Then there'll be a horrible correction as everybody starts losing their mind about deflation. But then the growth will just mysteriously continue. There'll just be positive payrolls every month. GDP will just roll in at, 2% to 4%. It'll be just like the same kind of amazing sort of rolling thunder miracle that we've had since the terrible bottom of the pandemic depression 3 years ago. And this whole inflation, deflation thing, the inflation was just a scare. It's passed through. The deflation will just be a scare. It'll pass through. These create very big opportunities for alert investors.
Okay. So, Don, the alert investors, if we're trying to navigate this outlook, which you're saying is going to basically do a 180 from the last couple months here, go the other way, is that because if to your point, there's going to be big disinflation numbers. A lot of people will think that is highly recessionary. You say the stock market corrects. Do you wait then and try and buy that dip when it drops, or do you short the market in anticipation of it? What's the trade?
Well, whether you just it depends who you are, right? I mean, there are a lot of investors who probably just shouldn't even listen to this. You just buy and hold forever and then cash out when you retire. But, if you're an aggressive trader, I think you want to be either selling or beginning to lay out your shorts right now. I think we are headed toward a blow off top. When somebody like me makes a forecast like that, I can't guarantee you that we haven't already seen the top. I mean, we did have a 5% correction from last month's highs. Maybe that was it. I don't think so. But you can be an alert investor without being a hyperthyroid investor. You don't have to call the exact top. This is the time when you should be just getting a few sell tickets out there. And then when you see the momentum start to go my way, when you see the headlines start to go my way, when you have Larry Summers as your guest on this show, and he says, oh my God, the inflation thing that I've been talking about all these years, oh, no. You have to start worrying about deflation. That will be your signal to sell, to short, and then 20% later on the S&P, you can buy them again.
Okay. So, and picking on Summers because he's been very anti-inflation. So your point is that when he goes the other way to realize it's actually the opposite, then we'll know that the tide is changing for sentiment.
Yeah, I think it's always worth it to know who your sort of bellwether is. Like who's your guru for this market cycle that people take their cues from.
Fair enough. All right. Hey, Don, thanks for the convo. Appreciate it.
Thank you.
All right. Definitely disinflationary outlook and a cautionary one, at least for the short term until there's an opportunity when the panic arrives around a big disinflation moment. All right, thanks, Don Luskin, Chief Investment Officer at Trend Macro, looking to lay out some shorts now in anticipation of weakness to come as stocks reprice, looking for basically a big 180 from the last couple of months here, where expectations for growth have only gone higher. That's the highlight for this week. It's economic data.
All right. 1 minute to open. I usually would like to watch barbecue when we open, just because there's not really a market, so very curious on what happens with it. SPY looks like it's up 0.5%. Got GNS up 32%. GME's up a bit. HE is up 32%. AMC's down like 4%. Liquor's up 35%. Let's see what we got. RAD is down 4% pre-market. Here we go. My computer behind again. Well, it looks about on now. There's the bell. This barbecue's down to 1.5%. Cool. Down 5% on barbecue. You hold that level. Buy. Did open up that paper strangle. So I don't know on the upside, like, not pre-market high or anything with the highs, so it'd be hard to know where to cut the calls. He's down 3.2. And fast is up 19%. I'd like to see barbecue hold 20 cents. Otherwise, we might just be consolidating here. Not just wick below there. It's a real reversal, not just a bottoming. 66. Barbecue's down 7.7. Eyes ripping there. Oh, we might be just getting to the top of the channel. Like 443, 35, somewhere up there. Continuing that rally from Friday. Down 8, buys up 0.65. Those not fill. So those didn't work. What? The yes seems so loud. Yeah, I guess these didn't fill for some reason. Market orders try to open. What you need. Fill an order there. Okay. Average down 5. GNS holding 32. They got wicked up there to 2.2 for a moment. I think that too will be resistance. If we get validating some pulling back. Hawaiian up 48 now. Breaking the highs. BDC is up 86%. Tickers come down some. SPY's just been ripping. 0.72% now. Yay, Carvana, 4% up. GME is up 2.5. Maybe when GNE hits this resistance, the buy will be at its top. Been open for 5 minutes. Only have 9 likes. Thank you guys for your 9. I hope you had a good weekend. Alright, GNS breaking that high. Breaking $2. I think it wants to. A lot of volume this morning. Okay. I have to resubmit it, I guess, once the market opens. I don't know. I'm broken. I'll close it though, because that was a failed attempt. Barbecue bounce back up there. 0.6. .4 on GME. It's got earnings next Wednesday. Barbecue down 5, so might just be flattening out here, not start a reversal. Would be a shame, given that I guess the catalyst and whatever is coming up September sometime, so we might not get a rally before then. I don't know. Below this support. Hawaiian Electric's halted the upside. Wow. Contracts really up 1,800%. Jeez. Bought the dip on that one, I guess. Oh yeah, because it dumped on the dividend cut. We had one day there to buy calls. GNS above the $2. %41 on it. Barbecue down 4. bit. If you get a bounce on low of the day. Barbecue down 5. Good to see it flattening out, but the momentum hasn't quite pushed the upside yet. Today's the day for barbecue, week at least. Wines resumes up 48% now. Rite Aid's up 5. Yes, Rite Aid. 0.8. Didn't seem like anything over the weekend was denying what was going on with Rite Aid. That was a false rumor or something. Yep, 4.3. I just consolidating up here. AMC is down 2.7. VNT is up 3. Fourth there. SPY's rallying again. Barbecue down 5. Glad I closed GNS for barbecue. Hawaiian Electric's halted again. Dish is up 3. Halted down now. Yes. GNS up 42%. I want to keep going. It's above VWAP. Yeah, it's starting to get kind of poppy. Adds up 9%. Yeah, I think it will, TJ. Rallying up there some more. Up 0.7%, getting back up to its highs. GNS climbing up 45% there. Just getting up to our resistance line. Got 2 there. Got a horizontal resistance around 18. And that diagonal one here. I want to get some puts for earnings for GME. This would be the time. Free up some capital. Got 50% there on GNS. New high of the day. Barbecue still down 5, 20, 25. Good Money Monday to you too, Christopher. We had a good weekend. Spies coming down here. New low of the day there on SPY. And look, what do you know? Right when GME hit that high resistance. The high for the SPY. Buy puts when GME hits its high. This is the way. GNS up 50. I got into some puts. On the little retrace there. Finding some resistance at the low of the day. GNS, man. Oh, there's a breakout on GNS. A little bit, yep, 52%. Did all that just get bought up? That candle. The 5-minute candle is gonna go from red to green. Almost 5% on GME. Hit 1801. Hawaiian Electric is resumed. Up 37% still. $55% on GNS. Moving up 2290. Next level up there's 2820. I bounced all the way back up to VWAP. Chopping still. Barbecue 5 down 3%. Your GME puts? Earnings? GNS coming back down to VWAP. Liquor's coming back up. It's above VWAP now. Yeah, I don't know which way earnings could go, but if I were to go bearish on it, this is when I'd probably get inputs for it. Yeah, IV elevated, earnings elevation. Wish the strangle worked on the paper account. Make any sense why that wouldn't get filled. Market order. Or open. Out of those. Oh, stupid. Chop. Gotta wait. Wait for the highs or the lows. I think we were gonna come and fill in some of this gap first, but barbecue up a little bit. It's only down 2% now. GNS came back to that VWAP level 2140. Seven and a quarter % on RAD. It's you. Up around 30-minute chart. Holding that VWAP. What are you referring to specifically? Morning, Jay. Happy Money Monday to you. Barbecue down 5%. I want to see barbecue start moving up, or I'm not gonna have much patience with it. When is the 12th. 12th of September. Last few days of rise and big dip. Like the 25th this rise and then that big dip. But then we closed up at the highs again. Beat that cup. And the 24th we just sold off at open. The 23rd we just rallied out of open all day. %, on rad. GNS coming down below VWAP out of that $2. Now's the time to maybe open up a strangle. Look for some nice tight chop. %, on rad. Where I closed out here. Okay, open up a strangle. Could wait. I mean, who knows how long we'll chop here, but there's 22% on rad. GNS below $2. Just barely. Barbecue hanging out, down 5. I don't think we have hardly any data today. %, on rad there. 50. AMC or barbecue down 3.7. AMC still flushing, down 8.2. Wow. The ape's been converted. The splits happened. Still hitting. Is up 6.6. Congratulations. Oh, I didn't even. Yeah, it's not updating my chat, guys. Got an early with 440s, Bubba. All right. Being pumped by Discord group. I mean, you expect Rad's gonna have a bounce from that huge sell-off, based on speculation. Looking for 444 the top for some drop off these calls. This resistance right here. AMC. I don't know what's going on with it. gonna have a big bounce at some point. It's just how low is gonna go first, I guess. Crazy. Para flasherinos. Un momento, por favor. G bouncing back up to VWAP. Off has slowly subsided. Only been 2 months. I still have it sometimes, like when I laugh. That kind of like tickles my throat or whatever, gets me to cough. And you mentioning it makes me think about it, and that makes me want to cough. When after I eat or drink, still kind of have it, I think. But yeah, last day or so, it's maybe showing some signs of improvement. I guess it slowly did, like the last weeks. It's true, there's not as much mucus. That subsided also last night. Yeah, what's up with 3M earnings? Settlement for earplug claims? Some more spy choppy. That's what's nice about the strangle. You don't have to. You're doing this chop. It's gonna break out one way or the other at some point, and strangle doesn't loses some value, but not really a whole lot at all. Yep, yeah, it's way better. GME just holding right at that resistance. GNS coming down now. It's below VWAP. It's below $2. I might buy the dip on a gap fill here this week on GNS, but I'm a little, shoot, my line go. A little hesitant just with that ex divvy day coming up. Might sell off. Don't know. Sell off before then. Maybe it'll rally. I'm not sure what's gonna happen. JH, you buying the dip on Mullen? GME, little red candle to VWAP. This is some ugly morning chop. It's kind of right in the middle of the range. We're getting a MACD crossover on the hourly. Of green over the 9. We could still, yeah, get a little pump to the top of the channel. See what happens there at resistance. That most likely will happen before the drop, because the momentum's up. I think, yeah, last we touched was the bottom of the channel, so time to punch back up to the top. This is almost like market. How flat the SPY is getting. Yeah, the strangle's decaying a little bit. I could add to it, I guess. AMC down 7.5. TV down 7.7. Goes down 5. Barbecue's down 5. Blackberry's down 3.5. They had that good news on Friday. Takeover news, right? Veritas Capital. Let's get to the top of the range here. Good breakout. bit. Delta jacking up again. And still in its range. Tupperware down 2%. Still kind of holding that support. High. Make a new high here. High in the day. Maybe. No. I still stuck. Last 1 minute of the video put media. What's it about? 5.3. Arian? Okay.
Let's get to it. Continues to say 2% is and remains our inflation target. If it goes a little bit quiet on that, I think that.
Do you ultimately think they will wait to 2, or do you think it's?
Well, I mean, in the press conference in July, Powell said we'll probably be cutting before we get to 2. Right. Right. I mean, just because of the math of how what's restrictive, what's not. But what we're looking at right now is a possibility that headline inflation will head back up. Yeah.
and core inflation may not come down quickly enough. And it all comes down to services and wages. That's where the battle is being fought right now.
And housing. Also, I mean, housing is not or is part of core.
So, you know, there's a real issue as to whether we've broken the housing market. When you go
Prices are going up. Rents are going up.
So when you go from record low mortgage rates to levels that we haven't seen for almost 20 years, you destroy both the demand and supply.
Right.
Right. And that's the irony. Yeah. Is that supply has come down and demand has come down as well. That is the way you destroy a housing market. And we've got to be really careful because the housing market is central to the economy.
Bye, there it is, new high. See if I actually get a move here. No. Not yet. One of those chop days. Until you break out. Day traders have to be patient today. Can't get all their day trading done in the first hour and a half. Back their tea times. Nope, still chop. We suck again. MC above VWAP, moving up a little bit here. Got a gap to fill at 1240. 5%. Barbecue's still hanging on 5. He's up 5. Back to resistant. Hana's up 8. Okay. What do you think, Jay? Go down 0.4. Breaking below a little bit here. Still on this barcode. No resistance. I think 444 here around this line. Only been open an hour. Look at this. 0.6% down on barbecue. That's gonna, yeah. I consolidating at the high of the day. Maybe about to break out. Oh, SPY not gone. No. Oh. Maybe. GNS 2010 up 37%. Hawaiian 37% as well. MCOM up today 30%. Fast 27%. SPY wants to come back down to VWAP now. Tesla's up 1%. Bull flag still on SPY. Can make up her mind. US Dallas Fed Manufacturing Business Index. August actual was negative 17.2 versus negative 20. Previous, the estimates were negative 19. Came out 7 minutes ago. US Treasuries par gains before auctions. 2-year yield near 5.09%. Evergrande unit all bonds trading continues to be suspended. Evergrande's down like 90-something% at open. China's market, I think. We just end at the highs. Liquor's still up 27. Barbecue hanging out, barcoding. US dollar rises to 146.685. Japanese yen, highest since November 2022. Micron Technology shares rise 3.3%. Intel up 1% after US Commerce Chief says discussed companies in Chinese meetings. Intel and Micron. ECB's Nagel says ECB may need to be at rate plateau for a while when they're ugly chop on SPY today. We've done straddles instead of strangles. Sold premium. 40. Thank you guys for your likes. We're at 16 thumbs up on the day. Wait for SPY to make its move. GNS bouncing back up to be up.
A good kind of representation of the technical setup that Rick's talking about, because you've got this uptrend that's holding, because they have had some decent quarters, but it's just still a tough racket to be in generally right now. All right, let's talk e-commerce. The old Chinese Pinduoduo and now PDD Holdings ownership. How are we looking here, Rick?
Well, actually, we look a lot like our previous chart, a triangular pattern with the two trend lines beginning with the lows of the year and the highs of the year. So you can see it looks like a very similar shape here, but there's some important differences. A very important difference is that we are more close to the middle of the triangle rather than the lower edge. Another big difference is that we're above our 3 moving averages. Now we're starting to fade a little bit today. It's where I think our 21-day EMA comes in at 80.18. We're at about 80.61 right now. So we're pretty close to breaking below it, but we are still hanging on. So it'll be really interesting to see if that is able to hold on into the close, because our moving averages look rather sideways right now. Maybe perhaps our short-term and medium-term are starting to trend upward, but our long-term looks like it hasn't really done too much over the past couple months, over then move sideways to marginally down, actually. So, like I said as well, very similar to our last chart here. And we can see the RSI is also doing something important today. It's also crossing above that 50 midline there that separates bearish momentum from bullish momentum. So the fact that we're pushing above our price resistance and the RSI is breaking to the positive side, that's a more positive sign for the bulls as well here, potentially here. Now, in terms of support and resistance, the green dash line, 75.50, that was a frequent stopping point for price. That's where we opened up after a gap downward and also bottomed out a couple times since then here. So that would be one area to watch. And our 252-day EMA comes in just below that, near 74.88. To the upside, we've got our trend line, our upper trend line there, near about 88. And then the 90 level was another one of these points where price frequently bottomed out, and then we had a break downward. And then that's about where we topped out recently. So 75.50 to the downside, 90 to the upside are the big points to watch. And one last thing to point out, too, I think we could be seeing a potential head and shoulders type pattern on the chart. You see those circles that I drew? There's one circle for each shoulder and one for the head. This is typically a more bearish pattern here. So it'll be interesting to see if it plays out, as it typically does, and I'm not saying it will, that's not a guarantee or anything, or if it fails and we continue the move upward, Oliver.
Yeah, on the margin, that RSI, a little better than the Best Buy chart. So I like it as two examples of what may look very similar, having some important differences, where in that short term, a little bit more momentum here for PDD. Then again, we have strength in Chinese stocks, and so with the exposure to China here in that e-commerce business, a little extra boost perhaps this morning. How's the analyst community looking on this right now, Renita?
That's consistent. Huge e-commerce giant expected to report better than expected earnings, and it did so in the last quarter as well. Also, one of the companies in PDD Holdings portfolio recently reported it was a payment platform, and it reported the better than expected revenues for the past 6 months that rose over last year over year. So analysts are looking for an adjusted earnings of $1.12 on revenue of $6.14 billion. Those both would be above last quarter, and it would break out. Hopefully, the analysts are hoping that, or the company is hoping that it would come in better than expected this quarter, just as they did last quarter. This stock, it is down year to date, close to around 2%, but for the past 12 months, it's actually up around 39%.
We're up 4.5 now.
There it is. So we got a nice little lift-off going here ahead of some of the e-commerce strength that's expected from the company. Thanks, Renita and Rick, for the setup here. A couple of retailers set to report. When we come back, we'll get the latest on Hawaiian Electric's debacle around fires. Shares are getting killed right now, but trying to bounce back. Volatile couple weeks. Up today, but down a ton. We'll get the latest.
yeah, they put out a fire hours before, or they started a fire hours before. They didn't start it. One of their power lines fell and started a fire. Firemen came and put it out 100% extinguished based on firemen's reports. And the power was still off. And then a couple hours later, another fire started. So that's what we're saying. They have reports from the firemen saying that they put out the fire that was caused by the downed wire, and that the power had been off for hours before that other fire, the main fire, even started. So maybe that lawsuit will get dropped. I don't know. Probably not. Probably take more than that time. What's DWs? Direct energy weapon? Confirmed soon. Hurricanes and pricing. You don't usually get a market reaction to a hurricane, like an overall market. That's very, very unusual. I don't know if I've ever seen. Individual stocks, yeah. I don't know how bad it is, of course. I think Katrina, maybe we saw some maybe a little market reaction. I don't know though. But Adalia, I don't think it's gonna be. Yeah. We're projecting category 2, maybe a 3 by the time it lands, and it's further, most likely gonna be further north than Tampa. So there wasn't a market reaction for Ian, and that was almost a Cat 5 when it landed, and super devastating. So unless if this thing whips up to a 5 and takes a gnarly right turn, it's probably going to be, and even if it does that, it's still probably going to get a market reaction again because Ian didn't. It is hitting during the super harvest moon and a king tide. That is true. Sharks with lasers. Pew pew pew. This is when the king tides are, though. It's during, almost always during hurricane season. So that's not anything new. And the moon cycles, that oftentimes goes on with hurricanes also, so valid points, but it's not, or presenting it in an extravagant way. It could seem extravagant when it's not. So far. I mean, it could get intense. Good thing is it sped up from, it's going like 2 miles an hour, is creeping. So I think that's pretty normal for them to speed up though. It's up to like 7 miles an hour now. So that's already, I think, faster than Ian. I think Ian at one point was going like 4 maybe when it hit. That thing was just creeping along, just devastation. Barbecue, bottom of the barcode, 2001 down 6%. I still chopping around. Yeah, I'm just getting time decayed on these contracts. You can actually see it now.
Level, the 10-year, came back a little bit. It's at 4.22 right now. So, it's really all about rates kind of driving the equities market.
What do you think, Nick? What excites you about this week?
Well, we heard an interesting fact this morning, Oliver. There has not yet been 2 back-to-back up days in August. So, Joe, I'm stealing a quote from a buddy here internally, but I thought we were talking about the internal choppiness and just
this would be if we go up today, right? If we go up today, that'd be 2 back to back.
This would be right. So pretty interesting, right? Given the setup here with Powell and the way that Friday went, really chopping around. So today pretty solidly up across most sectors.
What do they call these?
It's pretty interesting that the financials, and to your point, Oliver, the Russell's doing so well today because. The Fed and central bankers around the world, they told us rates are going to be high for a long time, and they're not going to be afraid to go higher. So
I don't know what they're talking about.
I think if you would have sort of blindfolded me and said, "Hey, what stocks are going to react to this negatively?" You would think some of these banks, and that would have a tougher time.
Bouncing off the lows.
A higher for longer environment.
Oh, it's
good news
range.
is, to Joe's point, the curve is normalizing a bit. We're not as inverted as we were, but there is still a really steep inversion, and we're not in a normal interest rate environment. So I agree. It's definitely the rates that are driving markets. I just think that it's a little bit interesting today to see so much strength across all sectors. We do have a good slate of earnings this week too, right? There's a bunch of retailers. I'm personally looking forward to Lulu earnings to see how they fare, kind of the high end direct-to-consumer retailer versus some of what we've seen from some of the big box folks. So I think that's an interesting setup. And then obviously you get PCE that right in front of the jobless or the non-farm payrolls. So pretty good setup. And I think consumer confidence will be interesting too with some more of these retail earnings coming out. And that's I think Tuesday morning.
Yeah,
so it's interesting.
New loan SPY
starting
to fill that gap a little bit.
Sleepy going into a holiday.
Maybe
that would be the case. Maybe that's why we're going to drift
south side first
in a bit. But I think there's
or only. I don't know. Maybe we'll come back up.
Pretty much telegraphing that even if they slow down, they're going to be up here for quite a while until inflation comes down.
For sure. 2-year yield continuing last week's move. That to me is pretty interesting here because otherwise bonds are pretty calm. Dollar's pretty calm today, but that 2-year at 5%. On the little bit of it's not even a tick, it's a pip higher from Friday. So the 2-year's not stopping, Joe.
No, and that's, like I said, I think that's an indicator to kind of keep an eye on, just because I think what it's saying is that the bond market is really starting to believe the Fed now that higher for longer is the case, and that they're going to get their cues from what they hear. Now, one thing going back to last Friday, I thought it was interesting. We got to talk about this idea at Jackson Hole where, Powell's speech might have leaned a little bit hawkish, but at the same time, I think for the most part, it kind of shot down the middle. It was Lagarde's speech that I found really interesting because she talked a little bit more kind of about the macro dynamics and what to expect longer term and how all these different things in terms of like EVs and how that's going to factor into the economy. Powell is very kind of short term in terms of, hey, what do we expect going forward? But I think Lagarde was quite a bit more hawkish, and I think she's got a lot more to do with the ECB than we have here on this side of the pond. I think we're in a better position.
Yeah, true. I think at this point we've seen some of the fruits of our labor, right, with the inflation coming down.
GME down a
much
little
lower
bit with
number to
SPY,
deal
below
with,
VWAP now.
Still got to deal with it. To your staying elevated, seems like, to your point, market's
He's just
getting used to
following
that
its
higher for longer concept.
commander.
Going to be a busy week. Thanks for the setup, guys. Nick Diderakis, Joe Mazzola. Trading 360 with Nicole Pedalides is coming up next. Thanks for joining me for MTL. I'll see you this afternoon, 2 p.m. Central Time.
I think downside, the gap fill at 440. There. Probably drop off what's there. Get back up at some point today, back to VWAP, if that all plays out. Calls are very choppy, very slow. Day before week of some market moving data, so August, which times are slow market. $20.01 down 6. Thought barbecue would be a little more bullish. Bounce there on SPY. Barbecue, a flushy candle, $19.99. $6. o'clock. Got 15 likes on the day. Thank you guys, appreciate it. To my foots there. For Jenny, she's coming. Caught Jenny this morning. Pre-market.
Which has been under some
Nailed
pressure
it.
for the last several years, as that was somewhat of a disappointing IPO, of course, in the Chinese market. But we are seeing at least XPeng today surging on the deal that they will acquire ride-hailing apps DiDi Global's smart vehicle unit specifically. Now, the deal, which is worth up to $744 million when converting into U.S. dollars, will see DiDi receive around 3.25% stake in XPeng, according to the company filings on Monday. Now, XPeng did say it plans to launch a new EV brand now in 2024.
Look like you
as
got some
part of
pain
a
behind
strategic
those eyes.
partnership with DiDi. They did say the brand is currently being developed under the project name Mona, and it includes plans to launch a smart class EV model next year. They did say that DiDi will be providing support from their mobility ecosystem with projected access to their national mobility market. So all in all, a win for both of these companies. Both of these names have been absolutely crushed over the past 2 weeks, but XPeng feeling the hit a little bit more, as we have seen some of these Chinese EV names to hit with some selling pressure, but at least getting a lift today, and we are seeing some collective strength in a lot of these EV names. Tesla up about 1/10%, but hey, these names closed out last week lower, so nice to see them start this week a little bit higher.
Right. Thank you so much, Jenny Horn.
Barbecue.
Great to see you, markets correspondent. Really appreciate
stupid.
it. All right, let's get some insights in the news shaping the markets, and for that we welcome
We'll
in
flush
Chris
on barbecue
Versace
down
with us, Chief Investment
8
Officer
now.
at Tematica Research.
I'm
Thank you
bullish now.
for being with us. What do you think are some of the themes? I mean, I could easily ask you about Jay Powell last week, and I will. However, what's on your mind now Monday morning?
Monday morning, it's, we got a slow week ahead of us filled with, a lot of economic data, but thinning trading volumes ahead of the Labor Day weekend, and we're heading into what could be, or has historically been, one of the most challenging months of the year for stocks, September. So we want to really try and pick our spots here. We don't want to rush into anything with what we're doing with as an investor or managing a portfolio. And I think really what we learn in terms of the data this week will really set us up for what the Fed is likely to do, either at its September meeting or more likely its November meeting.
Well, that's the whole thing, right? I mean, I know we're waiting on GDP and jobs and PCE, and looking at the services side within the PCE, because the PCE is really the Fed's favorite inflation indicator. So those are some of the prints that we've been waiting on, and the Fed will have to decide at that point. More likely to see November, though, than September at this point, right?
That's the way it seems, right? So if we look at the CME Fed Watch tool, we've seen some movement after last Friday's comments by Powell, which I would say were, if you've been paying attention, there weren't really any surprises there. But I think the fact that he reiterated 2% is the Fed's target. And again, if you look at the data, the economy has been stronger than expected. The Atlanta Fed GDP model got revised up to 5.9% last week, way above trend. But Nicole, we need to remember that's a rolling forecast, which is why this week's data is so important. And you rattled off several of them, but we've also got, the employment report, we've got the ADP employment report, what it will show on wages, and then at the end of the week we have the dueling manufacturing PMI reports from both ISM as well as S&P Global. So it's probably the biggest week we've had in several for all this data.
What about all the earnings that came in? Obviously, NVIDIA, everybody still was talking about that, even this morning. Just so surprised at back-to-back quarters, the growth that was even way ahead of those whisper numbers, the blowout, quarters, the guidance, just how incredible it is, and whether or not the rest of tech catches up or what's going on. In the meantime, how did you feel about earnings season, and what did it tell you about a lot of these companies here in the U.S.?
So overall, we've been kind of really paying attention to what the aggregate guidance is for the second half of the year. So, when we were coming into the June quarter earnings season, the S&P 500 was trading, north of 21 times forward earnings. So we had said, in order to see a sustained move higher in the S&P 500, and therefore the vast majority of the market, we needed to see expectations for the second half of the year move significantly higher. Have we seen that? And so far, the answer is we have not. So I think that kind of keeps us in a trading range of sorts. Now, as we move past this week, we're going to go into this mini wave of investor conferences. So we'll be listening for potential upside to the guidance that we got. Was it too conservative or not? We'll also be paying attention to what our company's seeing. Is the economy slowing, or is the Atlanta Fed number, is it really what's happening out there? What other headwinds are emerging? Are inflation pressures not receding? Wage pressure still there, and what about the dollar? So it's going to be a lot over the next 2-3 weeks. And what about some of the prints that we're seeing right now? You're seeing a stronger U.S. dollar, still above that 104 level. I was mentioning the 2-year bond yield above 5%, right near 2-month highs, basically. What do you think about some of these things that are occurring right now? Well, I think when we kind of step back a little bit, the message it's telling us is that, the Fed is, maybe they're going to raise again, maybe not. But we do know that rates will be higher for longer. And I think the market has started to really wrap its head around that over the last month. That's, we've seen that with the 10-year Treasury yield. We've seen the market sell off in response to that, particularly smaller cap stocks. Right. So I think the question now is, is the Fed going to wind up cutting rates first at the middle of 2024 or not? And there were comments out over the weekend that, depending on what the data is, some at the Fed may have to rethink that expectation. Right. So there's a lot of moving parts here. And, I love when people talk about soft landing or no recession and cuts from the Fed, and it certainly makes me feel like, oh, the market's going to go flying, it's going to be great. But I just feel like, is that real? There's got to be volatility. Maybe there'll be a Santa Claus rally. I just don't think anything's ever quite so easy, but we'll have to wait and see. What would you tell investors? I know you're watching inflation as well. What do you tell investors where to put their money to work so they maybe either protect their principal and or make some money? So we've been very fortunate, right? At the Action Alerts Plus portfolio that I run, we leaned into infrastructure spending at the right time. United Rentals, Vulcan Materials, and a bunch of others. So we're taking a more cautious stance right now. What I would say is build your shopping list. What are the companies that you really want to own for the next 12 months? If the market comes in a little bit, and there is the possibility that that happens, that's when you want to start nibbling away. Don't be in a rush to buy anything. Patiently build your book. Is there anything that you like more than others, whether it's sectors or, is there anything that... So I'm not a sector guy. I'm more of a thematic guy. And you do a lot of charting and everything too, right? Well,
we use the intersection of fundamentals, thematics, and technicals. Yes.
Okay, so tell me.
So, the areas that we like right now, we've missed on charge point, right? So EV charging. There was a great story out today about how 23 countries have passed a great tipping point for EVs, which is about 5% of new sales are EVs. To me, that speaks to the longer-term pain point. You can't sell EVs if you have no place to charge them.
Right.
Kind of a chicken and the egg.
Sure.
So I continue to like that group, although, small cap stocks are getting hit, like we talked about.
Yeah.
So I think, again, buy a little bit, nibble away at it, put it away, be patient.
Yeah, you talked about ChargePoint. I mean, we've had Blink charging on. We've had the CEO and the team on a few times. Superchargers from Tesla has been a big story in the news. EV, we had the XPeng and DD today. I mean, there's been a lot of interesting news surrounding the world of EVs. We'll continue to follow that too. Thank you so much, Chris. I'm glad you were here today. Kicking off a new week, a busy week ahead. Chris Versace of Tematica Research. Plenty more to come here on Trading 360. The big three stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals. Tom O'Brien takes us to the trades for Emerson Electric, TJX, and Eaton. That's coming up here on Trading 360. We'll be right back.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
And kind of scaling into puts little by little as we come down and I get them on bounces. Just building a position because I haven't closed anything yet. Still have my calls too, which I might average into at some point if we do go some reversal. GNS back to VWAP there. Barbecue down 7.5. Yeah, this is more like consolidation than a reversal. Fortunate. HE, Hawaiian, coming down a little bit.
Going from Shanghai to Tampa were $14,500 per container. Well, guess what? Last week they were $3,000. So now that's $3,000 spot rate, not for like an Amazon or a Walmart. So to me, inflation is already down. It has not coming down. It's down. And I think that's going to flow through. And I think, yeah, we can go into consolidation, but I think first we're going to go try to attack these highs from, a few weeks ago. And I think we have a consolidation happening. And I think that for all of us, I think we got inflation under wraps right now.
All right. We'll see, and we'll have the PCE, and we'll see what the Fed does. But in the meantime, if that's the case, that could be some good news. Tell me about Emerson Electric. That's your first one. It's at 98 and change today, Tom.
So you have Emerson Electric, monster company. The name is not sufficient as to what they actually do. They're a huge government contractor. So you get Emerson Electric trading at 98.51. You could buy it here. You put a stop at 95, and I'm looking for that to go to the swing. The high out there is 105. It's been on a nice uptrend, had some really great volume on Friday. It was coming into another swing from their last earnings report, and it just looks to me that, if I'm right on the market, meaning that it wants to come back up to those highs, well, Emerson's going to try to go after that 105. Contract-wise, their gross is still going up big time.
Right. All right. So whether the trend is up and continues.
Liquor above VWAP.
You know what? Ben's going to take a look at the charts for us. Good morning, Ben. Take a look at Emerson Electric, please.
Good morning, Nicole. Good morning, Tom. The trend is up, to say the least here. I've got an hourly candle chart here behind me, Nicole, and you can see it's a pretty well-defined pattern, right? We're talking bottom left to top right. Roughly about $20 worth of upside momentum as we've rallied from 76 up to 96. And I wanted to dive into this move to the upside and identify some of the areas of consolidation and establish what the bulls are looking for in terms of continuation as we look at this chart. I said 96 to 76. It's actually from 98 in this instance. Here you can see all the way down to this $76, $77 level that we were trading in. We're talking about as we go. And look at the chart here. This was the beginning of, we're talking about, well, last month here, ultimately, beginning of, over the last few weeks here to the upside. Taking a look here, Nicole, as we look at some of the areas of consolidation that have established themselves on the way up, because this is significant, right? The areas where the market pauses and regains composure, and also you can see that there's been limited retracement as we've established a staircase type pattern to the upside. We are, as you can see, currently trying to break out of a range that we were in around the $96 level, so attempting a vertical phase out of balance to the upside in line with the patterns we've seen play out here. We go vertical into that horizontal phase, so the bulls are looking for a new area of consolidation to form above this most recent area around 96. Now let's take a step back and look at the daily time frame here, a very similar pattern, right? We've got a bottom left corner to top right. Just mentioned here, Tom was talking about that 105, 106 level. That's the highs that we saw again back when we're talking the summer, the spring of 2021. And you can see how we've kind of been in this wave pattern since posting those highs at the lower extreme around 75, upper extreme again being around 106. So the bulls are looking for a breakout here through that 105 level Tom just mentioned. Checking in on where we are on the 50 to 200-day moving average, you can see holding above both those key levels. I've got my eye on RSI, supportive of the move up that we're seeing here. Basically multiple time frames supporting to this bullish narrative that Tom was just pointing to. I think the technicals are very supportive of it, Nicole.
All right, so look, you could just take that last sentence, the technicals are supportive. And you see those gap higher, and you see it from the 70s to the mid-90s. And Tom, I know you're watching that high over 100. Great charts, Ben. Tom, your final thoughts here.
What's sweet about Emerson Electric also is that a lot of folks actually don't know about it, and they have a huge amount of government contracts. So those government contracts are a long-term deal. They're a huge defense contractor, and that's always nice. That's the bottom line. So technically it's set up, fundamentally it's still growing. So, it's not growing by a huge amount. It's not like a tech stock, but it's steady,
That's 25%.
on top line and the bottom line. So I like the equity. I've liked it for a long time.
I like that you said what's sweet about Emerson Electric. I don't know that we hear that phrase too often. Okay, let's get to, I like that, it's positive. TJX Companies, the parent of TJ Maxx and Marshalls, and this one was more favorable than Target at one point in the last couple of weeks.
BFS looks like it's about to break out.
And so the big picture has been pretty good.
$88,
it's at $89.
there it is, new high. 90,
Where do you think it's
$90
headed?
bucks.
So you could buy it here. You put a stop here at about 87. Now I'm looking to go to 105, and where I'm getting the 105, Nicole and Ben, is if you put this on a monthly, this is a longer-term trade. It had taken out a swing point, taken it out with volume. It's a very strong stock.
BFS.
That's technically. Fundamentally, what you have is that, guess what? They have a lot of great product. Everyone's looking for price. We're still, and we will be in this inflation mind for quite some time, meaning that people want to save money for the same type of value. And TJ Maxx offers a lot of value. So technically, it's taken out a swing point, particularly on a monthly. On the daily, it's a nice setup. You can even see Friday. It's coming in there with good volume. That's not a retail trader that's buying that when you see that type of volume. That's funds that continue to come in at these highs. So I think, there's a separation, there's no doubt, in retail, but discount retailer with, a high-end product, which TJ Maxx has, it seems to me like that's where people are going.
All right. Yeah, the recent high of $90, and he's watching that 105 level. Ben, your thoughts?
Yeah, that recent high you just mentioned, Nicole, that's up from 75 that we saw back in the middle of May, if you remember. So here's the chart. I mean, it's pretty well defined, right? You can see, much like we were just talking about in terms of ETN, you've got a left to top right type pattern playing out. You can see a very well-defined trend. And here's that $90 level we just mentioned. I was talking about, again, 75, 76. Looks like earnings is what really provided that bottom. We're talking back in the middle of May here, and then the rally throughout. Well, we're looking at $15 to the upside. And I went ahead and identified some of the areas of consolidation that have formed along the way. These are hourly candles here, and you can see. Now, Tom was talking about 87. Tom, I've got my eye more on the $86 level. I think that's kind of the line in the sand, but I do see the gap that Tom's looking at here as we rifled up through that $87 level. Again, speaking of earnings being the catalyst a few weeks ago, or a few months ago, I should say, earnings recently the catalyst up and through this $87 level. So there is some strength. There's momentum to the upside on the hourly time frame, and that plays out across multiple time frames here. Tom told us to look at the monthly. We will in a second for you, Tom, but first and foremost, looking here at daily candles, and we're going back to, we're talking the spring of 2022, a nice run-up, areas of consolidation that have formed higher and higher levels, currently balancing around 89. Bulls don't want to see it below. We'll give Tom that 87, 86 level, right? What's a dollar amongst friends here? And you can see why 86 is significant. It's the most recent area of consolidation that formed prior to the one that we're forming right now. So the bulls are looking to buy breakouts or tests of lower extreme that fail to take out key levels, and ultimately looking for a restraint to continue and resumption of that trade to the upside. Here's that monthly candle chart Tom talked about, up 3 months in a row of higher this month, and it's just parabolic to the upside, right? Kind of zooming in on some of the daily candles here and where we are relative to the 50 to 200-day moving average, the blue and yellow line here. You can also see RSI has been very supportive of the move up. So again, another instance where Tom's onto something here, Nicole, bullish on the intraday, the longer term, and that monthly chart, I mean, parabolic.
Yeah, and I always love a long-term chart, and I love the stairs we saw going up there from the 60s to the 70s, and how you were charting it out there for us, and it seems very positive. And when it's above both those moving averages, right, the 200-day, the 50-day, you have a lot of positive momentum there, Tom.
I put that stop so close. Gaps, to me, will get filled. So I always get worried when it comes into the gap, because you never know how far it's going to go. And that's why I put it there, because once it's into the gap, gaps are like magnets, particularly the gaps that are below it, and then eventually, we're going to get a correction, okay? So we get a correction, just never know whether it's going to stop at the gap. That's kind of how that's set up. So, but the monthly set up nice. Fundamentally, I think we're in pretty good shape. So we'll see where this baby shakes out.
And I feel like that's a constant conversation, whether or not gaps get filled.
Yes.
I think a lot of people think the answer is yes, and others say no, not necessarily. So, I mean, I feel like I've had that conversation a lot. Tell me, Tom, let's get to Eaton today. It's around the highs here. 227 was the recent high. Where do you think it's headed and why?
Eaton, you can buy it at this particular point. You can put a stop at about 219. Now I'm looking for Eaton to go to 247. And Nicole and Ben, this is going to be the same type of setup. This is a much longer setup. If you take a look at the monthly, you're going to see that we took the swing points out. We took them out with volume. Last week, it had a really nice week. It was going into volume, going into high, continue to have volume. So we continue to have buyers in this equity. And, you know, this is also a very large company, large industrial company. They continue to have a bigger top line, bigger bottom line, you know, so I think there's real action here.
All right, Ben, what do you think about Eden?
There is some real action here, and Tom, that monthly chart is impressive. We'll get to that in just a second. First and foremost, diving into the more intermediate time frame. I've got hourly candles here, and again, we're going back to the middle of April in this instance, a well-defined trend to the upside, and this is similar to the other two names that Tom has brought to our attention here. In this instance, we're talking 227 all the way from down around 161 we were as we were trading end of April. We're talking beginning of May, and along the way up, we, as you would expect, we established plenty of areas of consolidation for us to just kind of keep an eye on and reference strength or lack thereof in terms of this move, right? We're also referencing the prior area balance as we form the new one. In this instance, you can see we're balancing around 220. We don't want to see this thing up through 205. You can also see a very similar pattern in terms of what we were just talking about with our last example. You've got a gap up here right now prior to the more sideways consolidation. So you can see that high conviction vertical move up, and then you can see the horizontal trade that's played out since. This is exactly what the bulls want to see as this staircase pattern continues to play out to the upside. Let's move away from these hourly candles because there's a lot of information here on the daily chart. This is actually a weekly chart as well. Three areas of consolidation that really stood out to me longer terms, what Tom's looking at. So I think this is a good way to look at this price activity. 45.70, 150. Look at this high conviction move we've seen to the upside, sideways consolidation, and look at the vertical move we're in here right now of higher on a monthly basis. Here's that chart, Tom, you asked for. 4 months in a row to the upside.
Green candle there in SPY.
I said parabolic with our last example. This one is
down here at the lows.
True example of that. I mean, look at this pattern that we're seeing here, and a high conviction to the upside here, to say the least. Diving into the daily time frame candles again as we look at the 50-day, hold on one second here, the 50-day, the 200-day moving average. I've got the chart 1 second. Here it is, holding well above the 50, holding well above the 200-day moving average. RSI, again, another example of supportive of this bullish trend. Tom's got 3 examples that kind of fit all in line here today. Bullish on multiple time frames, and Tom, I can see the enthusiasm behind these 3 stocks.
Yeah, all right. You know, and Tom likes to pick names that are on the way up, find some of the winners that could challenge even higher. Thank you both. Ben, thank you for that. Tom, a final quick thought?
You know, I think we're going up to these highs. We're going to kind of challenge these highs in the market in general. I think we're going to flip into a consolidation probably for a bit, build some cause, you know, for higher price. That's what it looks like. And it's because of the fact that I think this dollar is going to pull back. I think bonds have bottomed. You know, and if that's the case, it's it's going to be a good 2024.
Tom O'Brien, Ben Lichtenstein, thank you both for the big 3 today. Really
have a great one. Have a safe one.
Great to see you both. Appreciate it. Okay, coming up next, we're going to spotlight Boeing. The company just got a price target hike over at TD Cowen after restarting the 737 MAX deliveries to China.
Barbecue,
we'll break down how that impacts the stock. We'll be right back.
Popped up here for hour and 15, came down, now doing the same thing down here. Slowly making its way down. So the DW is saying that car started the fire, was hit with a direct energy weapon, like from a satellite. 11:30. EU's closing already. Might as well close. Market's not going anywhere. See if we get a direction with the EU closing. Not that way. Still down 4%. BNT down 5. Liquor's up 27. That's 41. 2080, just below VWAP.
Or downside, a lot of NYSE halts going on, a lot of news that is coming out that may be factual or not factual. So you always want to be aware of that type of environment when you are trying to trade this name.
Yeah, I hadn't realized that a lot of the talk was about the power lines. I mean, you know, I haven't followed Hawaiian Electric as closely. I know the story, but, you know, the big picture story and the fatalities, but I didn't realize this. They're saying power lines not responsible for that deadly Lahaina fire. I mean, it's a lot of back and forth, as you said, that volatility, and we're seeing 40% moves, you know, basically, right? Thank you so much. Kevin Green, great to see you, Senior Markets Correspondent. Thanks. All right, time to turn our attention over to a great American company, and that is Boeing. So the company will be resuming the 737 MAX deliveries to China after a 4-year hiatus. Jay Woods is with us, Chief Global Strategist at Freedom Capital Markets. We have a lot to discuss. I guess we'll start off with Boeing, because we're seeing Boeing obviously getting some good news today, and people like to see that. When we think of Boeing, I mean, I always think of it as a big, great American company and a national security company too, but the sales to China, sounds like a positive.
Yeah, it's a positive on two fronts. I mean, we're still having good relations with China on the industrial front, where, you know, if we talk semiconductors and technology, it's a little skittish. And they're shaking off some bad news that happened last week with the recall. So what I always look at first as a technician is the price action. And Boeing's been a stock that's been beaten down for a while. And one of the things we've talked about here on this network is how the industrials are coming back to life. And to me, Boeing is one of the leaders in that sector, where it broke out above 220, ran to 240, and then retraced. And that old resistance level became support, and it held 220. It's rallying nicely, and I think it has a lot to reverse. So I think this story is set up to really lead Boeing a lot higher going into the end of the year.
Yeah, and I didn't realize that these delays were so long, and deep here, 4-year hiatus. I didn't quite realize when they were talking about some of the issues. I didn't realize how long it was. In the meantime, Boeing's up about 12% in the last 6 months. What's the big picture here on the markets? I mean, obviously, Boeing is a member of a lot of the major averages, but tell me a little bit about the big picture.
Yeah, the big picture is we're finally coming to the end of August, so everyone is catching their breath. We got through Jackson Hole. Powell didn't really move the needle too much, and we had such recency bias thinking about what he said last year, and there were a lot of jitters down here, and he struck the right tune going forward. But two things I watch. The S&P 500, it's in this little range between 43.25. It's old highs, which were retested. It held, so it took a shot across the bow, and it proved that, okay, we're still in this uptrend. This is good. Now we're watching to the upside 44.60, which is the declining 50-day moving average. It just turned. We got there last week. We were heading there this morning. We're pulling back a little bit. Not too much, actually. And I think we're going to be in this range bound for a little while until we get through a few big economic data points that come out on Thursday. I think that will catch our attention. And then watch the 10-year. The 10-year, 4.3% was a nice breakout. It got above there. It failed. And now it's trading under that. If we can get rates to kind of pause here and retreat with the S&P staying above key levels, I think we're set up for a nice fourth quarter run.
Well, that's the whole thing. And I was surprised when I saw rates going up over the last week or so. When rates were going up, but tech was going up. And, left me sort of wondering, that isn't normally the relationship. Of course, we had some NVIDIA news, and people were excited about NVIDIA. But prior to the NVIDIA news, we saw tech going up and rates were going up at the same time. And it's just, you don't normally see that. So, yeah, I see what you mean. If rates could just sort of slow down or even come in a little bit, that might be some good news overall for the equity market. Tell me about NVIDIA.
Yeah, that was the one, it makes no sense. It was the greatest quarter we've seen, back to back. They hit it out of the park. But this is where price action really comes into play, and that's what helped the guys down here who traded, helped the people on the desk. When that news broke, wow, they had whisper numbers. They exceeded everything. No one thought they could do it again. They did. After hours on Thursday, price action was up to 520. We opened at 502 at 9:30, the session that matters, and that was the high. It reversed. So as a technician, you see two things that get you scared. You have one, a bearish engulfing candle showing price action closed at the lows of the day. It was up 47 cents, so it was up on the day, up 6% for the week. But it ran up into the number, and it couldn't carry that momentum. Something has changed. Then you have what we call an exhaustion gap, where it has gapped the last 2 quarters after earnings. It gapped this time, but filled. So to me, the momentum, as far as the trading point of view, has come out of it. Long term, I think it's one of the greatest stocks you have to own, put away. But if you're looking for that momentum to continue, we're on a little bit of a pause. It's going to digest some of those recent gains. Look for the 440 level, and then 400 was just August 14th where you were trading there. So these pullbacks would be natural, normal. Does it make sense based on the fundamentals? Not necessarily, but that's what we're seeing in the price action.
I mean, it was exciting to see it running up and hitting new highs. And Gene Munster, who everybody knows, forever on Wall Street, I mean, he just couldn't get over the back-to-back growth and said he hadn't seen something like this. And the guidance was so good. And the whisper numbers, as we were talking, I was talking about here on the network and saying, as we were doing previews, and I said, they got to knock it out of the park because now the whisper numbers are, and people don't necessarily always see or hear about the whisper numbers, but they matter a lot.
Yeah, and everyone knew that they were going to beat because when they guide, they usually guide to a conservative level and then they
put
crush
like another $4 billion on it.
Yeah.
That being said, the big picture, how are you feeling about between now and the end of the year? I know you mentioned 4460 was a level you were watching on the S&P 500. Investors sort of say, oh, what should I do now? And August has been a tough month. It's already, and September notoriously is not a great month.
Yeah, September, the worst month of the year over the past 20 years. It averages a 0.5% loss. I think we're going to chop around a little bit, and you're going to see that rotational theme that we've talked about continue. Industrials look like they want to take a leg higher. Healthcare is catching a bid. It's still down 1% on the year, but what you'll see is people rotate into sectors that have been beaten down. Technology, the NASDAQ 100 is still up 36% year to date. Third best year in its history if we were to stop right now. So to see people take profits, rotate out of the Apples and Microsoft, which had healthy retracements, go into some sectors that have been beaten down, to me this is fine, but I think by the end of the year, Q4 in the presidential election cycle, we are poised to take that leg higher and possibly close near or at all-time highs.
Yeah, and it's hard because you want to take profits and take something off the table, but then if there's another rally, you miss it, or at least in part.
And that's where the fear is, missing that rally. Yeah.
Right. Well, bulls make money, bears make money, pigs get slaughtered.
Exactly.
I know. Okay, Jay Woods, Freedom Capital, thank you so much for being with us. Coming up next, we're talking about the disruptors. Today, Lam Research just got a price target hike over its Stiefel, thanks in part to the growth of AI. George Sill is standing by, and we'll have all the details.
There's a SPY filling the gap. And repeating the same thing to this morning. Consolidating, little rally, flush. Same consolidation here, rally and a flush. Little head and shoulders here, just like we had here. $7 sales, $7 price target. Really depends on what happens with this XDivvy. I'm not sure if the whole rally will be before that date. If so, that's pretty aggressive. I think it's at the. I had the line on here, but I think it might be on Thursday. So, if it rallies after that. Isn't sure. Yeah, I mean, we've broken this resistance. Not a whole lot. A whole lot left up there. Distance 3.5. Yeah. 8.5, 8. Five and a half, 2. Yeah, volume's good today. A lot of volume this morning on it. Making a nice bull flag again. Big engulfing candle there on the 5-minute. On SPY. GNS, yeah, a little volume pick up there above VWAP now. Hawaiian's popping up to VWAP at 40%.
Reports its earnings tomorrow after the close. Want to have a discussion on this one. William Kerwin's with us, equity analyst at Morningstar, and our own Lee Bowles, senior manager, trader education at Charles Schwab. Thank you both for being with us. Obviously, this HP hit a high recently of almost $34. William, first one to you. I mean, where do we think the company stands? What are you waiting to hear in the earnings report?
Absolutely. Good morning, Nicole. So when we look at HP, we're looking at the PC and the printing markets,
almost below
with
the data
PCs
on
making
SPY.
up the majority of sales. And that's really what we're focused on ahead of the print tomorrow afternoon. The PC market is one that's really been in a cyclical downturn over the past 12 months. And so what we're looking for is just the hopes of a rebound and sequential growth. If we see that tomorrow, then we would feel like we're coming up off the bottom for this market. and that there's more growth ahead. So we're focused on that PC growth really tomorrow.
And what's your current rating on this one?
So we have it as fairly valued. Our fair value estimate is $30 a share, and it's trading right around that now. We also have a no moat rating on HP. That's an indicator of competitive advantage. And that really just reflects that we view PCs and then also printing as relatively commodity-like markets, not the greatest profitability, but it's still a name that we really like the dividend on. The shareholder distributions are good, so it's a good one to hold in a portfolio for that income stream.
GME coming down a little bit.
Yeah.
On 3,
Lee
or up
Bull,
3%.
I know you've been studying up on this one,
Thanks.
HP. Tell us a little bit about some of your expectations.
Right. So I agree with Kerwin that the PC numbers are going to be important. There was some data from Gartner came out in July of this year that said that, according to them, for the quarter April to June, PC sales plunged 16.6% year over year. So that'll probably be reflected in maybe a weaker print for HP. I think what people are looking at is how are they going to, like Kerwin said, they're in a commoditized market. So how are they going to make money? And I think going forward, and I think one of the things that they are looking at, which I thought was pretty interesting, is that they are spending money trying to do new PC architecture where AI programs will be run locally as opposed to in the cloud. And that will reduce latency and increase security. So that's one growth area potentially, but they've got to prove that they can do that. The other thing is we want to listen in the call is how their expense reduction is going. They're trying to get at least $560 million in cost savings through this year. So we'll have to see how that's working as well.
Right. And as we take a look here, I mean, you both talked about, Lee was just talking about April to June and those PC sales coming down. And William, you noted that PC is probably a majority of sales that this company sees, and we think about hardware and it being that the sales remain relatively soft. I mean, is it a hardware market problem or is it an HP problem? And I won't even say problem, but issue.
We really think that it's more market driven. HP is one of the largest PC vendors, one of the largest printing vendors. So this is a market wide issue for them. We don't think there's anything, execution wise on HP's front that's causing the weakness. It's really just the demand out there. If you rewind 3 years, the PC market went gangbusters after COVID when everyone went to work from home. And now we're just seeing sort of the hangover from that. No one needs a new PC these days. There may be a refresh cycle from those 2020 purchases, in a year or two, but right now it just stays soft.
Yeah, and you noted in your note that the firm is executing well in its new cost restructuring efforts. I mean, there are some positives here, but as you said, this could be a big market problem. I mean, are you worried about some of the negatives, Lee? What are some of I know you always have positive and negatives.
Right. So the negatives, I mean, if you've been watching the dollar, it's just been going up and up and up. And remember, only 1/3 of their sales come from the U.S. So I don't know how much they baked into their guidance the dollar would be this high. So that's kind of a headwind. And they also stopped buying their stock back because they've reached the top of their leverage. They also have quite a bit of debt. They have the debt to equity ratio, they have more debt than equity. And now a lot of it is longer term, but the shorter ones are going to come due with a little bit higher interest rate. So that's going to be a little bit of a drag as well. As a matter of fact, they have issued more than $300 million of new debt in the first 2 quarters of this year.
Yeah. Okay, quickly, William, just names that you think are winners, whether it's in this exact group or just a little bit beyond in the tech world.
Yeah. Yep. The one that I keep pounding the table on this year is Teradyne, ticker is TER. It's in a different market. It's semiconductor testing, but it's a stock that's gotten beaten up and I think overly punished by the market, and one that we're expecting a rebound in 2024. So savvy investors, we think, can get in today ahead of that rebound and that run up.
Teradyne, one to watch. Year to date, it's up about 19%. We'll keep our eyes on that one as well. William Kerwin, Lee Bowl, thank you both very much. Good to see you both. Appreciate it. All right, that's going to do it for us here on Trading 360. I hope you're having a beautiful Monday so far. I'm Nicole Petalides. I'll see you at 2 p.m. Eastern Time for the Watch List. Join me then. In the meantime, keep it right here.
And right at VWAP now. GNS up 43, just above VWAP. You might want to make another move today. Eyes going so slow. HE above VWAP. I want to pop too. Nice. Slowly melting down, but I'm back up a little bit here. Hawaiian above VWAP. I get a little bounce here.
economic data for this market to consume and digest. So there's earnings, but a couple high-profile names, but nothing crazy important about earnings. I think this week is all about data.
Yeah, definitely data deluge this week, led by the jobs, and jobs have been robust. That's been a thorn in the side of the Fed at this point. But one of the stocks, as I mentioned earlier, doing well today. That's 3M, up over 4%. On the back of some positive news, let's bring in Caroline Wood, senior markets correspondent here, to help us break this down. This is a breakthrough for this company at this point, Caroline, but they're not through the woods by any stretch of the imagination. They've got lawsuits on multiple fronts, but some positive news here for 3M.
Pretty,
hey there, Tom. Yes,
pretty generous.
Up about 5% right now.
Yeah, make it
on
$7,
reports that it reached a settlement over its earplugs. But as you've said,
got the ex-dividend date coming up.
A huge overhang
so
on
it could sell off after that.
They're not just
maybe that'll cause it to squeeze. I don't know, but
huge litigation, but also of course Forever Chemicals, which we've talked about in the past. But let's talk about these reports. There are over 300,000 lawsuits claiming 3M sold the U.S. military faulty earplugs that basically fail to protect veterans from hearing loss over loud noises and such. 3M has said that the earplugs worked correctly when properly worn, but now there are reports that it has reached or tentatively agreed to pay a $5.5 billion settlement to resolve those lawsuits. Under the terms of the settlement, 3M would pay that $5.5 billion over the course of 5 years. And when you put $5.5 billion into perspective, it's much higher than the $1 billion that 3M initially tried to pay. But analysts were expecting this to be as much as $10 billion or even $15 billion. So this is at the low end of those expectations, and that's likely why we're seeing shares higher today, as I said, up about 5%. We've also seen a few analysts weighing in about this reported settlement. Citi says the potential settlement could mark another step in 3M alleviating its legal burden and moving away from litigation noise that has been weighing on valuation. Although the analyst there said, we still think 3M has a hill to climb. So they're keeping their hold rating and $111 price target. Meanwhile, B of A also views it as a positive, but does note that the company has not actually confirmed this settlement yet.
Why don't you go ahead and get there by
the analyst
tomorrow?
there says, though, if it is in fact $5.5 billion, that would come in at the low end of estimates and would be a material positive for 3M. They're maintaining their neutral rating as well, balancing 3M's low valuation and improving execution with litigation risk. Their price target is $120 on shares, a little bit higher. So 3M currently trading, as you can see here, just below 104 a share. That's up about 5% today, but still down about 7% in August and about 14%, or a little more than 13% so far this year.
Yeah, Caroline, this is an important lesson for traders out there, because the knee-jerk question is, why is $5.5 billion bullish for a stock? And the answer is because the range was 5. I've heard as high as 20 billion, Caroline. And traders, investors, they like, they don't like uncertainty, and they like certainty. And so this and one more hurdle to clear the decks of all these problems, this is it. But for this stock to rally $5 or right at 5%, that shows everyone, put a number on it and the market will generally like it. De-risk this company, Caroline.
Especially if that number is far below what some of the analysts were saying, as you said, as upwards of $20 billion. I heard in the $10 to $15 billion range, so 5.5 definitely below all of those figures. But I do think it's important to note they're not out of the woods yet in terms of litigation overhang. They did recently have that $12.5 billion settlement with U.S. water providers over those so-called Forever Chemicals in drinking water, but they still have litigation pending, or consumer litigation pending over water pollution. So they've said that they'll remove all of their Forever Chemicals and products by 2025. So there's still a lot in terms of that. But yes, this should provide a bit more certainty if, in fact, this is confirmed by 3M, and being at the low end of the range, likely helping shares. That being said, despite the fact that this is a company that's been under so much pressure because of all of this litigation, and as I said, is down about 13.5% year to date. You take a look at the analyst breakdown. Not a single analyst at this point has a buy rating on shares.
$20 billion is crazy.
Have a hold
Gonna
rating.
ride the
There are
channel?
15 hold ratings, 4 sells, median price target of 115. So higher than where it's currently trading. But you take a look at that chart. That's what it was trading back at 2013. So it's
Only can stay in
definitely
this
a
channel.
long way to go for 3M.
Yeah, and then throw on top of that the PFAS lawsuits that they got the Forever Chemicals also.
This
Next
just
low
shows you
might-
the human element
might be the
of
final
this
one.
business because of their perception. You may have target ratings or price targets higher than this, but you don't dare recommend this stock for a buy.
Right. Yeah, because you need some certainty, not uncertainty. Still plenty of that out there. All right, thanks.
We used to say Post-it maker. I used to say Post-it maker 3M. Now it's associated with things other than
Nice
Post-its.
buy.
Yeah, I'm
Oh, yeah,
old enough to
been fast. We were
still
watching this
call
one.
it that. All right.
It's crazy,
Thanks,
man.
Caroline Wood, senior markets
Crazy
correspondent, here
one.
breaking down the
No,
3M
I mean,
story.
not a whole lot to look at, really.
But now let's bring in Alex Coffey, senior equities contributor. Alex, I wanted to kind of get
nice.
back
It's
to a
been full
discussion
flagged and
on the fallout from Jackson Hole. The
momentum
speech
hasn't
from
changed
Fed
at
Chair
all.
Powell. It seems like he threaded the needle for the most part. The market liked it a little bit.
But selling when it's
overly
green and into
hawkish, in
strength
my
is
opinion.
a good way to get the top if you're trying to
The
time the
2%
top.
inflation target goal remains,
scaling out
right?
at least.
And in
Because,
this type of
have a-
economy where
have a gap down
estimates for
any
GDP
time.
are starting to go up for this quarter, right? We're getting the second read on Q2 GDP later this week. But when you look at this with a robust jobs market,
since it's
how
up
did they
on
get down to 2%? Because
nothing
I
but
just don't see it, and I think that's
liquidity
why
or,
a lot of people in the
lateral
market
pump.
think they need to adjust that to maybe 3%.
Well, I think it comes down to ultimately what you actually think caused the increase in prices. I think that when Jerome Powell and the Fed initially were talking about inflation and why they were maybe late to act, I think largely the thought process there was accurate. We saw an increase in prices largely driven by supply shocks. When it comes down to it, you shut down the world, and rather than by shutting down the world, you bring down demand because everyone plays a little bit more safe and is watching their budgets a little bit closer. We propped up demand through fiscal stimulus as well as chopping down interest rates in order to kind of create that wealth effect. And QE, of course, to drive down longer rates. Although
rally
the
back to
data on
VWAP
how
first,
well
even.
QE,
It's kind of building up
really
this little inverse head and
impacts
shoulders
long
too now.
rates is up in the air, but psychologically it has that effect, at least on risk assets, to the upside during QE.
I've just been getting decayed on my time.
When you
It's
look
not
at
even
that, we've largely watched these
my direction,
transitory
I just-
effects take place slowly over time, and that supply and demand is coming back in line. A lot of those kind of areas of the market, semiconductors, used cars, new cars, we've watched not necessarily those things snap back to where they were before, but the rate at which they're increasing has fallen off a cliff, and in some cases there is a little bit of deflationary forces. But just because we say disinflation or inflation working towards 2%, I think the misconception is there's this feeling that means it has to go back to where it was. It's likely we're never going back to those prices pre-COVID. It's just we're not going to have runaway inflation to the upside. The Fed is concerned with runaway inflation. So although they're working towards 2%, 3% and 2% aren't really that far apart. And our path is towards 2%. So absent any type of major supply shocks again or some sort of force that we don't see, we're on that trajectory. And so now we watch the monetary policy path, and what has it been? Well, they started by raising rates by, 75 basis points. They did that a couple times. And they went to 50 basis points. And they started doing 25 basis points. Well, that's the smallest increment we can go. So how do you make that smaller? You start skipping meetings. And so I don't think September is in play, but November is absolutely in play, especially if the things that you're talking about, which is a little bit more sticky price increases, robust jobs, stronger economy is still in play. If you're truly trying to fight inflation through tightening monetary policy, you got to still tighten it.
Yeah, you got to still tighten. You got to maybe make the administration realize that you can't keep pumping money into a system that might not need it. Kevin, but same question to you. 2%, is it doable this year?
This in 2023?
Yeah.
No. No.
That's a
we
good
are
answer.
not getting to 2% this year. I'm going to read you the expectations for this week's wages number, up 0.3 and 4.4% year over year. That's flat from last month, okay? How about income and outlays data? The headline, up 3.3%. That's up 0.3% in the year-over-year headline. The core, 4.2%. That's up 0.1%. So every single metric, the consensus is right now for all these three to either be flat or higher on the year-to-year data.
Yeah.
That doesn't sound like 2% to me.
Right.
And,
Or middle of the day, we're starting to get some
Alex is
chop.
right. September might be off the table, and a
Wanted to be out of these before
How do
now.
you get to smaller increments? Yeah, you do one every other time. Well, I think that they're going to be frustrated with the stickiness of these numbers,
Right.
and I think Jerome Powell made it as clear as he possibly could. 2%'s the number, not 2.5, not 3.
Yeah, and we've been talking about that the last couple of weeks, where maybe we're going to get that leveling out of those numbers coming down, because we've had numbers come down since last June in 2022 as far as some of those numbers. So maybe some consolidation, maybe a little tick up higher, and that's going to probably present a problem for the Fed. But Alex, when you look at some of the stuff that's coming out this week, Kevin mentioned some of the data points. It's all jobs heavy at this point. We mentioned that GDP, but PCE is pretty important on Thursday, right?
Yeah, I think so. I think that the jobs data is going to be more critical. I mean, we've had now 3 consecutive quarters of declining earnings for the S&P 500. There are signs that the economy is not as strong as some of those, GDP forecasts and job numbers maybe suggest. I think what I'm going to be focusing on for the jobs data is what do the revisions look like every single time we've gotten a jobs update. They've revised lower the previous month, and so if that trend continues, that's more consistent with a contracting economy than it is with an expanding one. They did some research at the St. Louis Fed on this back in the day. We've talked about that before, but I'll give you the cliff notes. During recessionary times, the jobs data is overstated by about 20,000. Thus far this year, they've been overstating by about 40,000. And the baseline in just kind of all data is actually for an understatement of about 18,000, I believe it was. So if you're just comparing to baseline, we're like 60,000 overstating kind of what a normal time would be on each one of these jobs datas. So we keep getting these headlines like, oh, super strong jobs growth. Then you look back at that number 6 months later, and it's like, that's not even the same number. So we make all these headlines, and then that actually isn't reality. And so that's the thing that I think I'm most tuned in on here is the job market is an optimistic forecast of the economy. Well, we keep being overly optimistic about what those numbers actually are in the end.
Yeah, and when, Kevin, you look at, besides the jobs data, I mentioned the PCE, housing prices still at record highs, at or near record highs, interest rates. When you look at the dollar and the impact of interest rates on the consumer at this point, it doesn't seem to have hurt them so far. There are pockets that are under stress, whether it's small business loans, consumer loans, and such. But at the same time, everything's going along the Fed's path or plan that they've kind of set out here. The dollar and yields are those two key components that traders and investors that watch this show and are out there trying to figure things out should be watching, because those have been trending higher.
Yeah, I mean, we can go back to the history of this show and just rewind tapes of us saying how important the U.S. dollar is. Why? Well, the U.S. dollar, if it's rising, it sounds counterintuitive, but we actually want a lower U.S. dollar, not a higher, because it makes our goods and services cheaper to foreign buyers. Interest rates, pretty simple, right? It makes risk assets and borrowing money to purchase risk assets more expensive. So all these things lead to, remember, 27 of the 30 Dow stocks are multinationals.
Let's see how EOSE is.
So if a higher U.S. dollar it hurts basically 90% of the Dow Industrial Average, you can equate that to the S&P. So a higher dollar hurts stocks, and a higher level of yields hurt stocks. The economy and stock market, not always the same thing, as we talk about a lot. So yeah, I mean, I think you have to look at the macro for help looking at the day-to-day trading. I think the macro is extremely important here.
Yeah, yields, 10-year yield hit highs we haven't seen since 2007 last week. Dollar hit nearly three-month highs also, so we'll keep an eye on those asset classes for some direction on stocks at this point. All right, let's take a quick break. When we come back, we're going to take a look at Boeing. The airplane maker is up over the last couple sessions on the back of those China deliveries potentially starting back up. Past Markets coming right back.
Holding through the midday chop. After all we had was morning chop. Thought it was wanting to make something happen. We broke that low, but just made a new level to chop at. Break out of here. Direction. It's kind of building this inverse head and shoulders. Part of the reason I got out. But yeah, in middle of the day.
Positive news for this company after another setback last week, where Spirit Aerosystems, had some more issues with some of the production there. But this is, I think you base it on travel and demand, and TSA numbers are now above 2019 levels.
And that has to show up in airline demand. And you're right, the problem out of Spirit Aerosystem that came up for Boeing. They sold Boeing stock off hard, even though they can use other suppliers for this. And I don't think that was as bad of news as everyone thinks. But the news about deliveries to China is really good news. Mm-hmm. But Boeing, you always got to plan for the good news along with some bad news in Boeing, right? Right now, the commercial aircraft part of Boeing is surging. They've got backlogs there. They're raising the production. But the defense, space, and security is hemorrhaging losses. Their fixed price programs are getting creamed. Right. So once they discount that and get that off the books, the rest is pretty good news for Boeing, right? But they've got this one thing kind of dragging them down. The rest is doing extremely well, and every plane they sell, every plane they deliver, it's free cash flow. And they keep getting better. And their goals for 2023 of $3.5 to $5 billion in free cash, it looks like they're going to hit it.
Right.
And their 25 to 26 numbers of 50 planes a month, that looks like they're on track to do that. So there's a lot of good news here, but believe me, I watch Boeing often, and it's a uniquely frustrating stock to trade because you get good news, good news, good news, bad, good news, good news, good news, bad.
Right. And if you look at this over the last year, Alex, the trend is still higher at this point. This is just another feather in the cap of Boeing moving forward, especially with there's been no pullback in demand for these planes because a lot of these airlines actually put off getting deliveries. Now you got deliveries ramping up. Now you got China, 1.2 billion people flying around. This is a big deal for them.
No, and it really is, and it's changed the kind of shifted sentiment, I would say, back to more of an optimistic one. As Kevin had said, this is a name that kind of ebbs and flows with news headlines. It's no secret that it's essentially a duopoly for this market, and that's been quite fortunate for it because some of the missteps over the last 5 years and macro impacts probably could have had some catastrophic returns for a company that had greater competitors within its space, but only having to really deal with one allowed it to kind of weather some pretty interesting storms. I mean, if I was a economics professor or something, I was trying to illustrate macro and microeconomics. I mean, Boeing over the last 5 years has everything. It's got the 737 MAX issues, which are, of course, Boeing specific. And then it has, of course, the pandemic and its impact on the marketplace globally for the products that it sells from a macro standpoint. So I think it's been a really important stock over the years. But as we look ahead now, China as a marketplace coming back to this particular plane, which is one of the most important products for Boeing, is clearly optimistic, and we had a couple analysts that underscored that. Susquehanna reiterating their positive rating, a 270 price target, essentially on that move forward in China. And we also got a similar sentiment from TD Cowen, upping their price target to 260 from 255 and an outperform. So this is a name that wants to get back to where it was prior to 737 MAX issues, and the only way to do that is to, like Kevin said, take a couple steps forward without that step back.
Yeah, you got to be prepared for some month-to-month volatility in this name
because stock moves.
And earnings were great last quarter. Implied volatility, Alex, at or near 52-week lows in there. So how do you want to look at this one with the stock up about, 18% so far this year, but down nearly 6% this month.
Yeah, overall market volatility has increased, but you haven't necessarily seen an uptick tremendously in a name like Boeing. But when you look at the chart itself, it seems to be getting down towards a lower end of a recent trading range, and possibly you see some support levels below the market. So you can look at trading strategies from a volatility standpoint, and I think that that's something that needs to be considered. But I also think sometimes if you're a technical trader particularly, sometimes the price action fits the strategy, less so the volatility levels. And so if you're looking at Boeing from a standpoint of maybe it just holds on to these levels as opposed to moves higher from here, maybe you look to something like selling a put or selling a put vertical below the marketplace as opposed to buying premium or buying stock shares and looking for a move higher. And so in this particular trade illustration, that's what we've done. We're looking at selling a put vertical, Tom, below the market, going out to the September 15th monthly cycle. This is only 2 weeks from this Friday, so it's not a super long-term trade. But with a name like Boeing, it's certainly enough time for some of these news items to break and a surprise to happen. But also, if it kind of just churns around here and sort of languishes as it's been known to do absent some news, maybe this works out as well. But the strikes in particular, looking at the 217.5 to 15 put vertical, $2.50 wide strikes was the minimum increment in Boeing in that September monthly cycle. And so in order to make this a more accessible trade, I elected for the minimum increment for the put vertical. And then I basically selected strikes as a function of pricing. And so less so picking a technical level, less so picking a strike that I thought was a support level, but more so looking to collect at least 20% of the width of the strikes. And for the illustration, that was the assumption made, was that this would collect about 50 cents. So it may be trading for more, maybe trading for less, but using that as sort of our loose guideline here as a minimum. That would be a 4-to-1 risk-reward ratio in which you're risking $200 to make 50 for every one of these, not accounting for the transaction fees, of course. Break even would be 217. So if you look at where Boeing's trading right now at 225, that's about 4% below the current share price, a little bit less than that, but about 4% below the current share price. It gives us a little bit of cushion over the next 2 weeks and some change for Boeing, just to really build on some of this recent optimism as opposed to work any lower as it had for the weeks leading up to that China news.
Yeah, let's look at this strategy, September 15th monthly cycle. So 2.5 weeks till expiration on this one, selling the 217.5 strike put, buying the 215. Kevin, on this one, probability of that 217.5 strike put that you want it to remain above about 73%. So it's giving you that higher probability of success, which is why you're only collecting 50 cents on a $2.50 wide vertical. We're
18 days away, and the expected move now and the SEP expiration is $11. So that takes you to, 214. So you're right in the middle of that trade. So yeah, a good chance, a high probability trade, collecting theta, risk defined. Alex put his numbers so he would collect about 20% of the width of the strikes. That's fundamentally sound. Doesn't mean it's going to work, but it's fundamentally sound, right? But like I said, this is a name that you're right. You gotta be ready for some of the news cycle that they, with the company this size, there's always something new. I remember trading GE. You walk in every day, read the Wall Street Journal, and look in the table of contents. Any stories on GE? Now you can just click it up here and get news stories. But I remember doing that. As long as it's not in the news, we're good, right?
Yeah.
But so that's the way you got to look at this. But you got to always got to be ready, be risk defined, because news can break.
Yeah, and it did break through its 100-day moving average, bounced off it on Friday. That might be an area of support.
Around 221, I think it is.
Just below 215 is that 100-day moving
221 is the 50. Sorry.
Yeah, 50, but it's back above the 50-day, which might become support right now. So that's a key thing to look at. Do have some assignment risk on that short 217.5 strike put going into expiration over the next 18 days also. All right, thanks to Alex Coffey here joining us, senior equities contributor here on the network, breaking down markets and Boeing. But coming up after the break, Kevin and I are going to be joined by Andy Swan from Likefolio for discussion on Best Buy and the data on the stock moves. The retailer's lag in the market this year and is down about 8% ahead of earnings tomorrow morning. Stick around, coming right back. portfolio. Welcome back to the show, Andy.
Thank you. Happy Monday.
Happy Monday to you. We're talking Best Buy ahead of earnings tomorrow morning. Stock's really lagging so far this year and the overall market. And I put something out there on Twitter asking people where they get their electronics from. Amazon leading the way, followed by Best Buy, and then Costco at this point. What kind of data are you guys seeing out of Likefolio? Is it supporting the weakness in the stock at this point?
Yeah, it is. I think the stock's pretty well priced here. And it's funny, you talk about electronics, and if you'd asked me 3 years ago, 5 years ago, where Best Buy would be today, I would have probably said it's going the way of Blockbuster. It feels like, why do we need Best Buy? But I think the company has done a very good job of pivoting, getting some subscription type of services going in there, and some of those higher end electronics. I think, unfortunately for Best Buy, the one thing that we're seeing kind of disappoint us, especially right now, is web traffic. So those digital sales, we're seeing web traffic down 8% on a year-over-year basis. And why this is important is because we really think that the back-to-school season, the back-to-school shopping season, should have been and should be a lot better for Best Buy than it is right now. As a function of back-to-school shopping, the demand for electronics is far greater than it was even 5 or 10 years ago. Certainly when I was a kid, it was Trapper Keepers, notebooks and stickers and pencils. Now it's tablets and laptops. And so we really expected Best Buy to get a really nice move in August in terms of web visits, in terms of mentions on social media. We're really just not seeing that. It's just a little bit disappointing. And what that tells us is that Best Buy perhaps is not top of mind for consumers. And the reason that we're so interested in the back to school season isn't just because of the back to school revenues, which I think disappoint, but I think it tells us how much optimism the company probably has about its consumer base going into this call and whether or not they'll be able to guide higher or lower. And so if we had to guess at this point, based on what we're seeing back to school season, they probably either keep things the same or maybe even reiterate their call from last earnings that they're seeing some recessionary type behavior from their consumer base.
Andy, I'm an economics major, so let's make assumptions, right? Let's start off this discussion by making assumptions, which is, let's assume that a large percentage of the U.S. population bought new computers during COVID, right? Yep. That's a fair assumption, right? You saw the things happen. If the data that I read, a computer speed doubles the speed of a computer every 1.5 to 2 years, and heavy use computers need to be replaced about every 3 years, consumer computers less used every 4 years. Aren't we about to come into a big cycle of people from COVID replacing those machines? And shouldn't that favor a company like Best Buy that has
really just
relatively low prices, sold off a little bit, but and they do a great job with headcount and expenses.
Thanks, man.
They stay lean and agile. Isn't this makeup cycle setting up well for them?
Yeah, it's setting up well, but it's setting up for a really long time. We would have expected to start to see some of that already at this point. And I think especially this summer, we would have expected to see considerably more than we have seen. It's not just computers, it's also those large TVs that are on people's walls. A lot of the larger electronic items that we purchase, COVID, that whole thing in 2020 really sparked a lot of earlier than normal replacement cycle purchasing. And so you're right, we would expect that replacement cycle to be kicking in. We would have expected it even earlier this year, but I do think that the economy overall has given people a little bit of a pause and given people a little bit of a reason to kind of kick the can down the road on those replacement purchases a little bit longer than normal. So it is possible that Best Buy's kind of lackluster performance or disappointment this year could turn into a really big year in 2024 macroeconomic things start to turn around and we get that replacement cycle at the same time.
Yeah, and I think that a lot will depend if the economy stays pretty robust with the consumer. They don't get jammed up.
Sure,
a little bit.
layoffs don't do anything for computer sales, right?
Not at all.
Right.
And inflationary pressures, just the day-to-day living. But Andy, when you look at this, as far as happiness levels, you guys talk about that a lot with your data. I mean, how do you measure that? Because I don't go to Best Buy like I did 5 years ago or even 10 years ago, probably even less. I'll look at Costco, I'll look at Amazon for better pricing or maybe just ease. Are you seeing happiness levels deteriorate, and do you have an earnings score on this one going into the report?
Yeah, the good news, I think, for Best Buy's consumer happiness levels pretty flat. They're holding on to that. I think their services businesses are pretty good. Some of their appliance business, consumers like going there, which is not the first place I think of when I think of appliances, but they have a pretty good footprint there. And so going into this report, our data overall is neutral because the stock is lagging. And so we had kind of a negative slant on our data, and the stock has a negative slant on that. I do think that, from what we've seen from the retail sector so far, this earnings cycle, risk clearly is to the downside. And I don't think that the company is going to be in a position to come out and say, we're expecting a really big holiday season in fourth quarter. I just don't see the data to support that.
All right. Great stuff. Great data as always, Andy. Appreciate it.
Thank you.
All right. That's Andy Swan, co-founder at Likefolio, breaking down the data for us on Best Buy. Kev, I think we bring up good points. It's like people have maybe they're exhausted from what they purchased at the start of the pandemic, through the pandemic. And, you mentioned the cycle times. 3 years for a computer? I would always think like 5 years minimum.
Like I said,
if what you need.
The speed of a computer doubles every 1.5 to 2 years.
Right.
At some point, you start looking at the computer like, oh, this brick I have. What am I doing? I need the fast, sleeker one. Yes. So, human nature says that. But, this is still the most impressive thing about Best Buy. Number one, Andy's first comment that he made. A lot of people thought this company would be out of business.
Right.
And yet, they continue to outperform, not just perform, but outperform. Now, stock doesn't get a lot of love. It's got a pretty low PE.
They do buybacks, though. They like their dividend. They're very shareholder friendly.
Expenses and headcount, they are on it. They don't linger. They stay lean and agile. And so they're a well-run company.
Geek Squad is awesome.
Yes, exactly.
The services side, yeah.
So they do a lot of good things. Now, that doesn't necessarily mean that the macro won't take over, but maybe they're getting through that is what the numbers might hint to. I don't know for sure, but here's what I did, Tom, in terms of looking at a trade.
I'm like a bot.
You can't ignore the 5% dividend on this company. It's got a 5% dividend yield. Now, that's not guaranteed, and they could always trim that, and there's always the possibility. You got to be prepared for that. So how do I do a butterfly with stock?
Back up there.
So here's what I did, Tom. Here's what I looked at, something in a little more hybrid.
So
I bought 100 shares of stock in paper money for a practice trade, and then I sold 2 of this week's 78 calls and bought 1 of the 80 calls. 78 call right in line with the expected move. So I made a butterfly where the long end, instead of being a call, is actually the stock.
Yep.
So you could theoretically get the dividend and sell 2 calls right at the expected move on the upside and buy 1 to make it even. You are contract neutral, though.
Yeah, option market's pricing in about a $4.30 move in the shares, plus or minus. So let's break this one down, Kev. These are 2 separate trades that make up this strategy. So you buy 100 shares of Best Buy stock. It's trading around $73.40 on that. Then you sell 2 of the September 1st weeklies that expire in just 4 days. Sell 2 of the 78 strike calls, and then buy 1 of the 80 strike calls to complete this. So you're doing a 2-by-1 ratio call spread on this one, along with the purchase of 100 shares of stock, collecting roughly about $1 credit on the call vertical 2-by-1. and paying about $73.40 for the stock. So it's about $72.40 is going to be your break even on this one to the downside. You can see that on the risk profile. Now, this thing's got a lot of risk, right? $7,240 in risk to the downside if that's what you pay on it. You apex a profitability just above $500 on this. At or near that 78 strike, which is about that 1 standard deviation move. And then even above 80, because you own the stock, you're still going to be profitable on this type of trade. Kevin, any final thoughts on, it's a different one than we normally look at, but it's still the same basis of like an unbalanced call butterfly, but you do have that that risk to the downside to zero in this.
Again, it's two trades. Thinking about doing a strategy that would still allow you to get the dividend. It's a covered call, and it's a short call vertical.
Yep.
Right? You combine those two, and yes, if you are not bullish if you wouldn't do a covered call, don't do this trade.
Right.
Right? This sets up the guts of this as a covered call strategy, and then an extra short call vertical against it.
Yep, and you do have some assignment risk on that short 78 strike call in this strategy also. So good look at a different type of strategy, but setting up with a covered call and a short call vertical, creating this one. All right, that's going to wrap up this segment. But when we come back, we're going to take a look at Delta Airlines. The airline stock has hit 52-week highs in July, but has fallen pretty sharply, nearly 9% so far this month. Fast Market's coming right back.
I chopping around still. VWAP so low. Yeah, might not get a good setup for a trade today. This short was the only one, and that was short-lived. Such a small. Almost back to VWAP.
Gee, let me think.
Gee.
Sure.
Busy Bee, thank you for your support, man. Appreciate the generosity. Thanks, Busy Bee. Sorry I can't be so optimistic about Mullen. But it is rallying. There's 3%. Drew a little line here for you. Maybe you can consider it breaking out above $1. You hate Mullen. Mullen. I oddly don't like it as much as barbecue, even though I've lost much more on barbecue. What about that Mullen? Are you holding a good position, big position in it? barbecue. 20,000 shares in Mullen. Man, 30K in barbecue. Excuse me. Wow. Jeez, I think. Sure. Radical candles, some might say. The downside. They psych you up. Back to VWAP. Trading around VWAP. Looks like it's setting up a cup here though. Hard to see it flattening out here. I didn't like that double bottom for the puts. Just wanted to fill the gap and find some support here, but no. So we'll see if it makes high of the day. And it finds the top of the channel now, but I don't know. Very, very choppy day. Might not get much else.
For Delta. Now, if you look at last quarter's earnings and, of course, revenues conference call, they did increase quite a bit to the upside, from about $5.50 at the midpoint to $6.50. That's for fiscal year 2023. While at the same time, if you look at 2024 earnings, they were around $6.86. They actually moved another dollar to $7.86. So this really puts the 2023 and 2024 PE at 6 and 5 respectively. That's lower than 9 times earnings, which is based on the historical average. Now, valuation certainly makes a difference as long as earnings increases or is expected to increase, not decrease. That's the case here for Delta. So a lot of times you see value traps because earnings are decreasing and therefore low multiples trap investors who think they're getting a good deal. One of the things about Delta I noticed is the stock is down about 31% since prior to the pandemic. This is in 2019, but operating income is only down 21% now. It's improved significantly since 2022, and they have been buying back shares. They've actually bought back about 10 million shares since 2019, and now operating income and profitability is improving. And so, I think this is starting to look interesting here for Delta alongside the other major international carriers like United and, of course, American. And that flag pullback to the 20-week moving average also looks compelling from a technical standpoint.
Yeah, George, there's a lot to unpack here. These stocks, this sector, right, of trading in airlines, it's volatile in normal markets, right? It's volatile before there's disruptions and all this. But this is the gold standard in airlines right now. They seem to be doing the best job. They seem to be the most well-run. They instituted their dividend. They continue to get healthy. You mentioned they raised their full-year guidance earnings per share by 20%. So they seem to be able to holding on. They're slowly but surely, all the airlines are adding some capacity. But the question is, George, this stock sold off about 14, 15%, right around that level. How do we play this going forward, George? What's the right, remember, these stocks are always volatile, but is the value there? If the value's not in Delta, it's probably not in any of the airlines, George.
So yeah, I agree with you, Kevin. If you look at Delta from the other three, legacy international players, I'm going to exclude, of course, Southwest, which is more of a domestic airline, but the profitability profile of this company relative to those others is far better. And that's, just looking at the earnings profile and, of
GNS
course,
still
the
consolidating
expectations going
above
forward.
VWAP there.
I think it's interesting here. The reason I
Earnings
looked all the way back to
consolidation today
2019 is
on
I wanted to compare
GNS. Back to
price
VWAP.
relative to earnings. And if you look at the expectations for 2024's earnings, it's actually going to be exceeding. This is, again, based on the original share count back in 2019, exceeded in 2024, but the price is still down 31%. And I think that's important here because maybe from a valuation standpoint, this has still been underappreciated, especially from institutions. Now, lastly, I'll say this. If you look carefully, they cut their dividend during the pandemic. They actually reinstated it at a small amount, 10 cents. Now, that's not very meaningful, but it does make meaningful sense, especially when institutions, which can only own dividend-paying stocks, are now able to buy it. So I think that's another thing that I found it's interesting. I'm not saying it's a buy or not, but I think it's compelling because institutions now are able, for those who only have dividend-owning charters in their investment portfolios, can now start purchasing Delta.
All right, great breakdown here for us, George. Appreciate it. George Tilla, senior markets correspondent, breaking down Delta for us. Kev, let's get into a discussion about the example trade it came up with. Now they report earnings during the October monthly cycle of next month. So I looked at a strategy that they're one of the first ones, right along with the financials. So I wanted to look at something that I avoid that, but maybe take advantage of a move higher if that's what you believe the stock is going to do. So I looked at a combo trade here. Sometimes we call this a risk reversal, where you're taking a bullish call and helping finance it with a short to or neutral to bullish short put. So a cash secured put along with a long call on this. And going out to the October 6th weekly series here, so giving myself about 39 days till expiration, where I'm going to sell an out-of-the-money 41 strike put that helps to finance a long 44 strike call. You're collecting roughly about a dime credit. You actually might collect a little bit more. Stock has pulled back a little bit. But if you collect a dime credit, it takes your break even. You can see
looks
there,
like we're going to go for high day.
$40.90.
Maybe the top of that channel
That's
still.
About $1.20 below the current share price.
What
So
an
you're
ugly
giving yourself
choppy
that
day though.
cushion.
She's been in the middle,
And even if it
middle-ish
stays
of the
flat
range like
here,
all day.
between that 41 and 44,
Didn't make it to the
you can
low for a
still
nice long.
keep
Didn't make it to the high for a nice
dime
short.
credit that you
Just
collected. Now, risk on this, just under $4,100 because the stock has that chance to go to zero. And you have assignment risk on that short put, Kevin, which would make you a purchaser if you held that short put at $40.90. Your thoughts here on the combo where you think it's going to move higher and you're giving yourself over a month?
Yeah, your break even about just under $41. Why? The question is, why do this as opposed to just buy the stock? And the question is because you're doing it for just margin. You're not spending any real money on it. And if nothing happens, you've got $1 on the downside where you don't lose any money.
Right. Yeah. And we mentioned that break even just below 41 on this. Now, Kevin, historically we've seen stocks rise into earnings, right? Maybe we'll get some revisions. But we've seen stocks fall ahead of earnings, too, if they get lowered.
This has got about 77 deltas. Tom.
Yeah, and international travel picking up, business travel picking up. That's where they make their margins. As George mentioned, best balance sheet on this. Any final thoughts on this type of strategy? You've just got to be comfortable with owning the shares if the stock does pull back.
This is a more advanced strategy. It replaces buying the stock. Gives you the upside exposure, gives you the downside exposure, but there's a little buffer where you don't get hurt.
Yep.
And that's what it is. Buying the 44, selling the 41.
Yeah, nearly a month and a half in that example trade also. All right, Kev, that's going to do it for you and I today here on Fast Market. But stick around right here on the Schwab Network. Next Gen Investing's coming up.
climbing. Couldn't even have the decency to fill the gap. Well, see if we could hit at the top of the channel now on a longer time frame. I like 443, maybe 444. Yeah, maybe 444 even. Somewhere between 443.5 and 444. But it could just shut down and chop again. That has been the theme today.
That does have earnings coming later on Wednesday. That is Salesforce. So pretty massive company that we still have yet to hear from as far as their financial update goes. Then we will look at TD Cowen, who raised its price target on Boeing, which is also getting a nice lift today. Last but not least, a deal between XPeng as well as DD Global, which, if you could recall, Alex, when that name first debuted in terms of its public, in terms of the public market, it was one of these ones we discussed so heavily.
Do you look like a gingerbread man?
Fallen out of favor, but perhaps now being a benefit to a name like XPeng.
Yeah, not alone though. So many of the names that are U.S. listed, Chinese kind of based companies have had a rough last few years. So not unique, but certainly a little bit worse so than some of the others. But Jenny, I'm looking forward to talking Salesforce. You kind of forget that there's still some of these bigger names still lingering. You know, NVIDIA sucked up so much of the air last week. But we still got names like NVIDIA. Salesforce to keep things going here even into this week. So I'm excited for that as well. And then I was just talking Boeing with the fast market guys. So always a good chance to get back and talk more about the plane maker, Chicago-based or Chicagoland-based plane maker as well. So let's do upvote, downvote, not endorsements, not recommendations.
So we'll start things off here with Best Buy, and this name has been really anything but a good buy so far this year, at least in 2023. It's down about 9% year to date. Its earnings on Tuesday could be a turning point, although what we know from what we've heard from these earnings retailers specifically so far, that has not really been the case. Now, following a COVID-19 boom, we did see manufacturers and retailers alike that had too much inventory, which caused prices and the number of items sold to decline, thus squeezing their profit margins and their overall bottom line. So far, these strong reports have not done much for these consumer stocks this quarter, with companies in the sector actually beating estimates by 22%
a nice clean
as
cup
of
here.
August 18th. But the retail
Hasn't
overall
had any
fund
pullback.
falling still about 9% from its July peak. So we've seen this
At the
pullback
double bottom
in
and then
so
kind
many
of the break
these
of this
retail names,
trend.
despite some still strong beats and raises as far as their quarterly updates go. We are seeing this be the case with big names that saw pretty major declines last week. Macy's was one that was down over 20%. Dick's Sporting Goods down over 20%. So we will have to see how then, of course, Best Buy shapes up when they report. We are seeing earnings expected to be around $1.06 a share. We're also seeing first quarter sales expected at around $9.5 billion. So, Alex, it's been a very difficult retail environment. Although as far as the electronics go, we haven't really heard from a name that's super similar to Best Buy. So even though I'm listing out all these retailers that had pretty lackluster weeks last week, those are operating in a more discretionary, more apparel space. We'll have to see if Best Buy is able to buck this trend we've seen.
Yeah, and the trend recently has been a challenging demand market. So we'll see if that can change. But one thing to keep your eye on, year over year at least, some of these comps are starting to get a little bit easier, so you could see things like margins start to expand. But if demand was as challenged as some may think, that may have led to steeper discounting, which of course weighs on margins, so that's something to keep our eyes on. And then what was the theme last week? Of course, we know NVIDIA dominated the news cycle as well as Jerome Powell at the end of the week. But what was the biggest takeaway last week? Inventory shrink. So I'm going to be curious to see if Best Buy has anything to say about theft and inventory shrink, because seemingly that's the retail story.
I know I thought I was done saying shrinkage, but I guess we'll probably start discussing it when looking at the names. Now, our next name today is another one that does have earnings, although this name obviously operates into that consumer staple aspect of things, not less discretionary. That is JM Smucker, which is also seeing some weakness this year. It's down about 10% now on the year and down about 5% this month. Now, we are expecting to see a year-over-year top-line decline when it reports its first quarter earnings Tuesday, also before the bell. Now, Zacks is estimating revenues to be
try and hold till high of the day.
$1.8 billion. That would suggest around a 2%
And
decline
top of that
on a
channel,
year-over-year
maybe
basis.
444.
Well, bottom line is expected to grow ever so modestly in their first quarter. One thing that is important to note is we have seen the consensus estimate for bottom line remain unchanged in the last 30 days. So unlike a lot of its peers, actually, they have not been revised to the downside, which is actually being read as a positive, just given some of the weakness that has faced a lot of these staples names. They are also benefiting from their focus on some of these core priorities, including driving commercial excellence while reshaping its overall portfolio and streamlining its cost structure while really then I'd say mitigating some of their overall costs. They have been very focused on keeping their costs at bay, but we'll obviously have to see how well this was able to bode for them in the to-be reported quarter. But again, this name relatively lackluster. We are seeing, in terms of their earnings surprise, it's around 14% in the trailing 4 quarters. But again, just a name that doesn't trade with a ton of volatility given its staple nature.
Yeah, and watch the product mix, see if there's strength in categories like pet food, because if there are, that could be a higher margin, part of their business, and that could help their margins as well. So, going to paint us a different story than I think a name like Best Buy, but doesn't mean that they both can't be positive, potentially both negative. Inflation critical for some of these lower margin companies like these staples, of which Smucker's falls into. Next one on our list, though, is in this discount world, and we know that this has been a bright spot but I'm not so sure how much you can compare a Five Below, which admittedly I've never been to. I've seen them more often now driving around the city. Haven't stepped in one yet, but a little bit different than Dollar General, which is sort of more of a rural kind of grocery store to kind of oversimplify.
Yeah, and I would say the biggest difference is first of all, Five Below, it being the fact that it's not really a dollar store at all.
For a little handle now.
Actually, there's a section that's like $15 and below, so even Five Below isn't necessarily telling of the price point. But also, there's so many less of these stores. So Dollar General has around 16,000 locations in the U.S. Dollar Tree, including Family Dollar, has around 15,000. So they're two of the largest U.S. retailers as far as store footprint goes. Five Below is much, much, much smaller than that. So just in terms of their footprint, they're not distributing nearly as many items just across the country because they're so much smaller. They have also seen, though, a nice streak of beating earnings estimates.
A lot of volume spike up there. Looked like some stops getting triggered or something. That was crazy.
Its last reported quarter, they did beat consensus estimates. They also topped top and bottom line as far as the street had been expecting. They're now seeing their earnings are surprised at around 1.4%, so relatively smaller. But analysts have become increasingly bullish with actually seeing earnings revisions to the upside over the last 30 days in Five Below. I was shocked, though, to see the analysts that cover this name, Alex. I couldn't find a single bear. Of the 10 analysts that I was just looking at for a sample size, all 10 had buy or buy equal ratings with an average price target of $225 a share, which implies, I mean, back when I was looking at this, like $50 of upside from where we're currently trading. So they have pulled back this year. They are still up about 40% over the last 12 months, but have given back about 15% of their gains month to date. But all in all, a name that has been able to ride the retail storm quite well. Although I say this very hesitantly because if you looked at Dick's Sporting Goods, they were also doing quite well until their earnings. So we'll have to wait and see once we get this report. That is Wednesday, August 30th after the closing bell.
Yeah. And when you look at Five Below, it's always compared to the Dollar Generals and the Dollar Trees of the world, but it's just not Dollar General. It's just not the same type of company. You talked about store footprint. I'll talk about kind of where they're at in the map. You're much more likely to see a company like Five Below in a suburban area selling kind of discretionary items for a lower price. Dollar General is really serving rural marketplaces, and they're selling a lot of staples items. So there might be trade down effect, but it might be for different reasons and from different kind of demos in terms of geography. So it'd be something to watch. I'm excited for this one. Big part of the story might be a comp sales bounce back after drops last year. So looking forward to Five Below. Last one here on our list is Victoria's Secret. And so, you know, Jenny, one of the other themes of last week was that we talked about names like Gap stores and Guess. And I was starting thinking, those are to me, in Abercrombie and Fitch, those are stories about brands of yesterday.
Big GNS move tomorrow.
I may be crazy. Maybe Victoria's Secret's not that, but because it's in the mall and that's where you would see it.
Maybe.
Isn't it kind of the same?
Yes, 100% the same. It's even, you know, I have my own grievances with Victoria's Secret, but they even have had like, you know, documentary type scrutiny the same way an Abercrombie and Fitch has because of some rebranding and some of the issues with how they were treating their employees. So actually very similar to Abercrombie and Fitch. They're trying to undergo this facelift. Although if you look at the chart, it's easy to see this is not the same recovery story as we've seen in Abercrombie and Fitch shares. They're down 50% this year, and they're down 63% off their 52-week high. Now, Zacks is estimating their earnings to come in around 27 cents a share. That would indicate a decrease of around 75% from last year. Now, consensus marks for revenue have moved down about 6% year over year, but that's being pegged at around $1.43 billion. Results are expected to be negatively impacted by some pretty disappointing comparable sales that they have attributed to this more challenging environment. The estimate for comparable sales does hint at a decline of around 10%. On the flip side, though, consensus estimates for direct and North American sales is expected to rise, or excuse me, to imply a dip of around 9 and 11% respectively year over year. Now, one, I'd say bright spot as far as what the analysts are expecting, international sales, primarily driven by strong tailwind for them. So it will be interesting to see. We did mention in some of these Asia-driven sales in Abercrombie and Fitch. Guess is another name that does have some pretty sizable international exposure, and we know those were two of the retail winners last week. So we'll have to see if that bodes well for Victoria's Secret, but their chart looking a lot lot worse than a lot of these other retailers we've discussed, Alex.
Yeah, and all the comparisons we've made to those brands, and granted, I'm
Might average
aware that
in if
they're
we get more
very
of a
different
pullback.
in terms of what they're actually selling, but
like
if you're an
going
investor in
this
this,
early,
maybe you're feeling optimistic given some of that exposure to
78.6%
places like
right
China
there.
in particular being a strong point for some of those
23.6
other
rather.
companies. Maybe the same would happen for Victoria's Secret, but to me, this seems like a pretty critical time frame. There's so many names separating themselves from a winning and a losing standpoint right now in retail. Do you
never
want to
mind, it
be in
wasn't
the
quite
Dick's
that far.
Sporting Goods camp, the Foot Locker camp, or do you want to be alongside the names like Abercrombie and Fitch and even Guess of all companies as the outperformers? So that's going to be the biggest critical takeaway for me is which bucket do we put these in? Because that's the only way I can see to make sense of it all. There's just unlimited retailers in the publicly traded space.
Yeah, I would say you definitely want to follow at least whatever Abercrombie & Fitch and Guess. I still can't believe it, what Guess is doing, but we will leave it there. We'll be diving more into our two upvotes today, those being Best Buy as well as Five Below. We will be looking at some technicals as well as some example trades ahead of both of those earnings events. Stick around. Next Gen Investing. We'll be right back.
A little bit more of a pullback here. There's your 23.6. How's the deadline for buying? Is it? Oh, because XDivvy's on the 31st. D+2. Spy come down some more. Up and handles can always be double tops. I'm out of those calls. Wait for more of a pattern. Looks like, I mean, it could even pull it back down to VWAP potentially. Got a shoulder here. I was trying to catch the head, but the right shoulder.
Move higher. We know it's either going to go higher or go lower. It's a 50-50 proposition, and with that, this allows for us to have equal risk to equal reward in that kind of coin toss scenario. Nice thing too, you can flip this around, Jenny. If you're a little bit more bearish, you saw those technicals, you're a little bit less optimistic on this one, maybe a put vertical using similar strikes, buying a 74, selling a 72, for example, could be in play for a directionally bearish version of a similar strategy.
Yeah, like we always say, a very highly customizable example trade here, and of course easy to also change your expirations and strikes, like you said. Now to shift gears though and look at another name that does have earnings still on the horizon. That is Five Below, which is a discounter. And Alex has not been there. I've only been there a handful of times. So Rick, hopefully you have more expertise on having frequented Five Below, as well as of course the technical.
We'll add some more if you get a little right shoulder up here.
I have a lot of young nieces and nephews. It's a great place to buy Christmas presents or gifts for them. It's more geared toward younger folks here. And the chart is interesting
stuff that lasts for like 12 hours.
We can see that it's kind of a similar shape to our last chart, this symmetrical triangle type shape with our trend lines near those yearly highs and close to the yearly lows, but not quite at that level here. Now, the key difference in this chart is that we did have a downside breakout below that trend line, because it was extra important because that trend line roughly overlapped with our purple 252-day exponential moving average. So the longer term the moving average, the more significant it is if it is in fact breached here. And that is what happened. We had a 6.4% one-day drop. Met with some aggressive selling there. The next day, on Friday, we formed a Harami candle where the real body of our candle, the difference between the open and the close, was completely contained within the previous day's real body. So the opposite of a engulfing candle. So that's something that could signify a bit of a stall in this downtrend here. We're close to another volume node as well, near about the 177 level or so. So that's an area where you might expect to see consolidation. Once again, if you have a directional
stop on these, I haven't done any stops today, just
boundaries of
for whatever reason.
Node area. So
I was kind of waiting for that whole move down.
Our measure of momentum here. Once again, just above the oversold area. We had a dip below it recently, but we are hanging on above that threshold of 30 here. So look to see, once again, if we hang on or if we slip below it once again in coming days, that would be another bearish sign to watch out for. Support and resistance. A double bottom happened near the 165 mark. The actual low that we reached was 165.58 during that day in May there. You can see the second trough where it bottomed out there. That would be a support point to watch. The more times you have a price stop near the same level, the more significant it becomes. So the area around 165 to the downside looks like it could be worth watching. To the upside, our old support confluence and our 250 two-day EMA and our trend line right around the 184 mark, that now becomes a resistance point to watch out for. Old support can become new resistance and vice versa. So that could be an upside level to keep your eye on going forward, Alex and Jenny.
Right, Rick. I think really great breakdown on Five Below and, of course, Best Buy ahead of those earnings releases. We will leave it there. Rick Ducat, our chart master. So now I'm trading this name here, Alex, considering just a slightly different approach, looking to look at a more neutral to bullish example trade in Five Below, given the fact that obviously technically it looks different than Best Buy. Walk us through what you're thinking.
Yeah, I looked at something that could be seen as high probability, but also omnidirectional. We've looked at these strategies a ton of times, skewed put butterfly to the downside, in which we buy a debit spread, but we also sell a credit spread. Just happens to be, in this case, the credit spread's a little bit wider. The exact strikes we looked at was buying one of the 170 puts, selling two of the 167.5 puts, to buy one of the 160 puts to define the risk in the end. If we do that whole package for a 50-cent
climb
credit,
up a little bit.
it theoretically
VWAP's
removes
down
the upside risk. You can
now.
see that up here. This is a flat line at basically what would be $50 profit above all of our strikes, and this falling out of the money. It's going to perform a lot like a short put vertical in that moment. However, between our strikes, between 170 and 167.5 is where things get interesting in this strategy. As you can see, it upwardly slopes to a max possible profit of 300. You get that by looking at the $2.50 wide debit spread. Factor in the 50-cent credit, you get $3, which we know means 300 when it comes down to dollars and cents for a portfolio. 164.50 to the downside is the break even. After that is where the risk kicks in. 450, $7.50 wide spread, net of that $300 that we can make, leaves us with 450 in exposure. That takes place if all of these options are in the money. They go through assignment and exercise and offset for the maximum
How do you
value.
know?
That maximum value
When
is
does the flag end?
$7.50. If you take out our credit received and that debit spread working in our favor, you're left with 450. So when we look at this, Jenny, what I would think of this as is this is a neutral bullish strategy.
282 on GNS.
Get a downwards move right to 167.5. That's great. That's our best case scenario at expiration. But a trader who does this really would probably prefer either an unchanged or a slightly higher move. Allow these to potentially expire and just simply keep that credit.
And I think really well put in two different ways to look at earnings. As we do still have earnings events this week, I know earnings has dwindled, but still two names to keep on our radar. But also important to keep in mind for both of our example trades today. Multiple legs can lead to multiple transaction fees. Short options can be assigned at any time. And carrying option positions into expiration can add risk, like unanticipated exercise or assignment. Now coming up next, it's time for FOMO. We will dive into all things Salesforce as we did get some analyst news today, as well as earnings still ahead on Wednesday. We'll discuss more on that name coming up next.
I add to these calls at the same time. Scared that I should sell them. I like it though. I think we'll get a retest and maybe a breakout on this handle. We're right at that right little micro shoulder here. Shoulder. I'm not gonna add any because I only have like one more trade left anyways. On the upside, I don't think it's crazy from here. I think this upside was greater than what we'll probably get up here. This to 444. That's it. That's smaller than this move was. Still a tight range day and a pretty choppy day, more or less. This little up finally. Let's see. I think GME moves above 20 before earnings. No. Next question, Bob. Oh, 155. That's when all ball flags must break. Okay. And Julian.
Got a little something for this day trade. Well, that's another 33%. Pretty aggressive. I don't know if we'll make it up there today. Barbecue climbing up a little more. SPY coming down some. See if we get another bounce on this level.
And that's going to be another area where they might see a little bit of a boost in customer engagement. One of the things that we have seen since COVID is the cycle times or the refresh times when it comes to consumers has definitely slowed over the last couple of years. So they're thinking with having all of these new upgrades, as well as having different sizes available, like the 11-inch or 13-inch models, that could actually revitalize some of the iPad sales. Now, when we look at the last quarter, their iPad sales actually dropped about 20% on a year-over-year basis, but it's only around 7% of total sales. And that may sound a little bit small, Jenny, but at the end of the day, it's still about $5.8 billion when it comes to sales here. So let's see if they're going to be able to try to revitalize the iPad market, trying to have somewhat of a user experience similar to utilizing a phone, while also leveraging the Magic Keyboard to give a laptop experience here in the near future.
Yeah, and Kevin, I mean, I do think 7% sounds small, but then when you look at the rest of their sort of revenue and the way that they derive their money, I mean, it's such a massive company that 7% in context is so massive to me. But walk us through sort of what we can expect here from the next couple of weeks for Apple, because we do see this being more of a long-term story from Bloomberg, like you laid out. But of course, iPhone is still dominant. It's still around 50% of their overall revenue. So what can we expect from this highly awaited iPhone 15 launch?
Yeah, well, a lot of analysts are really focusing on these like recycle times. And when we kind of talk about that, that just means customers really updating the phones that they already have. And once again, we've seen that really elongate over since COVID-19 here. And right now it's sitting at around 2 to 2.5 years. They'd like to see that refresh cycle at around 1.5 years, because that means that it's going to be able to drive further sales. So I think that's where we're going to really be focusing on, as well as trying to figure out the manufacturing processes, as well as the delivery mechanisms when it comes to the iPhone. We know that Foxconn and some of the other providers for Apple have had some issues when it comes to not only the supply chain, but the manufacturing process, which could then lead to having lower supplies and higher prices. And that's really not what customers want to see. But you know, as well as I do, there's a lot of customers that are just diehard Apple fans. So no matter what the price is, they're probably going to see a little bit of interest, especially as it just rolls out.
Yeah, and Kevin, I just know from having an iPhone 11, I believe, that I am definitely due, but I will not mind waiting and not being part of like the whole frenzy to initially get one. I've waited 4 years. I can wait another couple of months, but we will leave it there. Appreciate the breakdown on, of course, a very important name to the overall market. That is all things Apple. Kevin Green, Senior Markets Correspondent for the network. Now I'd like to bring back in Alex, and it's time for FOMO. So we are talking all things Salesforce, as I do have earnings still on Wednesday after the closing bell. And Alex, I could not help but notice in some of the video that we have
here
of
comes the SPY back up to the
is, I believe, the footage of the building that was supposed to be opened in Chicago, and it's been delayed, and of course the pandemic. But now they have like a major real estate problem because they just built this massive, beautiful building, and I've heard that like 3/4 of it is sitting completely empty.
Yeah, not unique to a company like Salesforce. I think it's just a general trend that we've seen, particularly in, I guess, let's call it office jobs. As there's been concepts been proven.
Oh,
you
yeah,
can
it is.
go to work from home. You can work remotely. Many people made decisions to
Little
kind of
bit.
alter where they live. Maybe they move further away from city centers or places
some
where office
volume
buildings
there.
are, and found, limited differences in productivity. That's an argument we can have at a different time. I think we all have opinions on that.
Nice entry.
But when it comes down to Salesforce, I think the story has been declining growth. This has always been a company that seemingly
It's not even
buys
right.
its way into
Go
growth
EV is
as
switching
well.
CFOs.
It's kind of
That's
been
great news.
a serial acquirer of other
Fire one is
companies.
probably awful.
But more importantly, what stuck out to me as well is about 2/3 of its revenue is actually from the U.S. So unlike companies that we've been talking about where China's a significant portion, China's only 10% or a little bit less than 10% of its revenue. So going to be focused on margin, going to be focused on that trajectory lower in terms of growth. But we're talking growth still, and I think that's still a positive.
Yeah, and I would say that the bar has been put slightly lower into Salesforce's earnings. We have seen some pretty negative trends that have weighed on the stock over the last year. Still, as you can see there from the daily chart, still a relatively strong uptrend, but we have seen this demand environment and possibly some of these trends in sales potentially stabilize here, and that's the hope, I'd say, for those bulls of Salesforce into their second quarter print. The estimated bar is relatively low, just given enough of these negatives we've seen in overall business trends as well as bookings performance that's been detected. But all in all, the Marketing Cloud customer survey as well as setups and read-throughs for the company's data analysis now shows this company actually seeing modest upside to consensus estimates, at least from what the street is expecting. So street expects this name to slightly outperform while not posting a huge beat. Subscription revenue is supposed to be another bright spot as well as its operating margin now in the second quarter. Now, second quarter revenues are being expected at around $8.2 billion roughly. That would signal 10% growth on a year-over-year basis and around $1.90 in their adjusted earnings. Now, what I was reading as far as this analyst out of Oppenheimer, the company checks showing some upbeat demand and performance from Salesforce, potentially stabilizing trends as well as their better pipeline momentum and stability and their overall operations. So basically what the thought is that they've seen some volatility for now what's been the better part of the last 2 years. They'll finally start to see some more normalizing trends. However, this name, it moves, and it moves on the back of earnings. We've seen some weakness as of this month. Of course, that's not a Salesforce-specific story. I was also reading a note today out of Citi that did lower their price target on Salesforce to $220 a share. That's down from $230 with a neutral rating. The analyst does not see risk to the company's guidance, they said, but does expect some upside to be more constrained. So the firm says Salesforce's sales growth trends remain pressured amid some of these renewal risks heading into the fourth quarter, as well as their fiscal 2024, and expectations on their margin expansion have already largely played out. So very similar sentiment to me, as it seems like the street is expecting some upside, while to remain relatively muted, Alex, just for given the fact that this company is exposed to so many of these different tech headwinds we've already discussed throughout the quarter.
Yeah, we got 3 different analyst updates today, or rather 4 today, not including Citi. We got 3. The other 3 are all buy or buy equivalent ratings with price targets ranging from 240 to 250, being Jefferies, Wedbush, and Macquarie. And so compare that to Citi, 220. Those are all pretty optimistic price targets. I only see one sell or underperform equivalent rating on the street, and it's from Bernstein with a 153 price target from a couple days ago. On Friday, we got that. So still 7 in 10 or nearly 7 in 10 of analysts on the street like this name. It was a stalwart for a long time through kind of pre-COVID, post-COVID, during COVID. But it's hit a rough patch, and it's been sort of a storm investors are going to have to have weathered if they're still involved in this name recently, but off the lows, working its way back. And like you said, a lot hinging on earnings. This is one that has a history of moving pretty viciously post-earnings in both directions.
It does, and I would say what helps is we've already seen a pretty significant pullback for this month, so we're a little bit now, I would say, positioned more on sale than we were at the beginning of August, just given the collective weakness we've seen in so many of these tech-exposed names. But walk us through what you're thinking now as far as an example trade, looking to lean into some of the price activity we've seen as of late, or just you think that things could maybe have hit a bottom and we stand to benefit from that?
So the thought process here was, look, it's hard to determine where stocks are going to go. It's even harder to determine where they're going to go post earnings. And so, as a trader, we have a couple things that we can do. At order entry, we can control our risk. We can decide how much money we want to have invested in a trade.
I have an RSI
and what type of
divergence on the
strategy
hourly.
we're going to select in terms of managing through risk definition our total
Really?
exposure. But also, we can control, theoretically, kind of our probability of success using some of these option strategies. And we can do something like selling a put vertical below the market, Jenny, that allows for the trader to profit in several scenarios in order to increase the likelihood that they are profitable altogether. And so that's what we've done here. We're going out to September 15th, so it is it is 2 weeks from Friday, so let's call it 2.5 weeks away from now. But we're selling a 202.5 200 put vertical for 75 cents. That's about, let's call it a third, a little bit less than 1/3 the width of the strikes. You're risking $175 to make 75 on a neutral to bullish strategy. We have a break even of 201.75. Well, right now in real time, I'm looking at Salesforce. It's trading for 211.60. Granted, there's an earnings event on the horizon. There's a chance this stock goes sizably lower, but there's also several scenarios where this particular strategy, or one like it, be it in Salesforce or another name, could be profitable even if it's not right in terms of its direction. The stock could go down lower. That's still a profitable situation as long as it doesn't go below 202.5. It can stay right where it is. That's still a profitable situation. And of course, it can move higher. And so rather than comparing to just owning stock shares where penny for penny in every direction you're exposed, this allows the trader to, one, control the risk, but also to some extent influence the probability that they're going to be successful in the trade. I don't know what's going to happen in Salesforce. It very well could move lower, but even in that event, we know the total risk going in, and we know the exposure that this trade would have in the event that this stock moved. And whether it goes to 200 or 150, that risk remains the same. So it also protects you from sort of that black swan, catastrophic crash-like move if that's something that happens.
Yeah, and I think obviously you made a really good point, and it's difficult to pinpoint the moves in these names. It's better to just be prepared, obviously, in both directions, as that has been the theme we've seen over the last several weeks, outsized moves, whether it's to the upside or, of course, the downside following these earnings that are really all over the place. I couldn't even say necessarily we've seen consistent beats or misses, just a lot of volatile swings post those results. But we will leave it there for our FOMO segment. Now, coming up next, it's time to look at Boeing, which is making a nice move higher today. We got some analyst news to discuss, what's driving shares higher, and of course, their exposure to China and 737 MAXs. We'll discuss that with Renita Young coming up next.
It's the end of the flag as we know it. It's the end of the flag as we know it. Nice breakout. Up in there.
1.5% move to the upside. I think it's worth covering.
Absolutely, it's worth covering, and it's because Boeing has had a pretty hard life over the past 4 years, ever since the MAX 737 was brought to a global halt, right? Deliveries. But much of the world has resumed deliveries. China hasn't, though. However, the news that China will is positive for the stock. That's the word from TD Cowen, who raised Boeing's price target to $260 a share from $255. That's around a 15% move to the upside. The analyst also kept an outperform rating. They're saying that this China delivery restart of the MAX 737 and that upcoming update on the 737 MAX, those together offer upside to the stock, given that dip that Boeing has had from its recent peak. Right now, it's up around 19%. Year to date. Now, meanwhile, this restarting of the MAX 737 deliveries to China after this 4-year hiatus that we learned about on Friday, it is, of course, positive by several analysts who are talking about it. And just to remind folks, back in 2019, it was a global grounding after 2 fatal crashes of the 737 MAX planes, but much of the world, again, cleared this for flight. However, it's been caught up in a U.S.-China trade tension spat ever since most of the world has cleared the MAX 737 for flight, and the fact that these couple of planes have been readied for delivery to China is pretty positive for this stock. So that's what folks are trading on today.
Yeah, Renita, it seems that this is a name that ebbs and flows with the news cycle. And of course, this latest news item, as you discussed, with the resumption of deliveries to China. We're seeing the upswing here, and it's continuing from last week as analysts kind of pile on. Anything else to note as we kind of wrap this story? I think it's pretty straightforward. The marketplace is open back up. That should benefit a company that sells some pretty expensive items.
It would be expected to benefit, of course, but we still have to remember about that U.S.-China trade spat that's happening that could complicate things if the folks who are at the negotiation tables are not able to meet at meetings of the minds.
Yeah, Renee, I think a really good point. And of course, we'll be keeping this on our radar, as Boeing is one that we are frequently looking at because there's always headlines regarding one of their various aircrafts, of course, in particular, the 737 MAX. We will leave it there. Really great breakdown. Renita Young, senior markets correspondent for the network. Now, coming up next, we're going to look at another name that's making a nice move to the upside today. That is all things XPeng, as we did see a potential partnership with DiDi as well as BYD. This name's been busy over the weekend. We'll discuss those headlines more with George Tillis coming up next.
Going back to VWAP, there's 50%. Good. Nice deep dig for that handle. GNS doesn't know that song about the end of the bull flag, I don't think. DFS is moving up there. Back to VWAP. Alright, I'm out of these. I think we're getting it. Up on 2 o'clock. Buying around VWAP. We are. Oh, the cup ended up being a double top. I've got back in the range, back in the chop. See if we retest the low, see if we actually fill that gap now. MACD flip back bearish, right under the 9. Too excited for that handle. Just gave back all the gains from this call trade. He just set a stop. Beautiful. Thanks, psych you up. That's why I don't like opening around VWAP. We'll see. Too late into the day for me to get whipsawed. I considered flipping my calls to puts too at the top. Yeah, didn't do. Seemed
too aggressive, too greedy. You don't usually get a trade where you sell the call is the best time to buy a put, vice versa. Usually not quite that straightforward or simple. You get some chop, you get some up and down, you get... Yes, GNS. It knew the flag. It knew the song. It knew it.
It's going to be, you know, far away from the high price from a couple weeks ago, but I think it might provide some trending support. If it breaks below that, at least on 2 consecutive weeks, then maybe the trend to the upside is over.
And so, George, when looking at this name and sort of its near-term future now with this DD partnership, I mean, is there any concern that they're acquiring like a failing company? Because I know from watching DD for the better part of the last several years, it's not exactly like this name is crushing it. They first went public, and then we saw some mixed feedback. This name has had crazy levels of debt. I mean, so what does this mean now for XPEV?
5 fleshy candle there.
Yeah, I don't necessarily think that the purchase of this EV division is a challenge for XPEV. In fact, I think it's going to be accretive to their business.
Brokerage with
I think that's just maybe why the market's reacted positively. I know DD has had their problems. I know there was some listing concerns on the New York Stock Exchange, if I'm not mistaken, going back. Some questions about their financial viability. But if you look at their market share, they are the premier ride-hailing ecosystem in China. So again, you know, I think this is going to be boding well for XPEV because they have a strategic partner, and they need to improve their production scalability. They need to increase their volume because they are going to be selling at the lower price end of the market. So they need to improve their volume growth quite considerably.
Yeah, and I think that's a really good point. Obviously, we'll be keeping this one on our radar. George Tillis, we'll leave it there. Appreciate the breakdown, as always. New markets correspondent here for the network. That also does it for Alex and myself for Next Gen Investing for this Monday. Coming up next, we have the watch list with Nicole Petalides.
It's fine. Getting back to low of the day. I count. Because it's red, green, just like this chart. Get my entries and exits dialed. This was kind of a tricky day though, just with the chop. In hindsight, it's like, oh, the lows you can go long, the highs you can go short. But realistically, it would forward. GNS. Alright, see if there's enough momentum. Push through this gap fill now. Oh yeah, I think so. I think we will. I think we'll make it. We're gonna make it. 439. 50. Right here. To the support. Up on 2 o'clock. Come on, GNS. Last 3 times on the weekly on RAD. Like this week or last week, or what do you mean on the weekly candles? Got 7, 9, like 80 cents, 90 cents. Not sure what you're talking about. There's your flush, Bubba. I think you held through all this.
Oh man. No stops. No surrender. Closing one. 25%. Closing 25%. Got an inverse cup here now. Oh, that's right. Could be another just a triple bottom too. Anyway, this was a double top, or even a triple top actually. I think on the longer time frame though, they were kind of in this uptrend. I think we kind of broke out of. We started last week, just inside this bigger channel.
And last week was the first winning week in 4. Here's a look at the numbers. Right now, we're seeing the Dow Jones Industrial Average up 123 points. As I noted, last week was a winning week. The S&P and NASDAQ posted the first winning week in 4 weeks. And I will say, even though it was a winning week, August has been a relatively tough month. In fact, this could be our first down month and the worst month, I should say the worst month since last December for the S&P and NASDAQ, and they could be snapping 5 months of gains. The S&P right now is up 0.25% at 4417. The NASDAQ 100 up 0.25%. The Dow gaining 1/3 of 1%, and small caps, Russell up 0.75%. Just for a quick check, the VIX at 1550, so a little bit lower today. And that's why you see some green arrows. In the meantime, I want to get to some top stories. Joining me right now here with a top story and a name that will actually be reporting its earnings this week, and that is CrowdStrike. Caroline Woods joining me to tell me about a downgrade, though, for this name, right?
Yeah, shares of CrowdStrike under pressure today. You talked about it being a tough August. It's definitely been a tough August for CrowdStrike. Shares off about 11.5% so far this month, and down another 4.5% today as Morgan Stanley turns cautious on CrowdStrike heading into earnings. And of course, reports on Wednesday. Ahead of that, Morgan Stanley downgraded shares to equal weight from overweight with a price target of $167. That's down from $178. So just to put into perspective, currently trading around 143.
Yep, GNS new high today.
So still some upside, but not
Negative
quite
70%
as
to
much.
plus 29.
This analyst thinks expectations heading into earnings might just be a little bit too high. Says consensus estimates for a second half of 2023 and 2024 rebound appear high in light of a more difficult demand environment. What we've been hearing from so many tech companies.
Yeah.
In fact, this analyst thinks another cut to consensus annual recurring revenue estimates seems likely. So look out for guidance there. Morgan Stanley says the stock's risk reward seems more balanced at this point. I will say this analyst is in the minority. If you take a look at the breakdown, 40 analysts have a buy rating, only 6 have a hold rating,
Same thing I did up
including
here,
Morgan
but
Stanley now with the equal weight, and
just
not a
didn't
single
have a
sell
stop
rating.
set up.
So still quite a bit of bullishness on the street. The median
Yeah.
price target 180 heading into the report.
I see all the names are down. Fortinet, Zscaler, Palo Alto, the whole cybersecurity group has a down arrow today, right? Where most of tech has an up arrow. So this group may be, in sympathy, who knows? In the meantime, I wanted to turn everyone's attention over to jobs. And we'll have JOLTS this week and the monthly jobs report. But the holiday shopping season is upon us, and you're looking at Bath and Body Works.
I know, I always
Bath and
confuse
Body
those.
Works is a name and could be some hiring.
Yes. So unlike CrowdStrike, which has seen a 36% year-to-date gain despite the down month that it's had, Bath & Body Works has had a different story. It's down about 16% year-to-date. It's down about 4% so far in August with just a few days left, but it's a winner today. It's up about 2% today on the heels of this news that it's actually going to do some seasonal hiring ahead of the holidays. It said it's looking to hire 30,000 seasonal sales associates for the holidays. Applications go live tomorrow, and associates will have until October 29th to apply for the seasonal positions. And actually, there might be some opportunities for those seasonal positions to translate into full-time positions. So it could be good news for those people who are looking for work. In addition, they're going to hire about 2,500 employees for their 4 distribution centers in Ohio, with wages ranging from $18.25 to $23.50 an hour. So seems to be giving shares a boost today. Thought it kind of fit into the theme of jobs. I mentioned we have JOLTS on Tuesday. We have ADP for a look at the private sector on Wednesday. And then, of course, we have the big August jobs report on Friday. So really going to be a key theme this week.
Yeah, and I wonder if this really is a sign of what's to come for the holidays. I mean, even if people are spending less or they're being more selective on how they spend, you're going to have seasonal workers to, you know, field the people that are inside the stores.
Yeah, for what they hope will be strong demand for soaps and fragrances and candles and whatnot.
And pretty much everything. I was hearing from, I think it was the Abercrombie & Fitch CEO, but saying how Hollister, for example, the younger folks, the teenagers that were going into the malls, it turns out they had a lot, they would search online, but then they would come in person and do the shopping. So you need the staff to field.
I think that's because Abercrombie charges for shipping and returns, from my experience.
See?
So if you do that, you want to just go to the store.
All right, so there you have it. All right, thank you for that, Caroline Woods. And let's continue with the bigger picture. Sam Stovall, Chief Investment Strategist at CFRA. Good to see you, Sam. Last week we did hear from Jay Powell. We got a completely different vibe. Last year the market really got hit hard after he spoke and said to everybody that they could expect a lot of pain to come. This week was a little different, wasn't it? How are you feeling?
Hey, Nicole, good to talk to you as always. Well, I think I and the rest of the market are feeling a little bit better. Yes, he did sound a little bit hawkish with his comments on Friday, but I think investors are feeling good because he was also implying that maybe the risks are still balanced, maybe that there could be one more hike, and that the real concern is that they will keep the rates elevated for longer. And I think that's because inflation itself will likely to stay higher for longer. We don't forecast the core PCE on a year-over-year basis to hit the Fed's target until at least the end of 2024. But still, with the rate hikes likely behind us, I think investors are breathing a sigh of relief.
Understood. So with that now, you know, people still talk about recession, soft landing, or even maybe some cuts from the Fed next year. You know, how do you think investors could go about positioning themselves? I know there's different case scenarios, but is there a most likely scenario?
Well, you know, I'm a follower of history. I like to say that history is a great guide, but it's never gospel. So I think that once we get past this uncertain, this choppy third quarter, that we do have a lot to look forward to. The holiday hop, not drop, is typically seen in this pre-election year. And then an interesting stat is that the election year performance for the S&P 500 since World War II for all first-term presidents up for re-election has been positive. Not a guarantee, obviously, but certainly a fairly comforting statistic. So I would tend to say that unless we do end up with a recession, which is not something we are anticipating, yes, you can see on this chart that September is the worst month of the year for the S&P 500, also the worst month for the NASDAQ composite, and it's the only year in which the S&P has fallen more frequently than it has risen. So we have to get September out of the way. October is typically fairly volatile, 35% more volatility than the other 11 months of the year on average. So once we get through this choppy period, I think investors will be pleased with the returns that they get.
Right. How did you feel about earnings season? I mean, do you think it was relatively good? But there was some concern about guidance, particularly for revenue guidance, and that's something that left folks a little worried.
Hi there.
Well, when you look to earnings, revenues, profit margins for this second quarter, the actual numbers beat the end of quarter estimates. Surprise, surprise. This is now the 55th out of the last 57 quarters in which actual results exceeded end of quarter estimates because management has done such a good job managing expectations. Now what we're looking for is the potential for a positive 2023 on an earnings perspective year on year. Now the third quarter is expected to be off by only 0.5%. Fourth quarter up close to 8%, and then a 12% jump in 2024. So prices lead fundamentals, and right now it looks as if fundamentals are slowly on the ascent.
I wanted to just touch, you had the best S&P industries and the worst sub-industries. Any thoughts or takeaways? I know that they don't necessarily mean that's the future, but it is always interesting to take a look at those.
Sure. Well, looking at those groups in the month of September, what I did was I went back to 1995, as far back as S&P has sub-industry level data. And really 60% of the sub-industries underperformed the market in that period. The best performers, however, were footwear and household products, outperforming the market 71% of the time in those 28 years. Life and health insurance were also good, along with healthcare distributors and distillers and vintners. Yeah, I guess when the going gets tough, the tough go eating, smoking, and drinking. So basically, a hodgepodge of groups that have done fairly well, whereas on the flip side, we see that such groups as paper and plastic packaging, household appliances, and commercial printing beat the market less than 1 out of 3 times.
Right, understood. In the meantime, when you look at the market, you see a slightly stronger dollar these days. Rates are creeping up again. Last Monday, tech did well and rates were higher. It was almost unusual to see something like that. Any takeaways for some of the way something, oil's back above $80, Bitcoin's had a very tough go of it. Any of these are flags to you, or are you just waiting on more economic data like the Fed?
Well, I think you hit the nail on the head as it relates to the Fed, because interest rates are really what's causing this market to experience a lot of cross currents, undertows, whatever water reference you want to make, because things are very choppy because of the concern regarding interest rates. And with the 10-year yield flirting at about 4.25%, that too is something that's causing investors to have concern, because there is no alternative has gone away, that there are lots of alternatives with 30-year above 5%, 5%, I mean, the 2-year above 5%, and the 30-year attractive as well, that investors are now saying, you know what, maybe I'll just seek the safety of longer treasuries and get a nice return on my money. So I think on a day-to-day basis, things are going to look uncertain, but I think longer term, the trajectory for equities has superior potential than that of fixed income.
Yeah, and I always appreciate the historical data that you bring to us, Sam, whether it's for sectors and groups, or, during a presidential election year, or, what side of Congress is for what, group. You always have the different scenarios, and here we go, right? We're getting ready for a big year ahead. So thank you so much. We look forward to speaking to you again soon. Sam Stovall, FCFRA. Thank you. Up next, we'll get a trio of stock picks for you, including Lowe's, and our next guest will tell us why. Stay with us.
Platforming cup and handle? No. I mean, maybe we have a drop. It could be flattened out. Little bear flag. $55 we popped off. Not much of a breakout on GNS.
I mean, it's a stock I've loved for almost 3 years now. I mean, I was pounding the table way back in October of 2020, saying people should own it, and it's still, it's still the stalwart and the class of the field in that area in the energy sector. Number one, number two, it just seems to me that the Saudis are determined to keep interest rates to keep oil prices higher, and they only need West Texas Intermediate above $60 to make a real nice profit, and it's still trading at less than 12 times earnings. They still have a nice dividend yield. I think it's almost 4%. So this is, I still think it's a good play. It's not the sexiest name in the world, but it's a good one to have in your portfolio for the long term.
And then a name like Eli Lilly was a name that you liked, but you don't want to chase it, and you're turning your attention back to another, long-standing name, and that is Johnson & Johnson.
Yeah, I mean, Eli Lilly, with this 25% rally in 3 weeks, that's great. But this is not a technology stock, and I do realize that these drug stocks can see a big move, and weight loss is a big deal. But the stock is now trading at 58 times earnings. It basically doesn't give you much of a dividend yield; it's less than 1%. And I just think there's a little bit of euphoria in this name, and on a technical basis, it's getting quite overbought. It's a great long-term hold. I'm not saying people should sell it. I'm just saying it's not one I want to chase here. And I'm looking at Johnson & Johnson, which, obviously this whole baby powder or talcum powder issue is not fully behind them, but they are making very good progress in getting that and pushing that, getting a settlement completely done and getting that behind them. And at 15 times earnings and a nice dividend yield of 3%, I think that's a better play right now. Even though there's more risk involved in Johnson & Johnson than there has been in a long, long time, but those risks are starting to abate.
On Sam Stovall, who I'm sure you know, he was talking about just some of the outlooks from some of these companies. And then we did have a better than expected earnings season in some ways. I know you were concerned about some of the revenue guidance going forward. He seemed that a lot of the companies seemed to at least somewhat optimistic about 2024. If there are dips in the S&P 500, for example, or the triple Qs, or would you say those are buying opportunities?
Well, I think they will be, but I think we've also seen that it's not every little dip was a great buying opportunity until August. And we've seen now that we've a little bit of a change in trend where people have been selling the rallies rather than buying the smaller dips. So I do think it will be, we will get a great opportunity to buy the QQQs or others with a bigger dip later in this kind of September, October timeframe. But I think, we might even get a full 10% correction in the S&P before that happens. But again, with people, if you have a little bit of cash on the sidelines, I'm not saying raise a lot, but if you have a little bit, you can take advantage of that kind of dip and look for the usual year-end rally.
Right, understood. Matt Maley, thank you. Miller Tabak and Company, founder of the Maley Report. Thanks, Matt. All right, still ahead in the second half of our show. Artificial intelligence made.
This is looking more bearish on this inverse cup, even though it hasn't really come down much for a handle. It's not fully reversed at this point, but really just consolidating down here. 30 minutes to power hour. Not sure if we'll get the move today into this range. I think we could tomorrow though. Doesn't happen today. The extended hours. Sorry.
York Stock Exchange. 90 minutes left in the trading day after a winning week. It was a rare winning week last week. Let's check out where we stand right now. You are seeing some up arrows today ahead of a very busy week ahead for economic data. The S&P is up a third of 1%. In fact, all three of the major averages are up 1/3 of 1%. The Russell's up 3/4 of 1%. But I think there's a lot of wait and see. You have housing data, but a lot of jobs data, GDP, PCE for inflation, which the Fed will be watching closely too. All of these are important. Joining me right now, Penn Lichtenstein, Senior Futures Contributor with a market update. What are you watching? 90 minutes left in the trading day. We finally got a winning week last week after a very tough August. Your thoughts?
Well, I'm watching green arrows across the board here, Nicole, but I'd have to agree with you, very much in a wait-and-see mode after Fed Chair Jerome Powell's comments on Friday, dust settling from Jackson Hole, the symposium, and market reaction, too. We saw a strong rally Friday and really just continuation of that pattern throughout the day today. We saw a strong bid right out of the gate on the open. The SPX rallied up to, what was it, 44.38. We saw the NASDAQ up to 15,086. The Dow up to 34,652. You're talking about 600 points off the low that we saw on Friday. So a significant move up in large caps, and the Russell as well, which has been leading for the most part percentage-wise here today. Up over 0.75% right now. It traded up to 1877, but we've kind of sold back off to the highs that we saw on Friday. So giving back some of the gains that we saw earlier this morning, but still holding those levels that we established into the end of the week. Taking a look at where we are as we begin the week relative to last week's highs and lows. So again, a move off the lows from last week. We rallied up and for the most part been relatively contained here today. The S&P, as I mentioned, up to 44.38. That was the SPX. We're actually looking at futures right now at 44.32, up on the day by about 0.4%. But speaking of contained, you can see basically since the, middle of August here into the second, or throughout the second half of August, we've been in a bit of a range. We'll call it 4,500, above 43.50, but not a lot of conviction one way or the other after selling off the highs for the year. Here's that high from last month in July. We topped out at 46.34.50. I want to show you where we are. Again, kind of just speaking to that contained sort of aspect in terms of describing price activity as we head into the beginning of the week. You can see we've just been somewhat overlapping and rotational after breaking down below the 50-day moving average. We're still holding well above it. A busy week to come, though, right, Nicole? You mentioned the waiting. It's always the hardest part, right? You've got the JOLTS number tomorrow. We've got some housing data as well. We'll get a look at some of the other smaller employment reports throughout the week, but the big kahuna is going to be on Friday. That's the non-farm payrolls, obviously personal income and spending, the inflation data tied to all of this. Definitely what the Fed's going to be watching as we head into the end of the month and beginning of September. Yeah, that's the whole thing. And treasuries, what are you looking at there? Because I saw the 2-year near 2-month highs. Big time. I'm glad you asked, because I think that's where the attention is. It seems like over the last few weeks, it's really been more on the longer dated, a shift from what we had been seeing like into this spring, and the 10-year and the 30-year really took the focal point, right, as we rallied up into 16-year highs, and ultimately the impact we've seen on yields, or I should say treasury mortgages, I meant to say. But now I think the focus might be a little bit more on the shorter end, as we've seen, look at this, the 2-year up and through 5%. It begins the week above that level. And this is kind of one of those close to the edge, sort of dangerously uncomfortable areas where investors don't want to see this shorter end, because oftentimes it is the shorter end that leads more closely tied to the Fed. And an example of how we're seeing that pushback on cut expectations and just sort of more acceptance of that higher for longer narrative. Speaking of higher for longer, this is where that focus had been, right? We're looking at weekly candles now. So going all the way back to the fall of 2020, the big move up we've seen in the longer dated 30-year on the left from 1.5% up to near 4.5%. Taking a look at the 10-year on the right, we've gone from below 1% in that period. Again, we're going back to beginning of 2021 here, all the way up to 4.5% or just shy of. So definitely keeping an eye on that. And lastly, because that, oftentimes will bolster the U.S. dollar. That creates a headwind for stocks. I kind of feel like it's wash, rinse, repeat. Ultimately, inflationary pressures, higher wages in a strong labor market. I mean, the Fed definitely has a lot to deal with. I think that was what Powell's message he was trying to communicate on Friday here is the job's not done, and hold on to your hats as we continue this ride that we're on. Could be some more bumps along the road that he told us we were going to be traveling down here.
Yeah. All right. Ben Lichtenstein. We're going to watch all of that. Thank you so much. Great to see you. All right, let's turn our attention over to a hot topic, and that is AI, and discuss some of the areas of the market using that technology right now. And of course, it'll be sector to sector where we continue to see growth. And Dr. Uri Yerushalmi is with us, Chief AI at Fetcher, to explain more. Thank you for being with us. So Fetcher, an Israeli company working in the world of AI. You have a lot of customers. Tell us a little more about it.
Well, we are a generative AI company. We produce tools for automated micro decision making in enterprises. Our product is it's based on a unique large market model that has a deep grasp of market dynamics and accurately can forecast demand and market trends. And based on that large market model predictions, our system offers micro decision making for enterprises, like having accurate pricing or having inventory allocation that is very unique and accurate. And once these decisions are established, they're seamlessly and automatically published through the enterprise systems, leading to improved performance and invaluable ability for the business to have a throughput of optimal real-time business decisions.
So at this point, you're able to do the forecasting on demand and what inventories companies may or may not need, things like that. Where are you seeing some of the most demand for what you provide? I know you recently had a deal with Virgin Atlantic. We could talk about airlines, for example, but I am curious where, I'm sure you're needed in every industry, but tell us where you're seeing some of the deals and work lately.
Yeah, we saw a big demand in the airline sector. So we somehow began our journey working primarily with the airline sector. As of now, as you said, the notable clients that are benefiting from our system include Azur Airlines in South America and Virgin Atlantic in Europe. However, we are examining these days branching into other sectors like the financial one.
Oh, so tell me more about that.
Well, in the financial sector, we can see the field of trading and algorithmic trading, a fascinating field that we've seen through the last decades, the rise of it. And currently, we've witnessed an arms race where there is a race for three types of resources: for speed, for having signals, and having a depth of the analysis. And once a trading company has access to all of these resources, it can exceed any human capability. So in the essence of having the depth of that analysis is, for us, is having the ability of identifying hidden structures. So thanks to our experience in analysis of diverse markets, we possess a special advantage, enabling us to deliver richer depth of analysis to the clients.
I see Google Cloud, HubSpot, we mentioned Virgin Atlantic and Fair Azul, some of your notable partners. There always is concern how AI could affect jobs going forward. You know, I'm curious about your thought on that. And are you worried about certain jobs being eliminated? In the meantime, you know, you're turning, you know, old problems into real solutions using AI at this point, right?
Yes, the issue of jobs, we see the AI as a tool that empowers the business, empowers the employees. So we don't see the AI competing with the humans in the enterprises, but a tool that empowers them in some sense. And especially it's something that is very apparent in legacy industries that have their special nuances with the personnel in these industries. And AI is a very good tool for these industries to go to the next stage and to the next level in their performance.
Right, understood. It's great to see you. Dr. Uri Yerushalmi, thank you so much, of Fetcher. Thank you very much. Still ahead, we'll bring in our panel to discuss those travel stocks. Summer comes to a close. Travel demand, what we need to know for the fall and winter months ahead, coming up.
You could think getting commission-free trades is as good as it gets, but you know better. At Schwab, free means more. You get commission-free online trades and quality trade executions on our powerful platform. Plus the satisfaction guarantee.
Yeah, GNS making new highs there. Grind up still, 64% on it. High bounced off the low. Cup. Double top. Inverse cup turned to a double bottom. And that's consolidation. We are starting to weaken on this bullish uptrend we made though last week, so kind of broke out of that support. Well, slightly more bearish for tomorrow, at least maybe back to the bottom of this channel. See if we break through it. GME's kind of melted down ever since that $18 high. Barbecue down 5.6. Down 8.8. Friday's up 20%. Minutes of power hour. This has been a big move on GNS. Look at the daily. This was a huge gap up. Big rip. Pulled out one day before. Hawaiian climbing back up to the high of the day.
Travel this fall.
I think you make a great point. I know plenty of people that have traveled to plenty of places for some great football games. I never really thought of that way. I mean, I'm always thinking regular folks or business travel. Jed, tell me more about the normalization of travel and how much do you think the business traveler, and sometimes I know that they've been doing more where they combine a business trip and a leisure trip. That's been a new trend. Investor sentiment actually improved a little last week. Tell me a little bit about this normalization and how even, I guess, we might see higher unemployment. Are people going to have money to travel?
Yeah, I mean, I think what you've typically seen, right, is travel historically has grown about 1.5 times global GDP. We expect that to continue. Travel's also benefiting from the, we still have that shift from goods to services, that normalization where I think pre-COVID, it was about, I think, 69% to the services. So there's still a little headway for travel to make up there. But I just think if you just look at the year-to-year trends, you're now, listen, like, I mean, I think RevPAR is going to probably grow 2%. That's typically what it would grow. So now it's not just, last 4 years or 3 years all been about, certain data points or if a vaccine got approved. Now it's getting more into company specific, right? What company is executing against a favorable backdrop. I mean, travel before COVID was growing much faster than, goods and GDP. We expect that to continue. And they're just millennials prefer experiences.
Yeah, you did mention the B2B partnerships with MasterCard and Walmart. Just quickly, could you just give me a few seconds on that, Jed?
Expedia's B2B with MasterCard, Walmart. Yeah, I mean, I think they're B2B. What that does is that's another way for Expedia to bring customers into the funnel. It requires less marketing, and it gives you actually better revenue visibility. And the most important thing, too, is about Expedia's B2B business is it gets you away from some of those Google competition, Google headwinds, right? Because they're not paying for that traffic. So it's actually better that piece of the business should equate to better financial visibility.
Yeah, and a lot of people are putting stuff on the business card or on their credit card, I should say, and they'll, take their trip and pay for it later, Dan, right? And that's okay too, as long as you can pay for it later. I know you have a lot of these great names in your BEDS ETF. Quick thought on the consumer.
No, it's very true. And, like I said, a lot of people do go straight to the hotels to work the point systems. And a lot of those are on cards. Marriott, American Airlines, Hilton, they all have co-branded credit cards that a lot of people use. I just want to reiterate the point that we think this fall is going to be the true return to business travel. COVID's been gone a little while now, and business travel started back in the spring. But now I'm looking at my own travel, and it seems like we have a full slate of business travel, strong demand there again, coming back this fall. So I expect demand across the board to remain high. But as Jed said, I think we need to be more company specific and pick the right ones. And that's why our Advisor Shares Hotels ETF is actively managed. So we pick the stocks that we think are in the best position.
All right, Dan Aaron's Advisor Shares, Jed Kelly, Oppenheimer. Thank you both for being with us. And that's going to do it for me here on the Watch List. I'm Nicole Petalides. Thanks for being with me every single day here on Schwab Network, 11 a.m. and 2 p.m. live from the New York Stock Exchange. In the meantime, keep it right here. Oliver Rennick, Market on Close.
Oh, it's not too far, actually. We're getting there. We'll be by tomorrow. Might get a gap up, even to it. Another gap. Gap over. What? Baker gave back a lot of its gains. It's only up 10% now. Adds up almost 20. It's getting ready for Power Hour. GNS, little red candle here.
companies in the cloud and the tech space, stocks that in theory could benefit from some of the AI advancements, but this is now software. We've moved on from hardware, and a bunch of the notes out starting things off are kind of negative. There's a little bit of cold feet from the sell side, including the downgrade on CrowdStrike, and then a couple other price target cuts that we talked about this morning, like in Salesforce. So don't forget that in the backdrop of all the economic data this week, we're going to have important companies, the kind of pure tech growth trades that are going to report in the cloud space. Also, regional banks are working today, and that describes, I think, the dynamic pretty well. That value stocks have been strong throughout the session. We've got a little bit more interest in some of the cyclical companies, industrials, materials. Tech's been working its way up the ladder throughout the day, but there's really not a whole lot of impressive movement happening there. NVIDIA came back after being soft this morning, but there's really not too much else to say about stocks. Renita's going to take us through some of the news on the healthcare front in a moment, but generally this is going to be a macro-driven conversation as we prepare for a week with a lot of economic data. And so for that, let's take a look at the 10-year yield relative to the 2-year. This is the event from last week that I think probably could have gone overlooked. You might have missed it. I won't say probably because our viewers are astute viewers. They don't miss much. But in case you didn't notice, there was a big reversal in the yield curve throughout the last 5 days. This is the 20-day chart, and we unwound all of the yield curve widening that had been going on earlier this month as those economic expectations were moving upwards. As we revised GDP expectations higher, as the economic data generally beat, the yield curve was widening out without any extremely hawkish tone from Jerome Powell or any indication really of a dramatic shift in policy. The market has been enjoying higher growth expectations without the negative reaction from the Fed like last year. But that might have changed in the last really week. Yield curve now flattening back, as we see on the right side of the chart. That's coming not from the 10-year yield just moving over a little bit since putting in the fresh high. It's coming from the 2-year moving higher. So even though it seemed like Powell towed the line last week, this is the bond market telling us that on the margin, we have seen a little bit of move towards a more hawkish stance in terms of the market's expectations. And this is generally not necessarily what you want to root for if you're rooting for the economy. You'd rather see the yield curve widening out from the method of the long end yields going up. And that's what we had throughout the last month. It changed a little bit over the past week. We'll talk about that throughout the show here. Also want to point out, in terms of wild card things to watch, my kind of 2 wild cards that I talk about a lot, crude oil and Bitcoin. Crude oil because it tells you about the economy and the potential for inflation to warm back up. Bitcoin because, well, it's our risk monitor, but it's also at a very interesting place in its chart, and possibly coiners will be getting an update from the SEC before this weekend, before the Labor Day weekend, on the Bitcoin spot ETF. Something to keep in mind. Bitcoin's been holding its pattern of higher lows, but the big rollover in the past 10 days does definitely put the chart at risk of a breakdown if things don't go well. So just keep that on your list if it's of interest to you. Most people are going to be more focused on a big economic data this week, but for the crypto and the coiner hopefuls out there, we might get a little update on that spot ETF. Let's bring in Kevin Hanks and Renita Young, talk about some of the action here. Frankly, there's not a whole lot of action, Kevin. It's kind of a sleepy start to the week, but after holding 43.50 in SPOOs last week, I feel like every day we don't go down right now is kind of a victory for bulls.
Yeah, hi, Oliver. You know, I thought going into today, knowing that we have some backdated economic data coming up later in the week, I thought this might be a dry powder day for the market where it consolidates in a range, but it's actually turned out to be a pretty strong day. You've got right now 11 of the 11 sectors in the S&P higher, even though 2 real estate and healthcare, or I'm sorry, utilities and healthcare are pretty close to unchanged, only slightly up, but real estate's the leader today. The number 2, I think, is, communication services. So some pretty good, solid sectors here that are higher. And the Russell 2000 is the strongest of the 4, but all 4 indices up anywhere from 0.5%, close to 0.5%, to about 13/16%, Oliver. So a good solid day. The dollar's quiet, yields are lower, and stocks have taken that cue and moved a little higher. Couple good news stories in there. Boeing, that news that broke late Friday on delivering planes to China, took Boeing up Friday, takes it up again today as we start to kind of digest what that means. But all things considered, with the large amounts of economic data we have coming up later in the week, good solid start to the trading week, Oliver.
Yeah, and some of the key names have firmed up throughout the day. As you mentioned, utilities, healthcare kind of slipped to the back of the pack. Yeah. NVIDIA was down, now positive. Tesla was up, now kind of unchanged, but kind of swapped it out for Alphabet, Netflix, Apple. So some of the important stuff is going in the right direction. Let's talk about what's lagging here, Renita. The healthcare group in particular stands out like a sore thumb.
Risk-reward
ratio.
ratio.
Big drug companies are down, and it seems like the view is that that's because we're awaiting some policy changes and possible price changes from the Biden administration.
Absolutely. They're pressuring these stocks because back when the Inflation Reduction Act was instituted, it included a provision to empower pharmaceutical companies, or Medicare rather, to be able to negotiate the prices of some of the most popular drugs that are used by the elderly, right? We're looking at diabetes medications, we're looking at blood thinners. And if they have that power to negotiate, it takes the power away from the companies themselves to charge whatever it is that they like for a drug. That will almost immediately pressure profits. That's what analysts are saying. It could pressure profits, and it can lower revenues as well for these companies. And that's why you see companies like Eli Lilly, Abbott, J&J down today. And in particular, there are a couple of drugs that are possibly on this list, from one from J&J and one from Eli Lilly. And under this, the price ceiling for a selected drug will be somewhere between 75% and 40% of its average price. If that happens for some of the most popular drugs, then these companies would then have to find other money makers for themselves. And it's of drugs that have been on the market for a long time. And so the companies themselves, they've been able to make profits off of these drugs for decades. And for them to not be able to do that would certainly upset their balance sheet.
Yeah, and they're pushing back on it as they are suing the government to try and prevent some of this. And the analyst community, to your point, is very clearly saying this is going to be negative for the revenues, the profits. Blood thinner for J&J, diabetes treatment from Eli Lilly. This is also, though, going to separate pretty clearly the companies that are on the cutting edge of neurological treatments for Alzheimer's and other diseases, companies that have been on the weight loss pill and cutting. It's going to really separate, because to your point, these are mostly drugs that have been in the system for a long time, and they're just not going to have either exclusive rights, or they're not going to be able to surpass certain price caps.
You're absolutely right. And so in particular, I want to talk about J&J and Eli Lilly, what you brought up, because J&J, their blood thinner may be on the chopping block, so to speak, the price for Xarelto. The company itself is up around down 7% year to date. Eli Lilly, their diabetes drug, Jardiance, which we know folks have been taking for weight loss, that has driven the stock up around 51% year to date, right? And so you're absolutely right. We can see the difference in what these companies are going to be known for after this happens. And it's apparently going to be 10 drugs that Medicare will be able to negotiate prices for, and we should find out in the coming days what they are.
Yeah, this is going to be a lot more relevant for a stock that's down and already under some pressure, like a J&J kind of struggling to find its place post-COVID, versus an Eli Lilly that's kind of been blasting off and charting its own path here. Nice work, guys. Kevin Hanks, Renita Young, appreciate it. Finding some movers for us in today's session. Let's branch out and let's talk about the week ahead and whether or not the expectations for GDP are going to reach Atlanta Fed's 6%. Vincent Dillard joins us from StoneX Group. He's a director of global macro strategy. Vincent, you've taken a liking to my trampoline landing. I love it. You're rolling with it still. But what comes next? Have we gotten the trampoline bounce with all the expectations for GDP going up, or do we need to see it actually come to fruition this week and print a big number like 5% plus?
Yeah, I'm gonna frame the Atlanta GDP nowcast, and I'm going to send it over to you, Oliver, with a thank you note for coming up with the term trampoline landing, which I've shamelessly promoted with my clients. And, obviously it's been fantastic, right? I mean, everybody was thinking the economy is going to fall into recession and we get like 3 quarters of accelerating growth. Yeah, like China level growth right now. And that is a bit my concern is that the problem with jumping on a trampoline is that at one point you reach peak momentum, and when you're at the peak, there's only one way to go, and that's down. And I suspect we are seeing the kind of maximum velocity in the economic reacceleration.
So this reading this week, still looking back, expecting like a 2.5% roughly, kind of low twos where the ballparks are. What are the odds you think we beat that? What are the odds some of this quarter creeps into last quarter?
Yeah, a bit high. I mean, it kind of depends on like where the cut-off date falls. I still think, we're probably going at around 3% real, which is really good. My concern is that this is going to slow down in 2024 for the exact same reason that the economy was stronger in 2023 than people expected. And the reason really has to do with inflation adjustments being applied backwards. So last year we had very high inflation and it kept falling throughout 2023. So any sort of payment that was indexed on inflation, things like cost of living adjustment for Social Security or income tax brackets, which were raised by 7.5%, really meant that you had real wage gains of about 5%, which is kind of what we're seeing in personal income. So this was very good. Now going forward, this is not going to work just as good, right? Because inflation is now at 3%. So when the Social Security meets, they'll decide, okay, next year core is going to be 3%. Now, if I'm right that inflation will actually reaccelerate going forward, you'll see real incomes dropping. So that's one concern. Another concern is state spending. As you know, Mr. Newsom has been waiting for Joe Biden to die. DeSantis has been waiting for Donald Trump to go to jail. It looks like none of these things are happening, but we had a big surge in spending in California and Florida by about 45% last year as the governors were preparing for their run and they wanted to run the economy hot. That's going to reverse as well in 2024. So we have a lot of kind of headwinds in 2024. We have an economy that's red hot, and eventually we'll feel the impact of having 500 basis point tightening in less than 12 months. I mean, it's taking longer than prior cycles, but eventually tighter monetary policy will tighten financial conditions.
To your point about the fiscal drag coming from policymakers, coast to coast, basically, the annual general fund spending changes are coming down. Just another chart from your report here. And is it bad if it settles into something more normal? Like, what matters here? Rate of change? Because it's an extreme rate of change off the highs of the COVID spending, of course. But, I mean, what if it's just we're not getting stimulus anymore? Does that not mean, we can still walk, we just maybe won't run?
Yeah. That's a fair point. Now, when it comes to growth, it's really the impulse that matters, right? So that impulse was enormous. And it was spread out. That was not just the 2021, 2022. It carried on over 2023, that impulse, especially if you look at the state level. And that's going to be a lot less. Like, I kind of agree with you that, it's normalizing. Even if you look at the federal budget, we still have the IRA, the CHIPS Act. We'll still see, fabs being built and all that. But I think what was unusual about this year, we're coming from a very low base, right? Between the time the IRA was voted, you need to pay off the consultants, the lobbyists. So the projects don't get built right away. So it went from zero to probably $150 billion in spending from IRA and CHIPS Act projects. Now, I don't expect that to slow, you're right. But the delta is going to be close to zero, right? And then same thing at the state level. So that impulse, which is really what matters, for markets, what matters is the second derivative, right? The change in the rate of growth. That's going to be a lot less positive going in 2024. And I think what you say makes sense. Maybe that's not a recession. I don't think I have enough data to join the chorus of people calling for a recession. I want to be mindful that in general, the economy has always been a lot more resilient than people thought. So, we should give the benefit of the doubt to the economy. So maybe we don't have a recession in 24, but at least a slowdown. I think that's almost baked in.
consistent with the analysis that you've been on for months when there was a lot of talk about falling off a cliff, recession, regional bank fallout, all this stuff earlier in the year. Your point has been, look, more likely the surprise that could be painful to investors is surprising strength, surprising inflation, and then eventually, even if it's not true recession, if it slows down without inflation coming down, then we've got problems. So where do you see that kind of transition to where if we do start to slow down, we look and we check inflation, we say, okay, inflation's been coming down, so maybe that's all right. What is that cost benefit right now? Like, what should we be rooting for? GDP to go back down, inflation to go back down, both? Like, what's the ideal outcome?
Well, I mean, the ideal outcome is what we had all year long, right? Which is, GDP accelerating, inflation falling down. I think it's going to be much harder to get that going forward. I mean, on the inflation, we've reached peak base effect. That 3% may be the low for the cycle. On a year-over-year basis, inflation's already re-accelerated, by the way, last month. And I expect this to continue because the base effects are much less favorable, because oil prices are fairly high, because healthcare inflation has been understated for a long time, and that will reset in November. So we'll have about 10% of the CPI that's going to reset much higher. So I expect we've seen probably the low for this cycle when it comes to inflation, and we're going to stabilize at around like 4 or 5%, which is where wage growth is at. So inflation re-accelerates, growth slows down. I may not fall into recession. I'm with you on this one. I mean, I think we'll talk about it in 3 months once we have more data, but it's possible that we avoid a 2024 recession. I'm not married to this idea, but it's going to be a much harder environment, right? Falling growth, higher inflation. And you have equities at 22 times earnings. I can see that also impacting their earnings. We don't get the big recovery in earnings that's being priced in for 2024. So that makes for a much more challenging environment for stocks, which I think is one of the reasons why we've seen some level of weakness in the past month or so, like a 5-6% correction in the stock market could be the beginning of something bigger.
Vincent, appreciate the update on the framework and the thesis. Always a good convo. Appreciate the charts. Helpful to visualize where we're at here with those expectations getting ratcheted up, looking for inflation to continue its path higher alongside those economic expectations before the risk for recession starts building. But that's a next year problem, according to Vincent. So right now, we need to stay ear to the ground for inflation this week. Vincent Dillard, StoneX Group, coming up. Next guest got some stock picks for us and a pretty interesting batch. There's some cyclical stuff in here. There's a bank mixed in next to the king of AI, NVIDIA. What do we do with that stock after its faceplant last week on earnings? Still obviously up a ton. No one's disappointed with their NVIDIA outcome this year. We'll be right back.
for chips or best producer of AI. It's relying on Taiwan Semi. I'm a little worried about the exposure to China. I don't love the valuations at 200 times, but it's clearly the behemoth and leader in the industry. So you want to grab a tiger like this when the opportunity presents itself. I don't think it's right now, but I want to put it on folks' radar because it is a name that has certainly owned 70% of the chip market, and it now is projected to be maybe as much as a $1,600 stock. It's just really expensive right now, and I'm concerned about the next 30, 90 days. There'll be a better chance to enter it. So I want you to manage it now and be prepared to add more down the road.
Okay. So if you've been in it and you've made profits, take some at this point. Take the bird in the hand. If not, you might have missed it. Wait for a dip.
Exactly. It's a generational stock, just not right now. Let's be smart about not putting good money at bad right now. And we did a $7 billion in revenue and the company's selling off. It tells me the company's not inexpensive. Folks are taking profits. Let's let this play out and then look for a better entry point soon.
All right, fair enough. How about a stock like Walmart that looks kind of similar in some ways? I mean, it doesn't trade at 200 times, but has had a great year. And then it gives earnings that seem, I don't know, they seemed fine to me. And
yeah, it's building a little head and shoulders here, though.
So obviously totally
get your
different,
hopes up.
but kind of the same dynamic around earnings.
And I like that the stock dropped going into the best spending seasons of the year.
GNS.
Back to school is the third best spending season coming in, followed by Halloween, Thanksgiving, and obviously end of the year. 15% of their revenues now online sales. I project that to go to as much as 30. That's going to change the whole dynamic of the company. Buying back $1.5 billion, paying a large dividend. Company positioned for a slowing U.S. economy. From your prior guest, I couldn't agree more. The headwinds of the U.S. consumer as we run out of COVID spending and begin to environment of higher rates for longer eventually have an impact. This is a company at the core of where the consumer is going to spend in the holiday season is Walmart. So getting it a bit cheaper, getting it a company that's reinventing itself, paying a dividend, buying back stock, set up for a nice solid return at a time of what I think is a very bumpy stock market for at least the next 2 months.
Yeah, like the last point too, because Walmart's been able to weather a lot of different storms. Inflationary environment, had a misstep, but still was better performer than tech last year and then this year coming back with the economy. Not to mention Amazon is now pumping up their free delivery cost if you don't have Prime. So maybe people will be going over to Walmart to get the deal. Even I was at Costco this weekend, so that's got to mean something. First time in a lifetime.
Good company, a little expensive, but I like Costco as well too. Just not as cheap as Walmart right now.
Yeah, true. All right, let's keep going here. Where does JP Morgan fit in here? This is where things get very interesting because the acquirer of distressed banks seems to be their favorite role to play for Mr. Diamond.
Anytime I can get the best bank in the country at an 11% discount to its 5-year PE, at a time I think rates are going to be higher for longer, and they make a lot of money on cash, and they're in a position of power to buy up cheaper companies that are going to be good companies like we've already seen them do. I like this company a lot. Trading at a bit of a discount. The stock should trade about $170 a share. You look at where it's traded recently. We had some breakout days there. Their investment banking abilities, their capital markets ability, their trading capabilities, plus with what they own. Best bank in the sector. You look at how they really just crushed it in the stress test, that they have no real issues on their balance sheet. This is a company that's positioned for a long-term growth and a nice dividend. This is a weather the storm kind of company. I'm not worried about a company like this in a recession. It's a company that's going to hold up well in a volatile environment because it's cheaper than it's been, and you get a nice dividend as well, potential outgrowth in the months to come.
Do you think if the Fed's got to get more aggressive, rates go up again, is that going to stress the banks? And if so, does JP Morgan benefit from that if there are some more casualties along the way? It seems like the market's been happy with their acquisitions.
Exactly, and I think there's more of that to come. We're seeing consumer debt, specifically at the small banking sector, default tick higher here. So there's going to be smaller banks that have credit card debt out there that they're going to need help with. Now, as far as the biggest banks, specifically JP Morgan, almost none of that because of the size of their bank and diversified base of their customers. So not only are they positioned to take advantage of being able to lend money here and make big percentage returns on it, but also make acquisitions that'll just bolster the size of the bank that much more.
Pretty steady as it goes and still up on the year. All right, I like it. JP Morgan, NVIDIA, Walmart, last one, Caterpillar, which had a big response to last earnings, though I do think people still worry a little bit about the China exposure, what's going to happen to the economy there. What do you think drives the stock going forward, Phil?
Again, another stock is trading at an 18% discount to its 5-year valuation, but it is the aristocrat of dividends. This is a company that pays you a gigantic dividend. also buying back shares. If you think about the CHIPS Act and the Infrastructure Act, they're going to benefit from this continued infrastructure play, which is going to go on for years to come. Look at the housing market, how much more demand we have to build new homes. So I think they're positioned not only with the recovery from the pandemic and this need to buy new equipment. I'm less worried about China. They're not out of business in China. They're just doing less. But the U.S. can pick up that slack in an area where we're going to see lots of spending. But more importantly, let's put that aside. Let's assume revenue stays where it's at. What do you do in times of market volatility? You want to be paid to wait around. One of the biggest dividend payers out there, own the dividend. Well, hopefully they get great growth from what's to come. But even if they don't, the dividend battens down the hatches in your portfolio. It gives you balance. Buy a good company that's less expensive. It's a great way to ride this out if I believe like the next 18 months are going to be pretty tough in the stock market.
All right, that's a pretty well-balanced portfolio there of stocks that we just hit, right? You got NVIDIA for the high beta growth. You got Walmart for the stability next to JP Morgan, and Caterpillar on a little economic firming. And I will say Caterpillar, of all of them, is second best performer in the past year if you stretch it out to 52 weeks. So hard to touch NVIDIA's monster run, but Caterpillar sure has hung in there. Great stuff, Phil. Appreciate the rundown.
Thank you.
Yeah, fun combo. Thanks. Phil Blancano, Advisor Group. There you go. There's your 5-stock portfolio from Phil when we come back. If you really want to get some beta in the market, some juicy action, if you're hurting for a roller coaster, you might think about riding the VinFast train. This thing's going nuts, and it's weirdly out of place in a market that has been pretty static. A pocket of euphoric excitement on the Vietnamese EV company that just debuted this month. It's up another 20% today, and it just started trading options. We'll take a look at it with Tom next. Tom White in the studio with me with 3 bullish trades. I'm saving the exciting one for last, Tom. Let's get through these other 2 since I did the tease for VinFast, but we're going to make people wait. Splunk and Disney. Let's start with Splunk first, carrying its earnings bounce into this week. Pretty good move here. Major breakout.
Yeah. Hiked guidance. I think that's the biggest takeaway. Earnings beat. We've seen some earnings beats, but at the same time, we've also seen some stocks fall But the stock's up about, 36% so far this year, 8% this month. Pretty good report that they just had last week. Posted net new annual recurring revenue acceleration. Free cash flow was higher than expected. So beat a lot of the estimates there, simply executing better than maybe a lot of the other cloud-based companies. And we saw some call buyers in there out in the October cycle. So giving themselves some duration, about 2 months till expiration. They bought the 125 strike call about 3,000 times. Paid an average debit of about 266 on these calls, so that break even for this trader, 127.66 over the next 53 days. That's about 9% above the current share price in there. Yeah, we saw a lot of flows into Splunk last week also, post results, and adding 2 positions here. But I think the key on this trade is they're giving themselves some more duration, right? If the market rebounds, Splunk will probably partake in that also. But it's definitely gone against the grain in some of the tech names that did report last week.
Especially when there are all those cautious notes out on cloud companies going into this earnings.
Yeah, Snowflake, Nvidia's still, falling, and
that's right. Snowflake got hit. Wow, Snowflake's down another 2% today. All right, and of course, CrowdStrike down big. Okta's coming up. So, all right, Splunk definitely a winner right now in the group. Let's talk Disney. Fresh low last week. Dead mouse bounce here.
Hit 3.5-year lows on Thursday of last week. Rebounding a little bit today and on Friday also. Are they going to spin off ESPN? Are they going to have a partnership? Amazon said they're working with Disney to possibly stream some of their sporting events. It seems like everybody wants to get into this live sports action here. We were already seeing them with Apple TV Plus with their MLS deal. There's Wedbush put out a note that that Apple should buy ESPN. I mean, I never thought it would be for sale, but there's spin-off rumors also of ESPN being their standalone company. Cruise is at 98% occupancy. They've seen a little bit of dip in park attendance, but
inflation killed it.
Just an unloved stock here at this point.
So expensive.
Somebody thinking that, hey, by the end of the week, we're going to see a massive rebound in there. Or not a massive, but a big rebound in there, because we saw some traders buying the 85 strike call in the September 1st weekly series. So only 4 days till expiration. These are just out of the money to the upside. They paid roughly about a debit of 55 cents for 25,000 of these calls, Oliver. So that break even of 85.55 over the next 4 days is only about 2% above the current share price in there. The stock's below its 50, it's 100, it's 200-day moving averages.
There's
just no support. But with the sentiment being the way that it is, do you take that contrarian play here and think, okay, Disney's seen enough? Remember, Nike, another big brand name.
This is the Ben Watson trade.
Yep.
If your office is filled with Disney memorabilia, this might be your trade.
Yes, definitely. And, the sentiment on this stock is really down at this point. They've got segments of their business that are working well. So
yeah, I hear that.
Yeah,
it's so unique. There's just nothing. There's not that many charts that are making new 52-week lows. There's stuff that's rolled over from highs, but nothing quite like this. All right, but there's really nothing like VinFast out there right now.
No.
I don't know where this is coming from. Are people just gluttons for punishment? Every time a new auto stock or EV trade comes out, they're just going to repeat this? And, we've gone through this so many times. Is there any EV stock that's gone public in the last 4 years that is anywhere close to their debut price?
Yeah.
I don't think so.
I've got one little tidbit that I think might be driving the shares, and they've got 2.3 billion shares outstanding. Only a small portion of those are tradable right now. 17 to 21 million shares of that 2.3 billion are available for trading. A lot of them are locked up at this point. But, the stock is going bananas. You've got a market cap of about 190 billion, above
That's
$81,
insane.
$82 a share.
By comparison, Ford and GM are like 40 billion.
Yeah, 47, 45 billion for each of them.
This Vietnamese, not a startup, but I mean, kind of, yeah. This Vietnamese neophyte car maker is already trading at a market cap almost 4 times GM and Ford.
Produced just over 11,000 11,000 cars so far. So they're actually not pre-production, right? They're going to open a plant in the U.S., but this is out of hand. Who knows what's going to happen? Stock's up 120% from the closing price the day that it went public on the SPAC offering on this one. But yeah, the numbers are getting silly here. Is it a new meme stock? Who knows? But
their founder is right now the paper 23rd richest person according to Forbes.
Yeah, they got the one car that's priced comparably to the Model Y, about the same range, about the same 0 to 60 specs on it and stuff like that. But yeah, this is just all speculation.
Sure, I'm sure the cars, they seem fine.
Yeah.
First, I think the cars are
first
bad.
day the options traded in here, so we don't have any background or historicals on this, but we've seen over 16,000 calls traded on the session today. Pretty good for a stock that's going a little bit bananas here at this point. But we did see some call buyers kind of stuck out to me. They don't have weekly options yet, just the monthly. So September 15th, the monthly options here. Traders were in there. They bought over 3,500 of the 100 strike calls in here. So they paid a debit of average debit of about $7 on them. So the break even for this trade, $107. It's about 30% above the current share price in there, depending on where the stock's trading. Yeah, just below $82 a share. But yeah, 32% move to the upside. But Oliver, another couple days like today, over the next 18 days, and you're easily above that break even. But yeah, this is one definitely to keep an eye on. I mean, you know, market cap is nuts compared to the OEMs in this space, and all the EVs that are out there besides Tesla combined, this stock has a bigger market cap than all of them combined. So
yeah,
there you go. Lots of interest.
Tesla, Toyota, VinFast.
Yep. Well, wow. Buy options. Don't buy the stock.
Totally legit market.
Offset some of the costs. Sell some calls against calls.
The IV is like through the roof. Yeah. It's like the most expensive stock to trade right now.
Market cap wise, valuation wise, and everything else.
Market just has no respect for General Motors or Ford, basically.
Or Stellantis or Volkswagen.
All right, well, okay.
I think you combine three of those and...
No one's got respect for Stellantis.
Yeah, this market cap's bigger than all three of them.
Right, thanks, Tom. Interesting trade. All right, VinFast now open to options trading. Good luck. When we come back, let's get an update on a tech business from Jenny Horn, one that often goes overlooked, but a very important supplier to a lot of the hardware giants out there.
Okay, sending out alert to the data farm. Putting up a little position today. Head and shoulders broke. Just a consolidation on GNS. Minutes of Fugazi.
coming up. 7 minutes.
Pretty decent here today, Jenny.
Yeah, pacing for its best day, at least it was earlier this morning, since March of 2022. And actually, this ties in very nicely, partially to the story you were discussing with, of course, the EV being VinFast, because we're seeing a lot of these competitors emerge now to try to give Tesla a run for their money. But we are seeing this story today with Jabil involving BYD. Of course, that's that Chinese EV maker that is the second largest in terms of China, just behind Tesla now. But Jabil did reach this preliminary deal to sell its mobility business at a value of around $2.2 billion. Their CEO did say that if completed, the proceeds from this transaction will enable them to enhance their shareholder-centric capital framework, including incremental share buybacks. Additionally, he went on to say this will provide opportunities to further invest in EVs, renewable energy, healthcare, AI cloud data centers, as well as other end markets. Now, Jabil Circuit specifically, which manufactures some printed circuit boards, established a new unit about a month ago and absorbed its product manufacturing businesses, which will now become part of BYD. Now, interesting enough, BYD also recently established that it's now selling some electronic components, I'm sure to then establish itself as a better competitor to Tesla, which has tried to push out its different electric offerings. They now have some pretty advanced batteries as well as different solar offerings. So BYD now looking to expand what seems like to me beyond just being an auto player. Citi analysts do believe that this deal involving Jabil's Greenpoint metal casing operations could further actually penetrate Apple's casing supply with higher market share. So interesting competitor that Citi mentioned specifically. This name, though, is with this nice move higher today, up over 8.5%, erased all of its month-to-date losses. It's now up 64% this year. So this is quietly a really nice performer and is now up 102% off of its low, and also just delivered in its previous quarter a nice top and bottom line beat. So Jabil looking like a healthy company as far as its fundamental story as well as now its price activity on the year.
Very underappreciated. Definitely. I mean, things like kind of unstoppable. They're just churning out $2 billion businesses to sell to big growth companies. That's pretty impressive. Not to mention, super fun to say, Jabil, Jabil.
Jabil, Jabil.
Thanks, Jenny. Appreciate it. Big move in the stock, big move in the year. Let's talk some commodities. Chris Robinson joining us, Managing Director at TJM Institutional Services. Chris, it's a little bit of a sleepy Monday. Crude oil, though, managing to hold on to $80. Seems like it doesn't want to let go of this level.
No, it doesn't. It feels like they're kind of hanging fire. You know what they did in China? They're really boosting their market over there, trying to help their real estate market, their stock market, all kind of stuff happened. So people are going to still wait and see, because if that demand ever kicks back in, I think we'll break out of this range. What range am I talking about? For 6 months, we've been basically trading between 63 and 83. We poked above, 85. But again, it's going to need a launching pad to keep it going. And every time there's some negative news, we backed off. So they're making it difficult. Big picture, you got to take the contract high and I'm just using the spot month. 130, we dropped down to 63. I always look at the halfway back. Halfway back's 96. That, I think if we poke above 85, you'll see people start talking about 96. Why? Because markets like to do those halfway backs. Also, the whole world knows that we still haven't refilled the SPR yet. We are short 180 million barrels at an average of 95.
New high of the day on SPY.
That's another reason out there. On the way down, it was kind of the Biden put. On the way up, it might be the Biden call.
So that's a pretty interesting idea.
There's our test on the top of the range.
For limits
some puts
to
there.
The rally in crude oil. It seems
That's
like
what I was waiting for
it comes
earlier.
from several different places.
Finally made
I
it.
mean, obviously,
Last
people are
15
watching
minutes.
China's attempt to revive their economy, and it's kind of going so-so. America here, too, if we can generally kind of turn on the spigots, it seems like outside of like inflationary supply shock, perhaps our ceiling for crude is maybe lower than folks thought.
Well, we'll see. I mean, a month ago we were at 63, so
Four
it's
trades,
been pretty volatile. And we've done that round trip now, I think 2 or 3 times if you could look it down. So 2023 has been a couple times where, again, it hasn't been a buy and hold or a sell and hold market. It's been a trader market. When you get stuck in these sideways ranges, everybody gets bullish at the top. Here we go. We'll see. When it breaks out, you'll know. And like your previous guest said, I think the way to play it is, like Tom said, options, because you limit your loss when you're wrong.
If it is going to make a move, does it have to move soon? I mean, is the window of opportunity for crude bulls now going into a quarter where we're expected to push GDP from 2.5% up to 5% plus? I mean, that seems like that would be the time, if there was one, for commodity prices to start rising again. I mean, connecting it basically to the point of Vincent Dillard at the top of our show, who says, get ready for another inflationary impulse.
Yeah, I mean, it's the kind of the stage is set. One thing, it's interesting because I follow all commodities, obviously, and it's really impacted corn. Corn moves with crude oil and also gasoline. Long story short, gasoline demand has been kind of less than people had thought it would have been. It's a little bit on the feeble side. If that was to ever pick up, and again, everybody's out there. It all comes down. I think it's China number one, number two, the American consumer.
Resistance. That's crazy.
Spending. Then we'll get through it. If the American consumer backs off, you got to remember that's 70% of our economy, and the bellwether for that could be crude. So I think it's
down another 11%.
Probably if you're looking for a kind of a binary trade, crude's probably the way to go. If you're bullish or bearish, all you have to do is hit buy or sell, and you're in.
All right. To your point, our Bob kind of struggling a little bit today, down 3%, so a little softer there. Compared to crude, I mean, it's very choppy and range bound too. So
yeah, summertime trade, August. Wait till next month, September. We have to get through all the stuff in the fall, beginning of the new quarter. People start talking about what happened in 1929 and 1987. So they'll be in anticipation of some sort of a move. Just don't always assume it's going to be one way or the other. But again, the market's kind of pausing here. A lot of the commodity markets are kind of waiting, and I think you'll see a pickup.
Yeah. All right. Appreciate it, Tom. Thanks, Chris.
Thanks.
WTI hanging out near $80. Seems pretty sticky there. When we come back, we'll get our Charles Schwab Big Picture panel to take us into the bell.
All right, guys, there you have it. 10 minutes of Fugazi. I gapped up today. Range bound all day. That strangle in the morning. Guess it kind of worked out. So calls and puts like here, and then added to puts here. Okay, added again here. Close some here, close the rest here, and added to calls here. I was down most of the day. The strangle didn't work out, and the puts were just such a small range, here down to here with a lot of chop. Could have gotten into the long side quicker and gotten out of the short side. That exit was pretty slow. Some days I do it better than others, where I exit where it's good to exit, and then I don't think about entering. My old habit is basically exiting where I would enter the other trade, and that's not necessarily the way to go. So basically exiting when it's when you're up and you're profitable on it, and not thinking about waiting for it to totally reverse. So that's where closing the calls, or closing the puts, entering the calls, that shouldn't happen at the same time. Should have closed puts. Could have closed them here, even on this double bottom. Could have closed them. Could have entered calls on that double bottom as well. But definitely should have had my puts closed before then. I was kind of stuck on it, filling this gap, and that clouded my judgment, trying to force the market to fill the gap. And then on the calls, could have gotten in a little earlier. I guess I was still thinking low gap. So, but at any rate, back up profitable up here. Closed the calls up here, so did that trade right. Didn't wait for it to be good for puts. Considered puts, but I didn't. Got back into calls here for the cup, actually like here, and then some here. And same thing that happened the other day. Trying to trade that handle, prior for the handle. It took too long, and
then that stopped myself out. Didn't actually have a stop on there, which I probably should have. And then took the short here, which was a good trade, the break of VWAP, and then building this inverse cup. So I took that short and closed it, reopened it at some point, and then closed it back out at the beginning of this candle. So it didn't take too long on that. And that was basically my last break-even trade. So ended up flat on the day. It's good. Brokerage won today. That's okay. Small win for them on their commissions. But yeah, these are the days where it's like you have tight stops. You can just enter, puts at resistances and calls at supports. Double bottom, double top, another double top, another double bottom, just in the same range. At a tight stop, you can do that because if you're wrong any of those times and it starts going against you, you're just stopping out. So I kind of was able to start leaning that way towards later in the day, and that's what I was able to climb out of the loss from the morning. Just that chop, but overall pretty choppy day, even though there's big resistance and support. The longer time frame, it did just like do a crazy candle up there to the top of that range, so I think we'll probably come down a little bit tomorrow back to the bottom of this channel, as we've just traded sideways and kind of killed our steep aggressive upward channel here. So doesn't seem like that's going to carry us and break us out of the range to the upside, so I'll probably come back down bottom end of that channel. But yeah, tomorrow we have price index, job openings. So we had JOLTS, job openings, consumer confidence. Saw it. Let's see, job openings and consumer confidence at 10 o'clock. AMC's down 10.5. GME's up 2.5. This one's been quite predictable so far. We saw a bounce at some point coming, but it's still in this downtrend. They're just stretching too far from the moving averages, so bounced with the market a bit and just perfectly rejected that $18 resistance right here, and still trending down, using that as resistance as well. So I think it'll probably stay below 18 before earnings, and might even continue using this as resistance. This line right here, wouldn't be surprised. We do have earnings on it coming up though. Let's see, next Wednesday. Barbecue is a little bit more bullish by today, but we'll see. Trading sideways is better than trading down. So consolidating before, move up or down on it basically. But I think the downward momentum has stopped for now. Could be consolidating before more downs, or consolidating before reversal and bigger cup that's being formed here. So kind of waiting to see what levels hold on it. Today is down 5%. Is still above this resistance, which is good. You do kind of have a head and shoulders, but we also have kind of an inverse head and shoulders here, so it's just consolidation of a resistance, which is nice. GNS, big gap up. You're following us here for the dip buy. That was a handsomely rewarded trade. It's 150% or so from the dip. And if you're following it from back here when we bought it, the gap fill. Nice trade also. Down to that trend line, 320%. They've got their XDV coming up. Hawaiian Electric up 44% on news that they did not start the fire. Still have suspended their dividends, still a sketchy play, but pretty bullish. Liquor's up 12%, stock buyback. Jones up 10%, I think, just pre-earnings run up because they don't have earnings till I think after hours or tomorrow maybe. Pre-market, not sure why Jones up 10%. BFS still up 20%. Nice trend up. I mean, that's not a very good looking candle on the daily. The double doji could be a reversal. Let's see. 1 minute to close. I just in its range. Carvana's up 10% today. Crazy. I didn't do really any other trades. We traded GNS and then just the SPY. And then one entry on the Theta farm. A little bounce on Rite Aid. Up 8.3, 8.4. We'll see if they come out and say allegations of us preparing for bankruptcy are false. This will have a big rip. This wasn't our Theta farm. It is now out, so it doesn't matter a whole lot to me. Could get calls or something on speculation of that news coming at some point. IB is now cranked. Market's closed. See, I don't need to mess with another bankrupt stock. Or potentially bankrupt. Barbecue end of the day down 3.8. AMC down 11. I guess bullish catalyst for AMC would be that they've completed their dilution. I think that could be coming out. Possible, because I think they've been able to dilute. So, and the chart looks like some serious selling going on. But that's what I got, guys. Hope you had a good day. Good happy Money Monday. Most of the day getting positions, hardly closing. Yeah, GNS is still looking good. Might have another after hours move. Let's see the daily candle. Daily candle is pretty strong, nice volume. Yeah, you might get a gap up to fill that gap. We're near there. Have I guess a couple more days. You have till Thursday for the XDivvy, so you have to own the shares by close of tomorrow. Options for GME earnings. Yeah. Today, I said when I would have shorted it for earnings when it hit that 18. I think Guts got some puts on it up here. That was also when SPY looked like it was at a top. Doesn't mean it's not still a good entry tomorrow wherever it opens. Not sure what it's gonna do for earnings though. Really don't know. Thanks, Christopher. Thanks, Gillied. Thanks, Guts. Thanks, Bubba. Julian. Poison. Hope you guys had a good Happy Money Monday. Kind of slow. Or I was pretty quiet. It was pretty slow. Thank you guys for your thumbs up today, though. I appreciate it. 25 likes on the day. And we did it. We survived another day in the market. Every day longer you survive. Day longer. Likely to make money. Survive. Thanks, guys. 22%. Nice Guts. Oh, on those GME puts. Sorry, I couldn't be a little more chatty, Poison. It was pretty mellow overall. Even with GNS, just consolidated basically all day. It's like the SPY. Gotta survive. Surviving is winning in the market. Thanks, guys. We'll see you on Discord. All right. Have a good afternoon.